Evening. Welcome to day 5, the final day of your CA Final FR Marathon, applicable for your May 24 examination as well as later exams as well. Now, we are left with only few topics which are to be done today. Already 4 parts. We have completed part 1, part 2, part 3, part 4. Today is the 5th part of this marathon. And I tell you, this has been a very exhaustive marathon. Approximately, I have taken around 26 hours. Yeah, 5 days, and every day it's more than 5 hours. So approximately 26 hours we have taken. The 26 hours of revision, which covers your everything. All your theories have been covered, plus all the important questions marked in your material, they have also been covered. What's today's agenda? Today's plan, we need to finish up IND AS 115. Then we need to finish IND AS 116. Then financial instrument, IND AS 101. And lastly, analysis of financial statement. I hope you have enjoyed this session still now, and do share about it with all your friends. Definitely it will be helpful to everyone as well. And anybody who wants to buy my lectures, it's available on yashashacademy.com. Let's begin. Chalo, starting with IND AS 115.
I don't have an answer for that. Is there?
Starting with IND AS 115, that is revenue from contract with customer. Okay, now this standard is related to your revenue recognition. How do we record our revenue under IND AS? Okay, now the word revenue which is written, the revenue includes only your basically revenue from sale of goods or services in ordinary course. So under IND AS, word revenue includes only the revenue from goods or services from your ordinary course. Interest income, how do we record? Dividend income, how do we record? It's not covered here. But if I go to AS9, if you go to AS9, so under your AS9 revenue recognition, it also covers your interest recognition, dividend income ka recognition. That's covered under your AS9, not over here. Over here, interest income, dividend income, they will be covered under your IND AS 109. Fine. Now, recognition. This standard is based on a core principle. This standard is based on a core principle. What is a core principle? It requires entity to record the revenue in a manner that depicts transfer of goods or services. As in when you transfer goods and services to your customer, you record revenue. Now sir, what value? Okay, the when to record, as in when I transfer goods and services. What value to record? Amount. At an amount that reflects the consideration the entity expects to be entitled in exchange of those goods or services. Now there's a 5-step model for revenue recognition under your IND AS 115. First, you identify the contract with customer. Then you identify your performance obligation under the contract. Then you determine the transaction price. Fourth, you allocate the transaction price to various performance obligation. And step 5 is, as and when you fulfill your performance obligation, you recognize that much revenue. The 5-step model will discuss each of the step in detail. Step number 1, we need to identify a contract with the customer. First, there has to be a contract with customer. Now, when do I say there is a contract with customer? When do I say there's a contract with customer? So again, for that, they're telling there are 5 criteria. All 5 criteria fulfilled, then only we say there's a contract with customer. Which are the 5 criteria? 1, the parties have approved the contract. The parties have approved the contract and are committed to perform their contractual obligation. Now, when they say they've approved the contract, it's not necessary in writing. Not necessary in writing. Number 2, the entity can identify each party's rights. Entity can identify the payment terms. The contract has a commercial substance. And last, the important, it is probable. Probable means chances are more than 50%, more likely than not. It's probable that entity will collect substantially all of consideration to which it expects to receive. It's probable you will be able to collect substantially all. Substantially all is kind of more than 90%. It's probable you will be able to collect substantially all of consideration, more than 90 or sometimes more than 95 also. It's up to you. Okay, so now, it may be possible on day 1. It may be possible on day 1, substantially all the consideration I'll collect is not probable. I was not able to sell the goods only, and this time that's why I'm selling it to some new party. I have a doubt I'll not be able to collect money, but still I don't have any other option. So my goods are becoming outdated. I'm not able to sell to anyone. I'm selling it to someone. I have a doubt, but still, मैंने बेचा. The question, sir, should I record revenue? Now see, as even if one of the criteria over here is not being fulfilled, so can I say over here that the contract doesn't exist? So they'll tell, if the arrangement does not meet any of these 5 criteria at inception, you need to reassess whether they are subsequently met or not. And whenever they are subsequently met, that time you should book revenue. Now, sir, what about the advance received? Imagine substantially all of collection will come, that criteria was not being satisfied, but I've got some money. Imagine I got 20% money. So should I book that much revenue? They say no. Pay attention. A contract may not pass step 1, but you might have transferred goods and services and you might have received some non-refundable consideration. You're given goods and services, you got 20% money till now. So in that circumstances, you cannot record revenue until the step 1 criteria are met or one of the below event has occurred. Either the step 1 criteria should be met or one of the below event should have occurred. 1, you have no remaining obligation, and substantially all of the consideration has been received and it's non-refundable. Now see, I have not received substantially all consideration, I have received only 20%. So this is not satisfied. And number 2, the contract has been terminated. No, contract is still not terminated. So this criteria is also not satisfied. So sir, that advance 20% received, should I book as revenue? Now, if you have a doubt that substantially all of consideration will not be received, don't record that. So sir, what about that 20% received? That you show it as a liability. Once that step 1 criteria met, then you can record revenue full. तब तो fully record कर दो. But sir, what if that step 1 criteria never met only? So then in that case, if contract is terminated and whatever you have received is non-refundable, that time you can book it as revenue. Fine. Check question number 2. We sold machine for 20 lakh rupees. It's a new entity. If they earn, they'll be able to pay it. That's a kind of criteria. So we have a doubt. So substantially all of collection will come or not, वो doubtful है. So now, there's a non-refundable deposit of 1 lakh received at inception. Should I book that even 1 lakh revenue? Answer is no. So your criteria were not being fulfilled. Now that 1 lakh rupee, should I book it? That answer is also no until your step 1 criteria are met or any one of the following event occurs. Which are one of the following event? Okay, you have basically fulfilled your performance obligation. Substantially all of consideration has been received and is non-refundable. No, that is not fulfilled. Number 2, the contract is terminated. That is also not fulfilled. So you will show that 1 lakh as a liability, as a deposit liability. Okay, moving ahead, contract term. What do you mean by the word contract term? Contract term refers to the contractual period over which the parties have a present enforceable right and obligation. It's a contractual period over which the parties have a present enforceable rights and obligation. If the contract can be cancelled, if the whole contract can be cancelled, it's unperformed. Any of the parties have not performed and without paying penalty, they can cancel it, then there is no contract only. If either party or only customer has a right to terminate, so we need to check out in that, should I consider the contract term as 10 years? Should I consider the contract term as lesser? तो वहाँ पे check करना पड़ेगा. ठीक है. But a wholly unperformed contract, if it can be cancelled without payment of penalty, then there is no contract only. Now, combining contract. When should I combine 2 or more contract, account them together? So they are telling 2 or more contract may be accounted as a single contract if they are entered at or near the same time. They are entered at or near the same time and any of these 3 condition is fulfilled. So they should be entered at or near the same time. Any of these 3 criteria. 1, they are negotiated as a package. Consideration of one depends on consideration of other, and they are a part of a single performance obligation. Then you can combine. So 1, they are entered at or near the same time, and any of the following criteria are fulfilled. Plus, it should be with the same customer. I cannot combine contract with different customers. Coming to contract modification. Sometimes the contract is modified, the price is changed, tenure is changed, many different things happen. Now, how do I account for a contract modification? So they're telling if there is a increase in scope, by adding new goods or services which are distinct. So earlier I had to give 100 units, now they say no, you give me 150. So there's an increase in scope, and what I'm charging is the standalone price for it. whatever is increase happening, uske liye I am charging is a standalone price only. Treat it as a separate contract altogether. Treat it as a separate contract altogether. But if it does not constitute a separate contract, okay, when should I treat it as a separate contract? There's an increase in scope by adding new goods or services to be provided, and that basically what I'm charging is a standalone price for it. Okay. Now, if it does not constitute a separate contract, how do I account? So first, then I have to check. Then I have to check what? One. Account for modification prospectively so long as the remaining goods and services to be provided are distinct. Acha, if remaining goods and services to be provided are kind of distinct, then you account it prospectively. Ho gaya so ho gaya, now onwards it will be changed. But if remaining goods and services to be provided are not distinct, then we follow a cumulative catch-up method. Okay, so till now I should have booked this much. I've already booked only this much. The cumulative catch-up adjustment comes. Okay, the remaining goods and services to be provided are distinct. Prospectively accounting changes. Don't do anything. What has happened, it's fine. Now onwards, record this. But if remaining goods and services to be given are not distinct, cumulative catch-up. Sir, example, let's check. Question number 8 में I'm giving some maintenance services. After certain period, the maintenance services का price is changed. Okay, now can I say maintenance service given in first month, second month, third month, fourth month over, fifth month say whatever I have to give, it's a distinct thing. तो वहाँ पे I follow prospectively. Now onwards record instead of 45, 55,000 per month. ठीक है. So cumulative catch up. Okay, the checkout over here. I had to do some repairing work for you, or I had to do some interior services for you. Approximately earlier we thought 200 hours will be required and 150 per hour was charged. ठीक है. After 100 hours, तो 100 hours खत्म हो गए. I have charged you basically 150 per hour. Now we feel there is an increase in labor hours by 50 more hours. Okay, the service is same, interior service is same. Interior service is same, but now 50 hours more will be required, and uske liye I'm charging 100 rupee. Okay, so I'm not charging SSP for the additional thing. For additional hours, if I charge the SSP, it's a separate contract altogether. But here I'm not charging, so now I have to follow cumulative catch-up. So see, average rate will turn out to be 140 per hour. Average rate will turn out to be 140 per hour, cumulative catch-up. For 100 hours completed, I should have booked into 140, but I already booked into 150. Okay, 100 hours into 10,000 rupee reversal will come up. That is a cumulative catch-up. Okay, the remaining goods and services to be provided are distinct, accounted prospectively. Remaining goods and services to be provided are not distinct, cumulative catch-up. Okay, step 1 over, going to step 2. 5-step model tha. Achha, step number 2 is identifying the performance obligation. Okay, step 1, you identify a contract with customer. Now you identify under that contract how many performance obligations of yours are there. Performance obligation kya hai? The promise of yours. The performance obligation is a promise in a contract to transfer goods or services to customer which are either distinct or a series of distinct goods and services which are substantially same. So what is my promise under the contract to provide the distinct goods and services? Many times I enter into a contract where I'll give you goods, I'm selling a car, plus I'll also give maintenance services later on. So there are two things, selling a car, one thing, giving maintenance service, another thing. Okay. Now this is very important to understand how many performance obligations are there. Reason, as and when performance obligation is satisfied, we record revenue. Fine. And promises can be either explicit or implicit. Okay. Now, how do I identify this performance obligation as distinct performance obligation? Important. How do I identify this performance obligation is distinct performance obligation? A goods or services that is promised to a customer is distinct. Kab? If both the criterias are met. I say it is distinct kab? When both the criterias are met, customer can benefit from it either on its own or together with resources already available with him. And the promise can be identified separately from other promises in the contract. The customer should be able to get benefit either on its own or together with other resources available with customer, and this can be separately identifiable from the other promises in your contract. Acha, so I can try to understand there should not be any significant integration with other things. There should not be significant modification, customization. It should not be highly dependent on other things. So I say it is a distinct thing. It's a distinct thing. Okay, I'm selling you software. Okay, one, I'm selling software, and also I'm doing some modification. So software selling one thing, giving modification service another thing. It can be two separate performance obligation. But if software cannot work without modification, if software cannot work without modification, now they're interdependent. Then it's only a single performance obligation. ठीक है. Moving ahead. I'm taking only the important questions. Question number 16. Anywhere you're stuck up, stop me at the same time. Okay, question number 16. A software developer enters into a contract to transfer a software license, plus will perform installation services, plus will give some software updates, and will also give technical support. Four things. I'll sell you software, I'll do installation, I'll also give some updates later on over a period, and I'll also give some technical support. If you have a query, I'll give technical support over a period of 2 years. Acha, you sell license, installation, technical support as such separately as well. And installation is routine, can be performed by other entities also. So how many performance obligations are there? Four. Very understandable, simple one. But if you see next one, suppose they're telling the software is to be substantially customized. Software is to be substantially customized so that it's able to interface with your other application. So when I say software will not work unless you do the customization. So now over here, can I say that software with that customization is basically a part of one thing? So now integrating software into existing software will require a customized installation. The software with a customized installation, they are highly interdependent. It will be treated as a single performance obligation. Now, providing technical updates and technical support, providing updates and support will be separate performance obligation. So now there are three things. 1, 2, 3. Okay, question number 18. Question number 18. Telecom company T, you enter into a 2-year license for providing internet services, and they also buy a modem and a router from you. So see, there are three things. One, I have to sell modem to you, I have to sell router to you, and one, I have to provide you internet services. 3 performance obligation. Next, okay, non-refundable upfront fees. Non-refundable upfront fees. Okay, imagine for Netflix subscription, I'm paying on a yearly basis. Imagine for a Netflix subscription, Amazon Prime, simple. So Amazon Prime yearly, I'm paying say 1500 rupees. Now that they are charging me, can I say it's a non-refundable with they charge me in advance, but they have to give me services for the whole year. So generally what happens is the advance consideration what they've taken is actually for the services they have to provide for the whole year. So can I say that should be split as revenue over the period? In most cases, the upfront fee is an advance payment for future goods or services. They should be booked as revenue as and when that services are provided. But sometimes they charge some upfront fee, which is kind of for admin work. I gave you an example. I joined a tennis academy, and the tennis academy people, they charge me 500 rupee upfront as registration charges. Or same way, you take a SIM card, first time that SIM card ke liye they charge you 100 rupee. 100 rupee, and then later on whatever plans you are taking, based on that you get services. So now when I joined the tennis academy, they charge me 500 rupee just for admin purpose, registration fees, they'll add me in a WhatsApp group, they'll maintain my records, all that things. Later on monthly fees is different. So then that admin fees ke liye, are they required to give any goods or services in future? No. So they can record it immediately as revenue. Fine, now going to step number 3. The step number 1, identify contract with customer. Step 2, identify your performance obligation under the contract. Now step 3, determine the total transaction price. Okay, the transaction price is the amount of consideration which entity expects to be entitled for transferring the promised goods or services under the basically to the customer, excluding the amount collected on behalf of third party. Okay, you are going to pay me total, say for example 10 lakh, it includes GST. GST I have to give it to government, so I'll book a revenue net of GST. The amount of consideration which entity expects to be entitled, that is basically important. Now, your transaction price can include fixed amounts, variable amount, or both. Acha, if it's a variable one, what should I do? If you complete within 30 days, 10 lakh. If you complete between 31 to 60 days, it will be 9.5 lakh. And if you complete after 60 days, it will be 9 lakh. So can I say here my transaction price is varying? Okay, so what should I take basically as the transaction price? Should I take 10 lakh? Should I take 9.5 lakh? Should I take 9 lakh? You need to determine what you expect. So if the consideration promised includes a variable amount, the entity shall estimate the amount to which it will be entitled. ठीक है. And how do I estimate the variable consideration? Two options. One is the expected value method, second is the most likely method. Expected value method is used when there are more than one outcome. There are range of possible outcome, then expected value, multiply each of the outcome with the probability. Achha, most likely should be used only when there are two outcome. Only when there are two outcome. Okay. If you basically get a 5-star rating, 10 lakh. If you don't get a 5-star rating, 8 lakh. So it's basically only two outcomes are there. In two outcomes, basically you can go for most likely. ठीक है, check question number 22. AST Limited enters into a contract with customer to build a manufacturing facility. The construction is scheduled to be completed by 36 months and the price is 25 crore. But if you finish early, you get bonus. If you finish early, you get bonus. So can I say it can be more than 25 also? Now how much bonus? 15% bonus if you complete by 30th month only. 10% bonus if you complete by 32nd month. 5% bonus if you complete by 34th month. Now see three options. Either my bonus can be 25 into 15%, 3.75 crore or 2.5 crore, or it can be 1.25 crore. Depending on when I complete, three options available and probabilities are also given. Go for expected value method. ठीक है. Second is there's a quality bonus. Quality bonus 2 crores I'll get if you get a 5-star rating from health department. The safety department gives you 5-star rating, extra 2 crore. So can I say यहाँ पे either 2 crore or 0? So only two outcome are there. Here you can use is most likely. तो ऊपर वाले में expected value, second वाले में most likely. तो total revenue 25 था. Based on expected value 2.125 and based on most likely extra 2 crore वो quality bonus, total transaction price is 29.125. Fine. Now, this line written, constraining estimates of variable consideration, very important. See, whenever you are booking some variable consideration, like last question only, the bonuses you are including 2.125 and another 2 crore, you should include only when it's highly probable that reversal will not be coming. The entity shall include in the transaction price some or all of the amount of variable consideration. When I should include 2.125 and extra 2 crore, only when it's highly probable. Highly probable is not greater than 50. Probable is greater than 50. Highly probable is greater than 90. That significant reversal will not be coming. ऐसा नहीं होना चाहिए later on that conditions were not fulfilled and then we received less. So it should be highly probable that significant reversal will not be coming. If you feel reversal may come in, don't include them in revenue right now. Include them in revenue only when it's highly probable that significant reversal will not come. Fine, moving ahead. Okay, check question number 25. Check question number 25. A fixed fee is 1 million and your cost is 950. The fee आपका 1 million है, the cost will come 950, you'll make a profit of 50,000. And you use cost to cost basis to measure the progress, cost incurred till date divided by total estimated cost. Now there's an incentive. Oh, what is the incentive? Weight of the product. The lighter the product you are making, they are giving you bonus. 951 grams or greater, तो कुछ नहीं है. 701 grams to 950, 10% bonus, so 10 lakh ka 10% is 1 lakh. And 700 grams or less, it's 25%, so you get 250. So either you get 250 or you get 10 lakh or you get 0. Three options are there. Now, entity determined, it has a 95% confidence that it will achieve 10%. ये यहाँ पे तो आप पहुँच जाओगे. And 20% confidence that you will get this 25%. तो यहाँ पे only 20% confidence is there. तो can I say यहाँ पे significant reversal के chances are there. So better is to take this. So you would have taken 1 lakh. You would have taken 1 lakh in your transaction price. The entity believes 10 lakh to be the most likely amount and you included 10 lakh. And you feel the significant reversal will not occur. For 10 lakh, you feel significant reversal will not occur. So can I say I booked 10 lakh as, I've included 10 lakh in my transaction price. Okay. Now at the end of year 4, it becomes apparent that now you will be getting that 25% extra. So now 4th year mein aaye na, ab aapko lag raha hai 10 nahi, you will get 25 only. And now it's highly probable I'll get 25. So now you can book, now you can change your transaction price based on this. Now see, the contract is still the same. Goods and services are not yet given or distinct nahi hai aisa kuch. So I have to do a cumulative catch up. Cumulative catch up. Did you understood? Okay, now what is the cost incurred in first, second, third year? First, second, third year, this much cost incurred, 50 plus 175 plus 400 out of 950. So I can understand 65.78% the work is done, and I would have booked a revenue 11 lakh ka 65.78%. I would have booked a revenue 723,580. I would have booked the revenue 723,580 in first 3 years, 65.78%. But now I realized I should have booked not based on 11 lakh, I should have based on 1250. तो एक काम करो, extra 150 का 65.78% is left out. Extra 150. We took transaction price as 11, it should have been taken 1250. The extra 150, uska 65.78% work is done. The cumulative catch up is coming as 98670. Check karo ye raha. 4th year I'll directly book based on contract price 1250 only. But first 3 years mein I had booked it based on a contract price of what? 11 lakh. It should have been based on 1250. The 150 reh gaya into 65.78% already completed. Cumulative catch up. Did you understood this question? Did you understood this question? Okay, next, price concession. Price concession. See, simple. Variable consideration is there. I need to basically have a transaction price which I expect to be entitled. Okay. Moving ahead. Now see, there is this question number 27. You offer various concession based on volume, and variable consideration entity estimates its amount based on past experience. Now see, COVID aa gaya, I cannot use my past experience for determining volume. I need to do it in some other way. Because of COVID, now I cannot basically use past experience because now volumes will change drastically. Acha, cash payment. Acha, someone pays me early. If someone pays me early, I'll give them some discount. So you pay me within 30 days. Instead of 100, you pay me only 98. So should I take a transaction price 100 or 98? You need to take what you expect to be entitled. Fine. Acha, volume discount. This is good. Okay, if in a year your total quantity exceeds 1 lakh, if in a year your total quantity exceeds 1 lakh, you get discount. Now, 2 ways. One is prospectively. If your total quantity exceeds 1 lakh, so from 1 lakh first unit, I'll give you a discount. Second is retrospectively. So from unit number 1 only, instead of 10 rupee, I'll make 9 for you. If it is prospectively, what to do? If it is retrospectively, what to do? Okay, if it is prospectively, it's kind of, I'm selling you goods right now, and I'm selling you a right to buy the goods at discounted price in future. Acha, if it's prospectively, I'm giving you goods right now, plus 1 lakh first unit ke baad discount hoga. The right to buy goods in future at a discounted rate, that will be treated as a separate performance obligation. The revenues will be bifurcated between the current goods sold and the right which I am selling you to buy goods at a lower rate in future. But if it's retrospectively, if your basically yearly unit crosses 1 lakh, from the first unit only, instead of 10, it will be 9. I'll give you a refund. I'll give you a refund of 1 rupee for all 1 lakh units. So now in that case, day 1, okay, day 1 you bought only 10,000 unit. Yearly 1 lakh cross hoga, you try to estimate. If you estimate yearly 1 lakh will get crossed, don't record revenue of 10 right now. Even though you got 10, You record revenue of 9 only, extra 1 rupee, show it as a liability in your book. I hope this is clear. Check this question number 29, very important. Okay, 1st January 8, price per container will be adjusted retrospectively. Okay. And the price will be 100 if it is basically up to 10 lakh containers, 90 if it is 10 lakh to 30 lakhs, and 85 if it is more than 30 lakhs. We estimate it will be 2.8 million, 28 lakh. So we estimate it will be 90. We estimate it will be 90. Now today you bought only 7 lakh containers. So it's today you will be paying me full 100. But I am expecting yearly you will meet a target, and now I'll be getting is only 90. I'll have to refund. To do one thing, day one only, don't record revenue 100 even though you got 100. Book a revenue of 90 only, extra 10 will be shown as liability. The bank debit is 7 lakh into 100, revenue is 7 lakh into 90, and extra 10 is shown as liability. Moving ahead, refund liability, same what we discussed, refund liability, same what we discussed. So contract to sell goods to retailer for 1,000, there's a price protection given to him. And based on price protection, I feel 5% discount I'll be required, 5% refund I'll be required to give. So don't book revenue 1,000, book a revenue 950 only, extra 50 show it as a liability. The bank debit 1,000 to revenue 950 to refund liability is 50. Now, sale with a right of return. Sale with a right of return. Now, whenever I'm selling goods to customer, they can return me within certain days. To do one thing, very simple. If I know on an average 30% return comes, so I sold 100 rupee ka, but I know 30% return will come. So don't book sales for that. I know that's going to come as a return, to show it as a liability in your book, extra 30 rupees. And you can show it as stock with customer later on. तो उसके साथ stock भी बता सकते हो. तो see, bank debit you got 100. To sales not expected to be returned is what, 70. Acha, to refund liability expected to be returned is 30 rupees. So that way you do it. And ये 30 जो है ना उसका cost. It's your stock lying with your customer, show it as stock with customer. And when I show it as stock with customer, my COGS goes down. Okay, and whatever refund liability you recorded, you need to remeasure it. Okay, now just pay attention. Out of 100 rupee goods sold, I'm expecting 30 will come back. Out of 100 rupee goods sold, I'm expecting 30 will come back. But 30 आप वापस दे दोगे, but whenever you give back na, I charge a restocking fee. So imagine I'll charge the restocking fee of 3 rupee. Okay, you'll return me goods of 30, but see, I have to basically handle all the deliveries. तो पहले मैंने आपको free delivery दी, then again I have to send a guy to take it. So I'm charging a restocking fee of 10% of refund amount. तो refund आएगा आपका 30 rupees, 30 का 10% 3 rupees. So now can I say indirectly, I don't have to refund 30, I have to refund only 27. So have a liability not of 30, have a liability of 27. And 73 will be booked as revenue. 73 will be booked as revenue. Fine. Now check. Total 1,000 contract. Contract includes sale of one product for 50 rupees. Customer allowed to return within how many days? 30 days. And cost is 30 rupees each. And we expect 970 will not be returned. Okay, the 1,000 into 50, don't book revenue. Don't book revenue 1,000 into 50. You book a revenue of 970 into 50. So check out, revenue is 970 into 50. 30 units refund करना पड़ सकता है. 30 into 50 will be your liability. And one more thing, this 30 units, I can show it as stock with customer. They will be shown at my cost. 30 into 30, 900 will be your stock with customer. Next one is penalties. Now see, penalties are accounted as per the substance of the contract. Like if at all you are delivering late, तो आपको penalty लग रहा है, that is in form of a variable consideration. If you finished early, bonus था. If you finished late, penalty है. So that is in form of a variable consideration. So sometimes they are accounted as a variable consideration. But because of your product, there is a harm to customer. Because of your product, उनको allergy हो गई or harm to customer is there, that will be accounted as per IND AS 37. You create a provision for it. So you account it based on the substance. Did you understood? There's a carve out over here. IFRS 15, all types of penalty are considered as kind of a variable consideration. Here we account based on the substance of contract. Now warranty. Now see, warranty are of two types. One, it's an assurance. Kuch nahi hoga, don't worry. It's an assurance. And second, I know whenever I give warranty, some products come back and I have to repair and give it. Some services have to be given. तो एक ऐसा है, just a kind of assurance to you. I know products are not going to come back. My products are really very good. If it is just in nature of assurance, it doesn't fall here. You may do a minor provision as per IND AS 37. If it's in nature of assurance, but I'm pakka sure some of the goods will come back. I have to give services. So can I say what I'm charging today is for the goods which I'm giving you plus the service which I have to give later on. So now it's a separate performance obligation. So now whatever money I got, I'll be splitting it between the goods which I'm giving right now and the services which I have to give in future. If warranty is just an assurance that product will perform as per the specification, it's not a performance obligation. However, you may do a small provision as per IND AS 37 if by chance some product came. But if warranty is in nature of a service, I know वापस आने ही वाला है, then in that case it's treated as a separate performance obligation. Transaction price will be bifurcated. And one thing, if warranty is sold separately, it's always treated as a separate performance obligation. If warranty is sold separately, it's treated as a separate performance obligation. Okay, check this question number 33. You sell computer that include assurance type warranty for first 90 days. The first 90 days, I know nothing is going to happen. So generally कुछ वापस नहीं आने वाला. So then it is not a separate performance obligation. I may do a small provision as per IND AS 37 for it. But you also give an extended coverage for another 3 years. Usme I know it will come, I have to repair. So the extended warranty given for 3 years, it's a separate performance obligation. So today I'm selling you laptop, plus I have to give you services over the next 3 years after 90 days are over. The first 90 days ke liye, it's not a separate performance obligation. Next 3 years ka service which I have to give, it's a separate performance obligation. I charged a combined from you total. The total transaction price is 36,000. I charge a combined 36,000 divided between how much is for the computer and how much is for that warranty services which I have to give in future based on their respective SSP. The respective SSPs are 34, 32 and 4 they have given. 32 and 4 they've already given, do it that way. So cash debit 36, but today you record a revenue only 32. Extra 4 is for the services to be given in future, it will come as liability today. And for that first 90 days, the provision required is 2,000 as per your IND AS 37, that you book it separately. Warranty expense to provision for warranty. Warranty expense to provision for warranty. I hope this is clear. Okay. Question 34 is similar. I'm not doing it. Question number 35, we have already done it under IND AS 37. Question number 35, it's already done under IND AS 37, but still I basically take it. Manufacturer gives warranty to make good, they will repair or replace it, TK, which is coming up within 3 years. And 30th April, a manufacturing defect was detected. 30th April, a manufacturing defect was detected related to the goods manufactured during 1st March to 30th April. Okay, if these defective goods are already sold, now see, they are already sold. मुझे मालूम था defect है. See, I got to know today, but can I say defect was already there on 31st March? If defect was already there on 31st March, I get to know about it today. It's an adjusting event to create a provision for expected repair costs which will come. Achha, if it's lying in inventory, you value them at cost or NRV, whichever is lower. Achha, to treat them as a WIP which requires some repair. And defective goods manufactured in April, ये April में manufacture हुआ. See, to 31st March, these goods were not there only. If they're manufactured in April, that cost will come in April only. So can I say next year में? तो goods already sold, वो March में बनाए, we sold also. So defect was there at 31st March, it's adjusting event. Those which are in stock, value it at cost or NRV, which is lower. Treat it as kind of a WIP wherein your inventory needs some rectification. The cost to complete में it will be taken up. And those which are manufactured in April only, April में manufacture हुए, that goods का repair cost will come next year only, not coming in this year. Fine, moving ahead. Sales based or usage based royalty. Now see, I'm getting a royalty income. So I've given my copyright or I've given my patent to someone. They manufacture, they sell the goods. Uske upar royalty. So I'm getting a royalty income based on sales. So when should I book the income? One, whenever sales happen. Sales hoga, so I'll get royalty. So whenever sales happen, and I should have performed my performance obligation. Two things. So one, whenever sale happens, and I should have performed my performance obligation. For example, I had to attend some 3 seminars. If I have not attended that, even though sale has happened, I have not done my performance obligation, then I cannot record revenue. So both should be there. So isliye later of this too. Now significant financing component. Now see what happens. Sometimes customer pays you very late. Normal credit period is 1 month, but to this customer I've given you 1 year time. So can I say he'll pay me extra towards interest? The revenue cannot be recorded as full amount. The revenue will be the cash price equivalent. Extra what you have received will be recorded as an interest income over the period. So see, in determining transaction price, you adjust the promised consideration. This is paying me total 110, but 10 is towards interest. The 100 will be revenue, 10 will be interest income. You adjust the promised consideration for the effect of time value of money if the timing or the payment agreed by party provides the customer with the significant benefits of financing. The revenue is cash selling price, but you will not treat it as having a significant financing component when customer has paid for goods and services in advance. Now see, whenever customer pays in advance and I have to give goods after 2 years, so he paid me today and I have to give goods after 2 years, so what happens? If customer pays me late, I assume interest aayega. If customer pays me early, it's a kind of loan taken from him, I have to give him interest. So 100 tha, with interest became 110, then it became 121, and now instead of 121 cash, I give him the goods. So now 121 will be the revenue. So advance mila, you have an interest expense. Delay they are doing, they will pay late, it's an interest income. Both. But when I should not treat it as having a significant financing component, they have paid in advance and goods are ready. They can come and collect anytime. They come and collect after 2 years, it's their problem. I have kept it ready. Second, the difference. The substantial amount of consideration promised is kind of variable. So consideration जो है वो kind of variable है, तो उसमें fix नहीं हो रहा है. Then in that case, I cannot say there's a financing arrangement. And third, it's for reason other than finance. Sometimes they hold your 10% payment. And they say, I'll give you the remaining 10% after 2 years if machine works properly. The purpose is not to delay payment. Purpose is to see the machine is working properly or not. And there's a practical expedient given if that period you basically sell, they pay money, or you got money and you deliver goods. If the period is less than 12 months, you may ignore this financing wala thing. Okay, so if advance is received, it will be interest expense. If the payment is deferred, it's an interest income. See, if customer pays in advance, goods are to be delivered later, we treat it as loan taken from customer. If customer pays late, goods are already delivered, we treat it as loan given to customer. Okay, moving ahead. अच्छा, now इसके लिए we need to take the rate. इसके लिए rate कौन सा लेना चाहिए? Rate what would have been there if I had given a loan to customer, I would have taken a loan from customer in a separate financing arrangement. The separate financing arrangement में what will be the rate for taking a loan from customer or giving a loan to that customer? Okay, the check question number 38, a good one. The contract price states for a price is 1 crore plus some 10% interest. Okay, so customer will be paying not just 1 crore plus some 10% interest, and he will pay over 60 installments. 60 installment, so I'm charging 10% interest. Okay, ठीक है, 10% interest I'm charging. Now, if the contractual discount rate reflects a separate financing transaction rate, see we are charging 10. If separate financing rate will also be 10. अगर separate financing rate will also be 10, तो आप उसका present value find करो, it will come as 1 crore only, record sales at 1 crore, extra interest होगा. But suppose separate financing rate is 12% or 14%. Now he is paying me only 10, but actually financing rate should have been 14. If I discount by 14%, whatever I'm going to get, if I discount by 14%, then in that case the present value will be coming less than 1 crore. Record revenue at that less than 1 crore. Actually question should have given you that amount. They have not given, so यहाँ पे 9131 will be the revenue to be booked. Interest will accrue 14%. We are getting 10%. Voila. Fine. Okay, question number 39. I gave two options to customer to pay 5,000 in 2 years. Whenever I give you the asset, to see, I'll give you the control in 2 years. I'll be giving you the goods or services when after 2 years. So you pay me that time only. So you can pay at the time of delivery 5,000. Acha, so in that case, I'll book 5,000 revenue. Or else you pay me in advance. Acha, if you're paying me in advance, it's 4,000 you're paying. 2 years pehle you give me. Acha, if you give me 2 years in advance, it's treated as a loan taken. On 4,000, interest will accrue. Separate financing component wala rate lena hai 11.8. No, 11 point is implicit rate in the transaction. 11 point is implicit rate in the transaction. Don't take 11.8. Separate financing. Separate financing. The entity determines the rate that should have been used in adjusting the promised consideration is 6%. Okay, the 4,000 plus 6% first year interest, again plus 6%. So total 4494. So record a revenue 4494. Day 1, you got 4,000, it's liability because I'm giving goods after 2 years. The revenue will after 2 years. अब इसके ऊपर interest accrues. Second year also interest accrues. Now record a revenue not 5,000, 449. ठीक है. Next one is fine, not difficult. Moving ahead. COVID impacts now are not relevant. So next point is non-cash consideration. Next point, non-cash consideration. Okay. If at all I'm receiving a non-cash consideration, okay, I gave goods or services, they're not giving me cash. They're giving me PPE, they're giving me shares or some other assets. So then in that case, the transaction price will be the fair value of non-cash consideration. The transaction price is not the fair value of goods which you are giving. The transaction price is the fair value of consideration which you are getting. Clear? Acha. Now imagine they are going to give me PPE. The transaction price, the revenue should be recorded the fair value of PPE coming in. That way. ठीक है. Now if you are not able to determine it, then the transaction price will be the SSP of the goods or services provided. Now sometimes the fair value of non-cash consideration varies. Okay, they are going to give you shares. They are going to give you shares of Reliance Industries Limited. Now see, share price of Reliance Industries Limited keeps on changing every day. Share price of Reliance Industries Limited keeps on changing every day. So now what should I do? I should book revenue based on the share price of Reliance whenever I'm giving goods or services. Okay, if the fair value of non-cash consideration varies after contract inception because of its form, you do not adjust the transaction price for any changes in the fair value. But if the fair value changes other than form, achha, if you finish early, I'll give you not 100 shares of Reliance, I'll give you 120 shares. So now it's not due to share price, it's due to other than form. So then it's treated as a part of variable consideration. If we finish early, we'll not get 100, we'll get 120 share. So then in that case, transaction price, should I take 100 shares into Reliance ka price? Or should I take 120 shares into Reliance ka price? It's a variable consideration, what you expect to be entitled. And Reliance ke share ka price, I need to take it off the date when we entered into contract inception ka. Fine. Okay, if customer contributes goods or services, acha, so if customer is contributing goods and services and I get a control over that goods or services, then in that case, it's like a non-cash consideration received. Chalega. Okay, question number 49. Question number 49. Okay, they will pay you 350 crore plus you'll get a bonus 10 lakh shares. You'll get a bonus 10 lakh share if you complete it within 1 year. Acha, so whether we'll get 10 lakh shares or not, malum nahi. It's a variable consideration. What you expect to be entitled, that you need to see. Acha, if you expect that you'll be getting that bonus, so your transaction price is 350 crore plus 10 lakh shares which are of worth 100 each. 10 lakh shares which are worth 100 each, it's 1000 bija extra. So this comes as 360. 350 becoming 360. 10 lakh into 100. It's basically 1000 lakhs. 1000 lakhs is nothing but 10 crores. Okay, next one is consideration payable to customer. Oh, we pay to customer. Sometimes we give cashbacks. Okay, sometimes we give them some discount vouchers. Sometimes we give them some loyalty points. So that's consideration payable to customer. Now, whenever I pay to customer, if it is for distinct goods or services, I'm paying to them. Would I be getting any goods or services? I'm paying to them. Would I be getting any goods or services? If it is for goods or services, it will be accounted separately. You bought goods, you paid money. But if I'm not going to get any goods or services, then that will be adjusted from my transaction price. Okay, so if it is in exchange for goods or services, account it separately. If it is not in exchange of goods or services, it will reduce the transaction price. ठीक है, slotting fee. Slotting fee, I give it many times. I'm a manufacturer and a retailer is there. The retailer ko I say you basically like retailer DMart. I'm a manufacturer of goods, DMart is a retailer. I tell DMart to basically put my product on shelf like this. Now, slotting fee is not giving me any goods or services. In that case, it should be reduced from transaction price. But whenever we have a cooperative advertisement, the DMart advertises for my product, the cost is borne equally, but my advertising also happens. I'm getting some goods or services. So whatever I pay for that will be accounted separately. But whatever I pay for that cannot exceed the fair value of goods or services received. If it exceeds the fair value of goods or services received, the extra amount will be deducted from the transaction price. Okay, moving ahead. Okay, question number 55. We sell electric razors 50 per unit and we give a rebate coupon and customers can redeem it for rupee 10 and we feel 25% people will redeem it. So 10 ka 25%. Can I say 2.5 refund liability will come up? So 2.5 I'll have to pay to customer. So indirectly you don't record revenue. And see 2.5 you're paying to customer, you are not getting any goods or services. So it should be deducted from your transaction price. Transaction price will not be 50, it will be 47.5. Now going to your step 4. So step 1, identify the contract with customer. Step 2, what are your performance obligation in the contract? Step 3, determine the total transaction price. Now total transaction price you allocate between the various performance obligation. So step 4, allocate your transaction price between various performance obligations. Sir, how do I do it? So you need to try to see for each and every performance obligation what you expect to entitle. That way it should have been done. And it is based on respective standalone selling prices. If you sell them separately, what rate you would have sold them, that you need to check. अच्छा, तो discount भी apportion हो गया सब में. Indirectly, if suppose bundle is given, product A, B, C, individually I sell at 40, 40, 40, but this combinedly I sold at 100 rupee. So 100 rupees split between 3 in proportion to SSP 40, 40, 40, 1:1:1. So everyone will be 33.33, 33.33. The discount also everybody is bearing. But sometimes discount has to be borne not by everyone. When the entity I'll come to that point, allocation of discount. The entity shall allocate discount entirely to one or more, but not all. When I should not allocate to all? When all the following conditions are fulfilled. You regularly sell each distinct goods and services on SSP. ठीक है. You also sell few of them at a discount. Like as such, the price of A, B, C, all three together is 40, 40. The total is 40, 40, 40. A and B together I sell them at 70. A and B together I sell at 70, and now A, B, C I sold together at 110. So see, A and B I sell them at 70 means 10 rupee discount in A and B. 10 rupee discount in A and B. And now A plus B plus C I'm selling at 110. So still there's 10 rupee discount only. So that 10 rupee discount is only related to A and B. Nothing is there for C. So C should not bear any discount. Discount should be borne only by A and B. Acha, plus how to find out SSP? If your prices of each individual product available take that, आपका नहीं है, तो you try to have market assessment approach. That is, you try to see competitor के prices for similar goods or services, or you can do cost plus margin approach, or you can do residual. Okay, I know pricing of A and B, remaining is for C, but remaining for C, residual approach you should use only when वो जो कोर प्रिंसिपल है ना, व्हाट यू एक्सपेक्ट टू बी एंटाइटल्ड फॉर दैट आइटम, वो मैच होना चाहिए. ओके, चेक क्वेश्चन 57. You sold a bike with 2-year extended warranty. So two things are there. Bike I'm selling plus next 2 years ka extended warranty where I have to give you services. So I have to divide the total revenue between both based on SSP. Okay, the total price pay I sold 87,500 pe. 87,500 and individually the price is 80 and 10. So divide 87,500 in the ratio 8:1. So 80 by 90, 10 by 90. ठीक है. Okay, next question over here. You are selling XYZ individually. Acha. And Y and Z together you give at 50. So can I say Y and Z was 70, I give at 50. The 20,000 discount in Y and Z I give normally. Acha, XYZ together was 120, I sold at 1 lakh. If someone is buying only YZ, 20 discount. If someone is buying XYZ, still 20 discount. So can I say there's no discount in X? There's no discount in X. So allocate discount only to Y and Z. Now suppose together with XYZ, you're also selling a product Alpha. आप Alpha बेच रहे हो. Now total is 130. So I understood basically total XYZ के लिए 1 lakh था. तो can I say XYZ is 1 lakh, उसमें divide हो गया, Alpha is remaining 30. And they've given Alpha का range is 15 to 45. हाँ, you can use residual approach for Alpha. But here, if alpha ka range, if they're telling that alpha ka range is not basically within 15 to 45, alpha ka range has to be more, then in that case you should not go. Like for example, transaction price is 105. So 1 lakh is between XYZ. So 5,000 aa gaya alpha. Now alpha cannot be 5, it has to be between 15 to 45. I told you what you expect to be entitled for that item. The residual approach here will not be proper in the third case. Next, customer option for additional goods or services. Customer option for additional goods or services. So together basically with the goods I'm selling, I'm giving them some loyalty points or I'm giving some discount coupon. So can I say I'm giving a right to buy goods in future at a lower rate? Now if that right is material, like they will get discounts, other will not get. तो वो material है. So if that right is material, so indirectly I'm selling goods today. Pay attention. Indirectly I'm selling goods today. Plus I'm selling a right to buy goods in future at a discounted rate. I'm doing two things today. So whatever I'm getting today is to be divided between both. Whatever I'm getting today is to be divided between both. So in effect, we have collected advance for some future period also. So check question number 20. There are 20 resorts which basically a company is having. Customer gets points whenever they stay at resort. 1 point for rupee 100. 1 point for rupee 100. And the likelihood of exercise is 100%. So people will use only. ठीक है. So and the standalone price of each point is rupees 5. अच्छा. So can I say if you spend 100 rupee, you get 1 point and 1 point is worth 5 rupee, which you can use later. So the thing is, I am basically selling you goods of 100 and points worth 5 rupee, but I am not charging 105 from you. I am charging only 100 from you. So the thing is 100 rupee is for the goods as well as right to basically get discount in future. Points worth 5 rupee. So 100 rupee goods के लिए plus points के लिए together. So divide this 100 rupee in the SSP ratio, in the ratio of 100:5. In the ratio of 100:5. So check out now your sales. 10,000 into 100 divided by 5. 10,000 into 100 divided by 105. So it will become 9523. Yeah, 9524. And remaining you book it as a liability, which basically will get converted into revenue whenever they'll use that points in future. ठीक है. Okay, question number 61. Again, you buy for 1,000 rupee, I'm giving you a discount voucher. And the discount voucher ka worth is 120 based on exercise kitna hoga and all that thing. So see, goods of rupees 1,000, discount voucher worth 120, but together I'm charging not 1120, I'm charging only 1,000. So 1,000 split it between both in the ratio of 1,000 split it between both in the ratio of 1,000 is to 120. So 1000 rupee के goods है, discount voucher is this, but I am charging only 1000, total transaction price allocated between both in their SSP. Now question number 62. In short, total revenue which you are getting today is to be bifurcated, how much for goods and how much is for the points. वो bifurcate करना है based on SSP. Now in this question, customer loyalty points are given, they can redeem in future. In one period I granted how many points? 10,000, and each point is worth 125, but we expect only 8,000 will be redeemed. If I expect only 8,000 will be redeemed, the value of the point is 8,000 into 125. The value of the point is 10 lakh. Now value of point is 10 lakh. What is the value of goods not given? And what did I charge total not given? Actually total amount is to be split between goods and points in SSP. वो दिया नहीं है, तो assume SSPs, assume the value allocated to point is this 10 lakh only, 8,000 into 125. Otherwise what happens is, this is basically the SSP of points. ये SSP of points आया, same way SSP of goods and total I charge divided in the respective SSP. That data is not there. The SSP of point assume is the revenue allocated to points. The revenue allocated to point is 10 lakh. Okay, for the points, 10 lakh rupees are there. I am not booking revenue right now for that. It was basically shown as liability. Whenever they'll use point, it gets converted into revenue. Achha, if they use point, it will get converted into revenue. If they don't use point, it will get lapsed. Still, it will get converted into revenue. Then I don't have to give the goods. I got the money already. So when they'll use point, it will get converted into revenue. If they don't use point, still it will get converted into revenue. Now don't think this is for 8,000 point. Actual exercise might be 9,000, 7,000, doesn't matter. Total revenue attributable to point is 10 lakh. यहाँ पे जैसे total revenue allocated to discount voucher was coming 110, ये same रहेगा. Whether discount voucher used later, not used later, 110 will go in revenue later. That's it. Okay, so currently 10 lakh rupees is allocated for the points. We expect 8,000, half are already used. So can I say half I should transfer from 8 lakh to the revenue? And half of 10 lakh will still remain as liability. Now we expect total 9,000 points will be used. Now we expect total 9,000. But our total value for the point ke liye revenue which was kept was 10 lakh. And out of 9,8100 already used up. So can I say 90% already used up? So out of 10 lakh, 90%, 9 lakh should be booked as revenue. Already booked is 5, remaining 4 you book right now. And 10% of 10 lakh will still appear as a liability. And third year mein, the remaining points are used up. So everything goes in revenue. Now liability will become 0. I hope this is clear. Okay, question number 63. You get 10 points for every 500 rupee ka purchase. And 1 point is worth 50 paisa. So 10 points into 50 paisa. I get 5 rupee points. 5 rupee points for 500. So 500 rupee ke goods, 5 rupee ke point. Instead of total 5 of 5, I have to pay only 500. So 500 divided between goods and points in 500 is to 5. 100 is to 1 mein divide karo, 100 is to 1 mein. So now whatever basically I'm selling today, I'll not record full revenue. I'll divide it in the ratio of 100 is to 1. What should be the recognition done for a sale worth 10 lakh on a particular day? 10 lakh hai, so 10 lakh into 100 by 101 will be revenue, and 10 lakh into 1 by 101 will be the liability. Okay, second, how should the redemption transaction be recorded in 1718? A customer has requested you to present the sale of goods and redemption, and total sales is 5,000 lakh. 5,000 lakh पूरे साल का है. ठीक है, तो 5,000 lakh into 100 by 101 will be the sales. 5,000 lakh into 100 by 101 is sales, and 5,000 lakh into 1 by 101 is the loyalty. So this much is the revenue allocated to the points. This much is the revenue allocated to points. And how many total points were given? How many total points were given? 1 crore. 1 crore, but we expect only 80% points to be discounted in the future. 18 lakh already redeemed. Out of 1 crore, 18 lakh already redeemed, and remaining 92 ka we expect 80%. 65.6 plus 18. 82 into 80%, 65.6 plus 18, total 83.6 lakhs we were estimating. total 83.6 lakhs we were estimating. कितना था? Just a minute. Awarded 1 crore point, of which customer 18 points were redeemed. अच्छा, 18 lakh points remain to be undiscounted. अच्छा, not used is 18. 18 is not used, 82 used. 82 use हुआ plus 18 का 80%. We are expecting 9640. 14.4 plus 82. 9640 is the total we are expecting. अच्छा, 9640 में से 82 redeem हो गया. So for 9640, this much was the revenue. So 82 are already redeemed. So how much will be revenue allocated to it? That much is removed from points, goes in revenue. Third, what will be the liability? The remaining के लिए it will be the liability. What will be the liability? Liability basically over here is 739. So for 9640 it's 4950. So for 1440 it will be how much? Acha, next question. In the next year, 60% of outstanding points were discounted. Now see, outstanding point is 18 lakh. 18 ka 60%. 18 ka 60%, not 14.4. So 10.8 lakh. Acha, 10.8 lakh points basically are discounted. 9640 was this much. So 1080 will be how much? That much goes in revenue. 9640 was this much. So 1080 will be how much? That much goes in revenue. I hope this is clear. Any doubts? Anybody till now? Any doubts? Anybody till now? Keep drinking water, keep on replying, pay attention. Okay, now allocation of variable consideration. See, variable consideration may be allocated to entire contract or a part of contract. Like suppose I tell you we are selling computer, we are selling installation services and basically something else. So two things, suppose computer installation. If installation is done within 30 days, some extra thing. If installation is done late, penalty. So variable is only in installation. So now I cannot allocate to entire contract, I'll allocate only to installation services. So variable consideration ka allocation depends. Okay, now check this question. Question number 64. SS, we are selling basically two licenses. We are selling two intellectual property licenses. Selling price of license A is 16 lakh, for license B is basically 20 lakh, SSP. SSP. Entity transfers license B at inception. Now see, whenever I'll transfer license B, I'll record revenue for that. And whenever I transfer license A, I'll record revenue for that. License A transferred after 1 month. Okay, variable consideration allocated entirely to one performance obligation. Imagine, price for A is fixed 16. Now see, SSP be 16, uske liye charge be 16, understandable. And for B is 3% of future sales. So I can understand A ka SSP hai. C ka B you are charging 3% of future sales. And future sales is expected as you are estimating a sales based royalty 20 lakh. So SSP ho gaya dono ka. So I understand the variability 3% of future sale, it's only under B, there's no variability in A. Okay, so whenever, and now see, यहाँ पे 3% of sales हो गया, can I say sales based royalty? So I should book only when sales occur and my performance obligation is over. Okay, so B transferred, day one, don't book any revenue, record only when that sale happens. अच्छा, A transferred, you book 16 lakh, but 1 month के बाद transferred तब. So check out solution here. Check out solution. Upon transfer of B, don't record anything. Why? Because उसमें sales based है. So you should record only when sales based revenue occurred. And upon A transferred, you record revenue 16 lakh. वो 1 month के बाद आएगा. Now second case. Suppose price for A is 6. Now see, the problem is SSP 16 है. And हम लोग contract में 6 लिख रहे हैं. So it is not matching. This is not what we expect to be receiving for A. And B is 5% of future sale, which is coming 30 lakhs. ये भी गलत है. B we are expecting 20, ये 30 हो गया. A में 10 less, B में 10 ज़्यादा. A में 10 less, B में 10 ज़्यादा. This is not what we are expecting. So now I cannot basically say, so if I say 6 lakh is for A, it doesn't fulfill basically what I expect to be entitled, वो fulfill नहीं हो रहा है. So now in this case, A and B kind of clubbed. So now you think 6 lakh is also for AB and this 30 lakh which is based on sales based royalty is also for AB. So whenever you transfer B, 6 lakh is also for AB, 30 lakh is also for AB. That way you need to do it. अच्छा, तो 6 lakh को divide करो in SSP, 16 and 20. अच्छा, you transferred B, record for B. A का don't record right now. A का don't record right now. You transfer B. So this 6 lakh is for AB both. 30 lakh is also for AB both. So whenever you transferred B, record revenue only related to B. Iska 6 lakh ka 20 by 16, 20 by 36. When you transfer A, 6 lakh into 16 by 36 that. And whenever sales happens, you book a sales based royalty divided in the ratio 16:20. Fine, moving ahead. Changes in transaction price is okay, not much important. Last point over here, number 5, satisfying the performance obligation. Step 1, identify contract with customer. Step 2, determine transaction price. Step 3, determine your performance obligation in contract. Step 3, determine transaction price. 4, allocate transaction price to various performance obligation. 5th one is basically satisfying the performance obligation. As and when performance obligation satisfied, you book a revenue. When do I say performance obligation satisfied? When the control is transferred. When control is transferred. Now, indicative list is given to ensure that the control is passed on to customer. 1, you have a right to receive payment, your present right of payment. 2nd, customer has the legal title. Sometimes legal title might still remain with you, still the control might have transferred. Sometimes customer has the physical possession. Sometimes physical possession is with you, still the control might have transferred. Remember bill and hold sales. Customer has assumed significant risk and reward relating to asset. Customer has accepted the asset. These are the criteria given. Okay, consignment arrangement. Arvind sells goods to Pantaloons and Pantaloons sells to end customer. But if goods remain unsold at Pantaloons, Pantaloons can return it back to Arvind. If goods remain unsold to Pantaloons, Pantaloons can return it back to Arvind. Means Pantaloon has to pay to Arvind only if they are able to sell to end customer. So whenever Arvind sends to Pantaloon, can I say goods can still come back? Don't record revenue. It's a consignment arrangement. The indicator when I say it's a consignment arrangement, 1, the product is controlled by the entity. The entity is able to require the return. Arvind can tell to Pantaloons, do one thing, sir, you are not able to sell it. From here, you sell it to Lifestyle. You transfer it to Lifestyle. So Lifestyle ko de do aap. So entities able to require the return of products and or transfer it to third party, and the dealer, this is a dealer, does not have unconditional obligation to pay. Pantaloons does not have unconditional obligation to pay. His obligation to pay comes only if he is able to sell to end customer. So in this case, don't recognize revenue when Pantaloon gives to Arvind gives to Pantaloon. Pantaloon will send monthly statement. That's during this month we are able to sell this much. That much revenue Arvind can book it. Fine. Next, principal versus agent. See, if you're a principal, you book a gross revenue. If you're an agent, you book a net revenue. If you're a principal, book a gross revenue. If you're an agent, you book a net revenue. How do I identify I'm a principal or I'm an agent? Okay, so another party is responsible for fulfilling contract. If I'm not responsible, another party responsible, I'm an agent. I don't have inventory risk. I don't carry inventory risk. If I'm just selling on your behalf, nahi bik raha hai, aapka problem hai. I don't have inventory risk, then I'm agent. I don't have a discretion in pricing. Agent doesn't have discretion in pricing. Consideration what I'm getting is commission and I'm not exposed to credit risk. Acha, Pantaloons wale case mein, Pantaloons has a pricing discretion. If Pantaloons sells on credit to someone, wo unka hai, so they also have a credit risk. So Pantaloons will not be agent. Wo consignment sale hai, that's a consignment sale, but Pantaloons is not an agent. But if this criteria fulfill, it's an agent. Agent books revenue on net basis, they book commission income. If you're a principal, you'll book revenue on gross basis. Next important is bill and hold. Simple known as delivery postponed because of buyer's request. Okay, so the thing is, customer has told me not to deliver right now. He has postponed delivery. Uske request pe, so can I book sales right now? So they are telling, if control is transferred, you can book revenue. So for establishing transfer of control, all criteria must be met. 1, the reason for bill or hold must be substantive, customer requested. 2nd, product you have identified it separately, kept ready for physical transfer and you cannot use it. If you identified the product, kept it separately, you cannot use it, then I can record revenue even if the goods are lying with me, because the reason is customer told me not to deliver right now. All criteria met, you can record revenue. यहाँ पे question number 70 में customer requested us, we have to keep it. अच्छा, the customer has a legal title to spare part, but the entity stores the spare part in separate section, kept it ready for immediate shipment. All the criteria are being met, and he will ask generally after 2-4 years. So can I book revenue for that sale of spare part? Yes. But you are giving one more thing over here, custodian services. So some revenue you should allocate for that custodian services, which should be booked over a period of 2 to 4 years. So sale of machine you can record, sale of spare part also you can record, bill of hold ke criteria satisfied. But there's one more thing over here, custodian services, which you should book over a period of 2 to 4 years. Okay, now there's a word called transfer of control over a period of time or at a point of time. If control is transferred over a period of time, revenue to be booked over a period of time. If control is transferred at a point of time, the revenue should be booked at that point of time. How do I understand? If any of the following three criteria satisfied, control is said to be transferred over a period of time, you can book a revenue over a period of time. 1. The customer simultaneously receives and consumes the benefit. Customer simultaneously receives and consumes the benefit of whatever work you are doing. Second, your entity's performance creates or enhances an asset which customer controls. So either customer gets simultaneous benefit. Okay, so Netflix ka subscription customer is taken, they paid for 1 year, but can I say they're getting simultaneous benefit? Oh, you watch for 1 day, 2 day, 1 month. So you book the revenue over a period of time. The performance obligation is satisfied over a period of time. Second, the entity's performance creates or enhances an asset which customer controls. And third one, the entity's performance does not create an asset with alternative use to entity. See, I'm making a customized machine. It's of no use to me. आपके लिए customized machine बना रहा हूँ. I have no use as such. And I have a legal enforceable right for the performance completed till date. Whatever work I have completed till date, even if you come and cancel contract, whatever work I have completed, I have a right to receive my payment for the work I have completed, not just my cost, but also the profit. Okay, the thing is, the asset being created is kind of a customized machine. It has no alternative use for me, and I have a right to receive payment for it. Then in that case, assume the control is said to be transferred over a period of time. So record revenue over a period of time, else you record revenue at a point of time when that asset is transferred. Moving ahead. Okay, question number 76. Question number 76. Okay. You are required to build an item of equipment, customized equipment you are making. 10% advance, 80% installment, balance 10% at the end. Okay. And the payments are non-refundable. And you don't have any further right to ask money. Payments are non-refundable. Further, I cannot ask. Achha, equipment until I give, customer cannot get benefit. First criteria not met. Asset customer control nahi kar raha hai. Second criteria not. I am creating an asset which has no alternative use for me. Yes, I am creating an asset which has no alternative use for me, and I have an enforceable right for payment. I have an enforceable right for payment for the money for the work done. Achha, so progress payment received covers that. If progress payment received covers that, then yes, that criteria fulfilled. But if progress payment received doesn't cover that, then I don't have a right to ask for extra compensation. So then that criteria not met. First and second anyway is not met. Third way, progress payment covers the cost and margin, then criteria C satisfied, revenue recorded over a period of time. If progress payment doesn't cover that, then C criteria also not met, revenue recorded at a point of time. Okay. Methods of measuring progress is fine, it doesn't matter much. Output method, input method. Okay, how do I measure the progress? Input, cost incurred till date. Oh, input method divided by total estimated cost. Yeah, input method. Output method is sales value of goods or services transferred divided by total contract price. Oh, output method. Now, whenever I'm using input method, when I'm using input method, while determining this cost incurred till date, you need to take care. Sometimes I might have brought the material, but the material have to be used later on. अभी यूज ही नहीं होगा, वो पड़ा रहेगा. And you say, sir, I bought the material, the work this much done. No, work that much is not done. Imagine, I bring a lift. I'm constructing a building mein lift will come. I bought a lift right now, brought it, but lift will be fitted after 6 months. So you cannot say, oh, lift purchase kar liya, that much percentage work is over. No. So what to do? So when you apply input method, a consideration should be given for events that do not depict a direct relationship between input and transfer of goods or services. The adjustment may be required. So when any cost incurred but does not contribute to progress, when any cost is incurred but does not contribute to any progress, like wasted material, don't include it. Usko लो ही मत. And second, so in your cost incurred till date, wasted material should not be included. Same way, when cost incurred is not proportional to entity's progress, like lift, you brought it and you say 30% work ho gaya. Out of 50 lakh, 15 lakh was for lift. You brought the lift. So doesn't mean 30% work is over. No, nothing. You have not started also building. So do one thing. For that item, you book a revenue up to cost incurred. Lift leke aa gaye, I'll allow you to book revenue, but only to the cost of lift. You cannot say 30% work completed and you book 30% profit also. Lift aa gaya, you have not started the work. Lift is to be fitted after 6 months. But I'll allow you to basically book till the cost of lift. Okay, check, there's a question on it. Question number 78. 1st January 1, the contract to renovate a building, you also have to fit new elevator. Total transaction price is 50 lakh. In that 15 lakh is for elevator. Cost में 15 lakh elevator, other cost is 25. Total 40. ठीक है. You brought the elevator and delivered to site 6 months before they are to be installed. Aad लाए, कुछ काम का है नहीं. Okay, so for this 15 lakh which you have spent, okay, I'll allow you to record revenue up to cost only. Usme I cannot allow you to book profit. You can't say, oh, I incurred 15 lakh, 30% work over. No. And actual other cost incurred is 5 lakh. Achha, other cost incurred 5 lakh out of 25 lakh. So can I say 20%? The actually work done is 20%. Achha, out of your total revenue 50, I allocated 15 towards lift. So now 35 ka 20% you book. So 35 is 20%, you will book 7 lakh revenue you will book. Achha, expense related to it was 5, 2 lakh ka profit will be coming. 7 lakh revenue. Out of 50 lakh, 15 is for elevator. I'm booking revenue up to the cost only. For remaining 35, 20% work completed. Standard due obligation is fine. Repurchase agreement. Okay. If I have already entered into a contract with customer, I'm selling you today, I'll repurchase after 1 year. आज आपको बेच रहा हूँ, I'll repurchase it after 1 year. So if there's a mandatory repurchase or entity has an option to repurchase, you have a call option. Entity has an option to repurchase. आपके पास option है. Customer नहीं, आपके पास. You have an option to repurchase. Then in that case, the control is not said to be transferred because mandatory repurchase asset is going to come back only. So in first and second case, control is not said to be transferred. But sir, so don't record revenue. But sir, I got money. Money which you got, treat it as a loan received. So under A and B, control is not transferred to customer. Don't record revenue. What should I do? I should record it as basically what? How do I record? So they've given you 2 things. Pay attention. I'll just tell you this. If repurchase price is more, I got 100 rupee from customer. I have to pay back 110 after 1 year. I'll repurchase at 110. If repurchase price is more, treat it as financing arrangement. Loan taken 100 with interest, I'll repay 110. If repurchase price is more, then it will be financing. If repurchase price is less, you gave me 10 lakh, I'll give you only 9 lakh. So then that difference, that is basically treated as you used my asset for 1 year, uska lease rental. So then in that case, if repurchase price is less than original price, accounted like a lease. Acha, so you paid me 10, but I'll give you 9 only back. You used my asset for 1 year. It is treated as basically lease arrangement. If repurchase price is more, it's a financing arrangement. Repurchase price less, it's a leases. Acha, if customer has a put option, customer can sell you back. Customer has a put option. So for you, you have written put option. Entity has written a put option, so you have obligation to buy. Acha, you have obligation to buy only if customer gives. You have obligation to buy only if customer gives. If customer, C point may, if customer has a right to sell to you, he will exercise his right only when it's beneficial to him. If repurchase price will be more than the expected market price, if repurchase price or basically what rate he sells you will be more than market price, then he will sell you. But if the repurchase price is less than market price, he will not sell you. So if at all customer is not going to sell me, so you can record the sales today. If he's not going to sell me back, I can record the revenue today. But if he's going to sell me back, if I feel customer is going to sell me back, then I should not book the revenue today. Acha, if I'm not booking revenue today, how should I record? So if at all I have to repurchase at a higher price later on, it should be treated as a financing arrangement. If I have to repurchase at a lower price later on, then in that case, lower price than what I've got, then it is treated as leases. Acha, so for determining whether customer will give me back or not, so whether customer will exercise his right or not, we compare the repurchase price and the expected market price at the time of repurchase. Acha, whether to account it as a financing arrangement or lease, we compare the repurchase price and the original selling price. So यहाँ पे comparison is of two different things, here comparison of two different things. So to decide whether customer will give me or not, I'll compare the repurchase price with the expected market price. So if repurchase price is more than market price, he'll give me. If repurchase price is less than market price, he's not going to give me. He'll sell in market only. Okay. Next is a license of intellectual property. License of intellectual property. Imagine I'm giving a license. If I'm giving my license to someone else, how should I book revenue? Should I book the revenue immediately or should I book it over a period of time? So I need to understand whether it's an access to IP or right to use IP. Under right to use IP, I don't have any performance obligation. Okay, I have to give you the records of Kishore Kumar ke songs. So I gave you the songs, my obligation over. What do you do with that songs? How do you use it? My obligation over. Then in that case, it's right to use IP. If it's right to use IP, revenue is recognized at a point of time. But right to access IP, under right to access IP, I have some performance obligation. For example, the Pogo channel, they have a cartoon called as Chota Beam. I am a toy manufacturer. I want the rights of the Chota Beam. So you gave me the rights of the Chota Beam, but they have to continue running the show. So can I say that I expect to see the entity is required or reasonably expected to undertake activity that will affect my licensed IP? License exposes the customer to any effect. So uske karan it exposes me. And the activities are not a performance obligation under the contract. Okay, the thing is to run a show is as such not a condition of the contract, but I reasonably expect they will run the show. Because of that, basically the Chota Beam character ka importance will grow and grow and grow, and my toys basically selling will increase. So can I say here they have some performance obligation? If they have some performance obligation, then in that case the revenue should be recognized over a period of time. If I just give the songs, that's it, I don't have any performance obligation, you record revenue at a point of time or you record it over a period of time in case performance obligations are there. So you are required or reasonably expected to undertake some activities. Okay. Check question over here, 82. Sports team D entered into a 3 years license to license its name and logo to apparel maker M. Okay, so now say for example Puma will make t-shirts of India. Team India ke t-shirts Puma will be making. Now determine the nature of license. Now tell me whether Puma expects that Team India will continue to play matches, they will try to give their best so that basically they reach in finals. Yeah. So then can I say Team India has to do some performance obligation? Revenue should be recorded over a period of time. But imagine you are Team D has not played any games in many years. They've not basically played any games in many years, and I don't expect them to play also. So can I say now I just want the right of their name, Kapil Dev ka naam. I don't basically want Kapil Dev to do anything. I'll make t-shirts of Kapil Dev. But I don't want Kapil Dev to do anything. So can I say now in that case they don't have any other performance obligation, book revenue at a point of time. Fine. Okay. Contract cost. Okay, one is cost to obtain the contract, acquisition related cost. Cost to obtain the contract, acquisition related cost. So what do I do for that? Incremental cost of obtaining a contract. Acha. Incremental cost of obtaining a contract are actually capitalized. Now what is incremental cost? If the contract was not there, this cost also would not have been there. So incremental cost to obtain a contract is capitalized and then split over the period in which the revenue is recognized. Over the period in which the revenue is recognized. Okay, moving ahead. Amortization impairment is fine. Okay. Now come to presentation and disclosure. Come to presentation and disclosure. Now I'm booking a revenue as per IND AS 115. So whatever revenue I book, can I say revenue, say for example, I can book 100 rupee. As per IND AS 115, I'm entitled to book a revenue 100. I'm booking a revenue 100. But as per the contract, I can bill only 80 rupees. Achha, as per IND AS 115, I'm allowed to book a revenue of 100 rupee. But as per the agreement, I'm allowed to bill 80 rupee. 80 bill kar paunga. And 70 they have paid. Achha, so can I say revenue of 100, received is 70, 30 is my asset. Achha, 30 is my asset. Out of that, billing kitna hua hai? 80. So can I say 70 to 80 is pending? 10 rupees my unconditional right, that will be debtors. 10 rupees my unconditional right, that will be debtors. And 80 to 100 I booked as per IND AS 115, that will be a contract asset. So receivable is basically unconditional right to receive. And your contract asset will be basically 80 to 100. So out of total 100 revenue booked, 70 is received. Achha, as per the agreement, I was entitled to bill 80. So 70 to 80 pending is a receivable. 80 to 100 pending is a contract asset. Achha, if I have received extra, it will be treated as a contract liability. Advance mil gaya aapka, extra mila hai. 100 I have booked a revenue, 110 you have paid, extra 10 will be a contract liability. Okay, there's a question on November 19 in this, but it's not important, so I'm skipping it. And this last point of this standard is service concession arrangement. Last point of this standard is service concession arrangement. Now, what is a service concession arrangement? Government of India gives a contract to construct road to L&T. I'll just directly go to the example on next page. Government enters into contract with L&T, where L&T will construct a road, maintain it for next 10 years, and then L&T will collect toll income. Achha, the L&T will construct a road, maintain it for next 10 years, as well as collect the toll income. Now, pay attention. Okay, under such an arrangement, the private sector entity, L&T, constructing the infrastructure. Now, that infrastructure will be used by public at large. So, whether L&T can record road as their asset? No. I cannot record road as my asset. Okay. For constructing road, I'll be getting money. If government pays me, say, fixed amount, 200 crores. If government pays me fixed amount, 200 crores, so can I say for me, 200 crores will be my revenue? But if government doesn't pay me fixed amount, they give me a right to collect toll for 5 years. I'm not being paid any fixed amount. I'm just given a right to collect toll for 5 years. That right which I'm getting is an intangible asset. It's an intangible asset. Achha, if fixed amount I'll be getting, it's a financial asset for me. If a right to collect toll I'm getting, it's an intangible asset for me. Okay, the infrastructure shall not be recognized as PPE in the books of L&T because they don't have a control over road. So how do you record it? So you have to record revenue for construction work and the maintenance work, what you will be doing. So uske liye revenue. The revenue related to construction renovation will be, what revenue you have to book? Fair value of construction. So construction for the construction ke liye revenue will be the fair value of construction. You need to book revenue and cost for construction. You need to book revenue and cost for operation. Okay. If you are giving construction, the fair value uska jo hoga construction ka, that will be your revenue related to construction. You need to book a financial asset. When I have to book a financial asset, when I'll be getting kind of a fixed amount. A second, you'll be book a intangible asset if you're just getting a license. License mila hai aapko to collect the toll, you'll book a intangible asset. Check this question number 87, it will be more clear. There's a Bhilwara Jabalpur project. Total expense is 100 crore. Fair value of construction is 110. Fair value of construction 110. This you book it as revenue over a period of construction. Fair value of construction is 110. ठीक है. And you've incurred till now 50 crore rupees ka expense. ठीक है. Total cash flow guaranteed by government 200. Government has given me a guarantee of 200. So this is not intangible. This is financial asset. This is financial asset. Revenue, finance revenue is 15 crore. अच्छा, operation phase उसका finance revenue as they are paying late interest revenue is 15. Okay, so now let's try to understand out of total 200. Out of total 200, revenue for construction will be 110, the fair value. So construction period में I can book 110 revenue. I can book 110 revenue. Finance revenue is 15, so 110 plus 15 and total 275 will be the operational revenue. So if you just check out the journal entry, during construction I spend 100, cost of construction debit to bank 100 and I'll book a revenue 110. I have to receive financial asset to revenue 110. This is construction phase. Okay, second operational phase. Operational phase pay finance revenue, financial asset to finance revenue is 15 and other operational revenue is 75, financial asset to revenue is 75 and total then I receive 200, bank to financial asset 200. Cost related to operation not given, it has been ignored. This is the first one. Okay, second one, Kolhapur Nagpur highway, the cost of construction is 110, uska fair value 200. So 200 crore you'll book it as revenue over the period of construction. And you got a right to collect toll. I'll book it as intangible asset. I'll book it as intangible asset. Okay, so first I spend 110, cost of construction to bank 110. Okay. Now construction period mein I'll book a revenue 200. Okay, I cannot write financial asset debit. I got a right to collect toll. The intangible asset debit to revenue is 200. And this intangible asset will be amortized over the period. The 200 amortization will come during operational phase. The revenue from toll etc. is not given. I keep it question mark. This is IND AS 115. Any doubts? Anybody with IND AS 115? Any doubts? Anybody with IND AS 115? We'll start IND AS 116 as well. We'll start IND AS 116 as well. Probably half will do, then we'll take a break. Keep on replying. Thank you, Aradhya. Thank you, Abhijit. Thank you, Harshit. Thank you, everyone. Okay, moving on to the next one, IND AS 116, which is on leases. Now, this standard is applicable to all the leases. Two things are not covered under this standard. Which are two things not covered under this standard? One is called as a short-term lease. If it is a short-term lease, your option not to apply 116. And second one is a lease for which it's a low value item. So one short-term lease, low value item, there's an option given to you. You may not follow this. You can directly book them as an expense on a yearly basis. Normal. Acha, what is a short-term lease? So at commencement date, the lease term is 12 months or less and there's no option to purchase the asset. Commencement date where lease term is 12 months or less and there's no option to purchase the asset. And if you're going for this short-term lease exemption, you don't want to apply 116 for the short-term leases, you need to basically have it for all the items falling in that class. Okay, say office furniture. So for all office furniture, it has to be same way. It cannot be like one office furniture, I follow 116, another office furniture, I don't follow. For all office furniture, if they are all short term, you have to follow this. Fine. Now the question came, sir, a word written over here was commencement date. Then the word came lease term. What do you mean by all this? Acha, so first of all, they've written the word inception date. Inception date is the date when you entered into an agreement or there's a commitment by the parties. You entered into an agreement or there's a commitment by party, whichever is earlier. Commencement date is the date when asset is available for use. जब से asset available for use हो गया lessee को, that's commencement date. Okay, we entered into a contract today. Say for example, today is 28th of April, we entered into a contract. But, I'll be giving you asset from 1st May. The 1st May will be the commencement date. And third, lease term. Lease term is the non-cancelable period. Lease term is a non-cancelable period. It will include the renewal period if renewal is basically kind of reasonably certain. And if there's a termination option, imagine lease term as such was 10 years, but it can be terminated after 6 years. And if termination is reasonably certain, then I'll not take 10 years, then I'll take only 6 years. ठीक है. Moving ahead. Now, what is a lease of low value item? They're not given amount wise. 5,000 low value, नहीं, ऐसा नहीं बोला है. They're not telling that way. So, what is a lease of low value item? The underlying asset can be low value only if both the following conditions are satisfied. Lessee can benefit from the use of underlying asset on its own or other assets which are readily available with lessee, and it's not highly dependent or interrelated with others. So many companies, they take laptops on lease, small other items on lease. So for that all things, they say you can apply lease, basically low value item exemption. You may not account as per IND AS 116 for small IT equipment kind of things. And a head lease, you know, A to B, B to C. So B to C is called as a sublease, A to B is called as a head lease. Head lease will not qualify as a low value asset. Head lease में कभी low value item नहीं आएगा वो. Okay, now what do we mean by the word lease? So first they say that this standard covers all lease, but for basically short-term leases and lease of low value item, your option, if you want, you don't follow IND AS 116. And for that, you will be accounting it like, okay, monthly, whatever rent paid, you account that way. Now, what do you mean by the word lease? It's a contract or a part of contract. Contract or a part of contract that conveys the right to control the use of an identified asset. Right to control kya? Use of an identified asset for a particular period of time in exchange for consideration. At inception date, whenever agreement entered, we need to see whether the contract is a lease or contract contains a lease. So, right to control the use of an identified asset is required. So, can I say first of all, we need identified asset? Identified asset. Now, when do I say I have granted right to control the use? Right to control the use. So, substantially all benefit related to use should come to me. So, does the customer have a right to obtain substantially all benefit related to use? Acha. Agar no aaya, then it's not a lease. Acha, if yes, acha, you should be getting not just substantially all benefit related to use, but you should also be able to direct the use. So, does the customer have a right to direct how and for what purpose asset is used? If yes, customer has it, then it contains a lease. But sometimes what happens is the purpose is kind of predefined. Imagine I take solar panels on lease which are already installed. So I should have, so in that case the use is predetermined. उसमें कुछ करना ही नहीं है, solar panels are already installed. I should have been there either in operating the asset or I should have been there either in designing the asset. Okay, so one, there has to be identified asset. Second, you check, do you get substantially all benefit related to use? अगर वो yes है, then you check whether you are able to direct the asset, the use, the purpose. अगर वो भी yes है, then it's a lease. But if suppose direction or use is kind of predetermined, then you should have been involved in designing the asset or you should have operated the asset. Then it contains a lease. ठीक है. Identified asset is fine. Now, if there are substantive substitution right, imagine I take a car on rent. From someone, but that guy says that whenever I want, I can come and change the car. Like, okay, I'll give you the car, suppose Maruti Swift, but suppose I gave you Maruti Swift for 7 days. After 7 days, I have some another Maruti Swift and I need this, I can exchange it. So see, if at all that person can keep on exchanging, so can I say there is no identified asset? Then in that case, it is not a lease. It doesn't fall under lease. So supplier's right to substitute the asset. If supplier has a right to substitute, if that right is substantive, it is not a lease. When do I say it is substantive? When supplier has practicability to substitute and it will benefit him. Practicability bhi hai and it will benefit him, then in that case, it was a substantive right. But supplier can substitute only when there's a problem in the car. When this car has a problem, he will give me another car, then that right is not substantive. Then basically we don't consider it, then it is still considered, then identified asset is there. I hope this is clear. Okay, this already done. Right to control use. Okay, exam angle, this all theory not much relevant. Exam angle, accounting portion will be more relevant. Okay, coming over here, question number 10. Coming over here, question number 10. Customer X enters into a contract with supplier Y to use the vehicle for 5 years. The vehicle is identified. He cannot substitute unless it's breakdown. He cannot substitute. So can I say supplier does not have a substantive substitution right? ठीक है. Customer X operates the vehicle, directs how to use it. Customer X decides how to use the vehicle. But supplier ने prohibit किया है, you can't move it overseas or you cannot modify. These are protective right of supplier. The supplier is telling don't take the vehicle abroad. Abroad मत ले जाओ यार. And you can't modify my vehicle. I have given you on rent. So does it fall under leases? Answer is yes. The right available with supplier are kind of just substantive only. Who is directing the use? Customer X only is directing the use. Customer X only is getting all the benefit related to use. So this is basically leases. So whether customer X has the right to direct the use? Answer is yes. Okay, now separation of lease and non-lease component. See, sometimes what happens is there are two components. One is a lease component, other is a non-lease component. Imagine I'm giving you a building on rent. Plus I'll also handle your maintenance services. So there are two things in a contract. One, building given on rent, and I'll handle your providing maintenance services. Now providing maintenance services is a non-lease component. Giving building on rent is a lease. वो lease है, but second part is non-lease. So I need to segregate the lease component, non-lease component, account it separately. Now sir, how do I segregate? Based on the relative SSP. So check over here, separating. अच्छा, sometimes there are two lease component, उसको भी अलग करो. Separating lease and non-lease component, that also you can segregate it. Fine. Building taken on lease and split AC taken on lease. These are two lease components. A building taken on lease with a centralized air conditioning system. I cannot segregate centralized air conditioning. So it is only single lease component. So whether there are two lease component, so if lessee can benefit separately out of each asset and they are not interdependent, interrelated, then yes, there are two separate lease component. अच्छा, ये है separating lease component from non-lease. Non-lease I already gave you example. Building given with maintenance services, car given with a driver. So one is a lease component, other is non-lease. Acha, you will also pay a maintenance of building. Okay, if you pay maintenance of building, are we getting any goods or services? See, when I have to give maintenance, you pay maintenance. Yes, maintenance is service to be given. But if you pay municipal tax doesn't give any services. Municipal tax doesn't give any services, so that is not a separate performance obligation, or that's not a separate service provided, but maintenance is a separate service provided. So check over here, reimbursement is basically for maintenance. We have to transfer goods and services. It's treated as a non-lease component, but we reimburse certain taxes, government wale, they do not transfer goods or services, so they are not a separate component. They are not a separate component, and they have given one optional exemption which is only for lessee. There's optional exemption only for lessee. A lessee may not bifurcate a lease component and a non-lease component, but account all together as lease component. The lessee may not bifurcate a lease component and a non-lease component, but account it fully as a lease component only. Only for lessee, lessor doesn't have this option. Lessor doesn't have this option. Okay. Now suppose lessee does not go for practical expedient and is bifurcating lease component, non-lease component. So lease component will be accounted as per IND AS 116. Non-lease component, you're buying goods or services, accounted separately. You're buying goods and services, accounted separately, not under 116. So if you are not going for practical expedient, everything is lease component. But if you're going for practical, if you are not going for practical expedient, lease component, non-lease component separately. If you're not going for practical expedient, dono separate. But if you're going, then everything is just lease component. Achha, if you're not going, I have to account it separately. How do I split? How do I split the payment made? How much is towards building? How much towards maintenance service? Standalone SSP pay, it will be divided, just like we did under IND AS 115. Okay, come to question number 18. Come to question number 18. We leased the equipment plus we'll also do maintenance. Okay. The price is written in contract. This is of no use. Price is written in contract is of no use. Ye mat dekho. I need to see the standalone prices. Standalone prices are 85 and 15. 85 and 15, but we charge 90. So divide 90 in the ratio of 85 and 15 into 85 by 100. This is coming 76,500. This will be 13,500. Contract combination, same as IND AS 115. They are entered at or near the same time with the same customer, and they are telling any of the one criteria satisfied, negotiated as a package, price of one depends on price of other, and third, they are a part of a kind of single lease component. Portfolio application is fine. Going to the word inception and commencement of lease. Okay, this definition we already saw. Inception is the date when you entered into agreement or the date of commitment between parties, whichever is earlier. Commencement date is the date from which the asset is available to use, available for use to the lessee. Available for use to the lessee. And lease term includes a rent-free period also. Like suppose we made an asset available to you on 1st May only. But I gave you 15 days for making furniture. Rent starts from 15th May. Even though rent starts from 15th May, the lease term starts from 1st May only, the date when asset is available for use. The date when asset available for use, that's basically from the date the lease term starts. Okay, inception date is important to decide whether it contains, whether the contract is a lease or contains a lease. That I have to check on inception date. Commencement date is important because accounting starts from that day. The lessor lessee will start accounting from commencement date. Lease term is a non-cancelable period which you cannot cancel. Renewal period you include if it's reasonably certain for renewal. Termination period, like out of 10 years, you can terminate after 6 years. And if it's reasonably certain you'll go for termination, then you don't take 10 years, then you take only 6 years. Fine. And lease term can include a non-consecutive period also. I entered into a contract with you to take a warehouse on rent only for the month of April, May, June, and next 7 years. 7 years I'll take, but only for April, May, June. So lease term will be 7 years into 3 months, 21 months. Lease term will be 7 into 3, 21 months. Okay, over here non-cancelable period is 6 years. There's a 2-year fixed price renewal option. There's a 2-year fixed price renewal option which is not reasonably certain, so don't take it. Then lease term is 6 years. Yahan pe you've done a leasehold improvement and now it's reasonably certain, then you take it 8 years. Acha, yahan pe 8 hai plus a 2-year wala thing and they've done some improvement, so they are not going to vacate it, then you take it 10 years. Ye third ho gaya, chalo. If a contract can be cancelled by any of the party, like suppose contract was for 10 years, but after 6 years, any of them can cancel it without insignificant penalty. any of them, lessor, lessee, any of them can cancel without insignificant penalty, then the term will not be 10 years, term will be counted as 6 years only. So both. Acha, if only lessor can cancel, assume lessor will not go for cancellation. If only lessor can cancel, assume lessor will not go for cancellation, term is 10 years. Acha, lessee can cancel, then you need to see, then you need to check whether lessee will go, whether lessee will not go. Depending on that, you take either 6 or 10. But when both party can cancel, then you take only 6 years. If only lessor can cancel, ignore it. Assume lessor will not go. If only lessee can cancel, you have to think whether it will go, whether it will not go. You take 6 or 10 like. If both can cancel, then you can take only 6 years. Okay, next is reassessment of lease term and purchase option. Okay, lease term, initially you thought you will not go for renewal, but after 2 years, now you feel you will go for renewal. Achha, initially you thought you will not purchase the asset at the end, but now you feel you will purchase the asset. तो वो reassessment हुआ. Reassessment of lease term purchase option is, there was something in the contract, initially we thought something, now we feel something else. There is no modification in contract. There is no modification in contract. So this is called reassessment. How to account for reassessment? It's covered later. How to account for reassessment is covered later. Okay, next is lease payment. What is included in the word lease payment? What is included in the word lease payment? Very important. Lease payment include your fixed payments, what you're making, less any lease incentive receivable. Achha. Many times we give incentive to the tenant. Many times we give incentive to the tenant so that he takes our property on rent. He is telling, sir, I basically stay very far. और सर वहाँ पे मेरा ऑलरेडी फर्नीचर था, यहाँ पे आई हैव टू डू इट अगेन, तो आई से ओके आई विल गिव यू मनी फॉर फर्नीचर. तो द थिंग इज बेसिकली दिस इज व्हाट आई एम पेइंग टू द लेसी. तो योर लीज पेमेंट इंक्लूड्स योर फिक्स्ड पेमेंट्स प्लस इन सब्सटेंस फिक्स पेमेंट, लेस एनी लीज इंसेंटिव रिसीवेबल. अच्छा, प्लस वेरिएबल पेमेंट विच आर डिपेंडेंट ओनली ऑन रेट और इंडेक्स. वेरिएबल पेमेंट डिपेंडेंट ऑन सेल प्राइस, वेरिएबल पेमेंट डिपेंडिंग ऑन प्रॉफिट. नो, which depend only on rate or index, inflation rate, inflation index, kind of that. Okay, exercise price or purchase option. I gave you a purchase option, and if you're reasonably certain to exercise purchase option, the exercise price is also included in lease payment. So whatever I'll be getting, kind of. Acha, payment of any penalties for terminating lease. Acha, lessee has an option to cancel after 6 years, but for cancellation he'll have to pay 2 lakh. And if lessee feels he'll go for cancellation, the 2 lakh to be paid will also be included in lease payment. So lease payment include your fixed payments plus in substance fixed payment less any lease incentive receivable. Received nahi, receivable. Acha, variable payment which are based on index or rate. Third, the exercise price of purchase option if purchase option is reasonably certain to be exercised. And fourth, the penalties if it is reasonable we go for cancellation. Plus if I have to pay anything under residual guarantee program, many times the lessee gives a guarantee that at the end I'll buy this from you at this much rate. So some residual guarantee program may have given a guarantee that pakka you will get 3 lakh basically from car. Acha, now outside से मुझे लग रहा है 270 आएगा. I have given a guarantee of 3, तो extra 30 I have to pay. So lessee said I'll use your car properly, and pakka I say after 5 years, okay, even if I am not buying, but I guarantee you'll get 3 lakh for the car. अच्छा, अगर लग रहा है कि he will be able to get only 280 for the car, but I have guaranteed him 3 lakh, तो कहने से I'll have to pay 20,000 to him. So that's amount payable under guarantee program. Under guarantee program. अच्छा, for lessee, the amount payable under guarantee program is what he has to pay. For lesser, the guarantee will be including, the amount for the guarantee will include the guarantee given by lessee or the guarantee given by third party, whichever is higher. अच्छा, for lessee, amount payable under guarantee program is what he has to pay. But for lesser, amount receivable under guarantee is the guarantee given by lessee or third party, whichever is higher. The guaranteed residual values are included in your lease payment. Now, what does lease payment doesn't include? What does lease payment doesn't include? Any amount allocated to non-lease component, they are not accounted here only. They are non-lease component के लिए allocated, or variable payment which do not depend on rate or index. ठीक है. Fixed lease payment is which are fixed. अच्छा, first year 1 lakh, then 110, then 120, then 130, 140. That is also called as fixed only because वो time है. Time is certain to go, तो वो भी fixed ही है. अच्छा, in substance fixed. If you use the property 1 lakh lease, if you're not using, it will be 50,000. there won't be any month where you're not using. वो कोविड आ गया अलग चीज था, बाकी otherwise it is not going to happen only, you are going to use only. I know it will not be 50, it will be 1 lakh only every month. That's in substance fixed lease payment. Lease incentive, already told you, the payment made by lessor to lessee to motivate him to go for the lease. So basically lease payment includes your payment less any lease incentive receivable. Variable lease payment, I already told you, which varies. If it is based on rate or index, it's included in your lease payment. If it is not based on rate or index, it's based on sales, profit, something else, it's not covered under your lease payment. Sir, if it's not covered under lease payment, how do I account? I'll come to accounting later. Acha, initial direct cost. Initial direct cost, they are the incremental cost of obtaining a lease. And if lease was not there, this cost would not be there. Incremental direct cost are the cost for obtaining a lease. If lease was not there, this cost would not be there, like agent ka commission, broker. So that all is initial direct cost. How to account, I'm coming to it later. You're just understanding word, accounting is pending. Discount rate. Discount rate. Okay. See, under your IND AS 116, whenever I take a asset on lease, I record a ROU asset. ROU asset debit to lease liability. And lease liability is whatever I have to pay in future, uska present value. So lease liability will be whatever I have to pay, uska present value. So discount rate, which one I should take? Discount rate, which one I should take? So one, I take the IRR, implicit rate of return of lessor ka. But sometimes I may not be understanding what is lessor's IRR. So you can basically use the lessee's incremental borrowing rate. So either it's IRR of lessor or your incremental borrowing rate. How do you find out IRR? How do you find IRR? See, whatever I'm getting, the present value of lease payments, if I think from lessor's angle, lease payment includes guaranteed residual value plus UGRV. So whatever you will be getting, if it equals to the fair value of asset and the initial direct cost, fair value of asset plus the initial direct cost of lessor. Imagine lessor bought a asset, gave it on rent, on giving on rent brokerage laga tha. So this too he incurred, and this is what he is getting. The present value of this equals, that is IRR, internal rate of return. So present value of lease payment plus the present value of UGRV, wherever it equals the fair value of asset plus the initial direct cost of lessor, that's IRR. So IRR of lessor you take as discount rate, or lessee's incremental borrowing cost. If IRR of lessor available, take that. Okay. And IRR of lessor, how do you find? By trial and error method. That's understandable, you have done earlier also. Now the word lessee accounting. I'll just take lessee accounting bit of things, then I'll basically take a break. So 10 more minutes, then we take a break. So how do we account in the books of lessee? Day one on commencement date, not when you entered contract, the date when asset is available for use. 1st May. The date when asset is available for use, you book a ROU asset and opposite a lease liability. You record ROU asset, lease liability. Question comes, what value? First, coming to lease liability, the lease liability will be whatever I have to pay in future, uska present value. It's present value of the lease payment which you are required to make over the time. It is a present value of the lease payment which you are required to make over the time, discounted. Present value china. And just remember, lease payment includes guaranteed residual value. For a lessee, whatever you have guaranteed, wo aayega. ठीक है. अच्छा. And your lease payment, whenever we are calculating lease payment, lease incentive receivable has been deducted. Achha, lease incentive already received will not be covered here. Lease incentive already received will not be covered here because lease incentive already received. तो वो liability में है नहीं कहीं पे. It's already received. ठीक है. Now check question number 31. Question number 31. Okay, if I just take 30th also, for 10 years you're required to pay 10 lakh. For 10 years, you're required to pay 10 lakh. An implicit rate given 5% for discounting is 5%. I'll take. So whatever I have to pay, every year my rent is increasing by 2%. Every year my rent is increased. The first year 1 lakh, then plus 2%, plus 2%, plus 2% this, and discounted by the basically 5% discounting rate. So this is your lease liability. Second question mein, whenever lease rentals are payable at beginning, just take care. Whenever lease rentals are payable at beginning, just take care. So 9-year period, 70,000 is lease rental. And you entered into another agreement whereas there is some other things also to be supplied. So यहाँ पे to be bifurcated. Annual service charge amounting to rupees some 1 lakh. So ये कुछ we need to bifurcate. SSP is basically 1 lakh. SSP of lease agreement is 120. Standalone for facility is 80. So 120, 80. And what is the total consideration? What's the total consideration given? Ye 70 and ye 1 lakh. What is written doesn't matter. The total 170. What is written in contract doesn't matter. Divide 170 in SSP, that is 120 is to 80. So into 120 by 200. So this is coming 1 lakh 2,000. This is coming 68. What is written in agreement doesn't matter. Agreement mein likha 70 for rent, 1 lakh for other services. No. Total 170 divided in SSP. So 1 lakh 2,000 is for rent. 1 lakh 2,000 is for rent. Uska present value will be the lease liability. Okay, now how do I measure ROU asset? How do I measure ROU asset? ROU asset is whatever lease liability came that. Whatever lease liability came that. Acha, payment made to lessor. Already payment. See, liability kya tha? Whatever I have to pay in future, the present value. If already some payment is made, already payment made at or before commencement date, usko add karo. This is what I had to pay in future, uska present. But already paid is also to be added in asset. Acha, any lease incentive already received, that will be deducted. Already received. Acha, plus lessee incurs any initial direct cost. Lessee incurs any initial direct cost, that will be added to the asset. Initial direct cost incurred by lessee, ROU asset to bank. And whenever basically you take ROU asset, last में आपको dismantle करके restore करके देना है, so whatever will be the restoration expense coming at end, उसका present value. Whatever is the restoration expense going to come at then, उसका present value you include it in asset. The entry will be ROU asset to provision for dismantling. Okay, so whatever is lease liability coming that plus payment which you already made or lease incentive which you already received, usko deduct karo. Plus initial direct cost which you are bearing and any restoration which you have to do, uska present value asset mein add it. Clear? Okay, this was day 1. So day 1 we are having an entry ROU asset to lease liability. For payment already done, it was ROU asset to bank. Okay, for that dismantling wala thing, ROU asset to provision for dismantling. Subsequent measurement. Liability was booked at present value. So every year unwinding of discount will happen, interest accrues, we pay something, closing. That is in liability. Acha, for your asset. For asset, ROU asset will be depreciated. Sir, how would I depreciate? So you need to depreciate over the economic life of the asset. Life of asset kitna? Or your lease term, whichever is lower. Life of asset is 10 years, but I took it on lease for 5 years only. I have to depreciate over 5 years. Okay. So ROU asset should be measured using cost model, or if you are going revaluation, the revaluation is also allowed. Cost less accumulated depreciation, accumulated impairment. Remeasurement karoge, value change hoga. What is remeasurement? I'll come to it later. And you need to depreciate over useful life or lease term, whichever is lower. Lease liability, day 1 it was there. Interest accrues, we receive something, closing. Interest accrues, we receive something and closing. Okay, check question number 35. Check question number 35. Okay, in your 35th question, property term is 10 years with 5-year renewal. ठीक है, economic life 40 years and your option to purchase at the end for 30 lakhs. First payment is 5 lakh with increase 3% every year. Every year 3% increase. Implicit rate of interest 9.04. This will be used for discounting. And there's a lease incentive 2 lakh at beginning of year 2. Now see, lease incentive is at beginning of year 2. We assume the lease rentals are also at beginning. Lease incentive is at the beginning of year 2. We assume the lease rentals are also at beginning. The beginning of year I have to pay lease rental first year 5 lakh. First year 5 lakh. Then plus 3% every year I have to do. So it is, pay attention. Yeah, 5 lakh, then plus 3% is 515. 515 hai, but we got 2 lakh lease incentive. That way. Achha, 515 plus again 3%, it becomes 530, plus again 3%, it becomes 546, so on. These are at beginning of year. Lease incentive receivable was at year 2 beginning, yahan pe deducted. Fine. Now, the rate I have to use for discounting is how many percent? 9.04. Beginning of year hai na? ठीक है. 5 lakh I paid on day 1. 5 lakh I basically have to pay on day 1. Okay, so do one thing. This is how I have to pay. As I have to pay on day 1, uska present value is 1 only. Second year beginning which I have to pay, take a PBIF of first year end. 10th year beginning I have to pay, take a PBIF of 9th year end. So total lease liability 3739. Did you understood? Just here take this care. PBIF kaun sa lena hai? 3739. Now, interest accrued, we did not pay anything. Ye tha interest accrued, this closing. Now, this 4906, we paid 315. Now, interest is on 4906 minus 315. How I am calculating interest? Interest here is calculated as 4906 minus 315, means previous year closing. Previous year जो closing था उसमें से day 1 I paid something, on remaining it's 9.04%. I hope this is clear. Okay. Last point before break. If I have a lease in foreign currency, do one thing. Find out the lease liability in foreign currency only. Find out the lease liability in foreign currency, and liability is a monetary item, then bring it to closing rate. Find lease liability in foreign currency only. So suppose I have to pay $10,000 every year, first year, second year, third year, fourth year, fifth year. Find present value in foreign currency and check over here. I have to pay $10,000 for how many years? 5 years. Beginning rate, average rate, closing rate given, and 5% is the discounting rate they have given. So I have to pay this 5% discounting rate. So what I have to pay is $43,300 present value wise. Closing rate pe le lo. 29,44,400 should be the liability in your book. Entry ROU asset to lease liability. Now, this you booked it on day 1. Acha, pay attention. Day 1 I have to take the rate on the date of transaction. So when I took ROU asset, when I took that ROU asset, I took that lease pay. Day 1, take the rate on day 1. Take the rate on day 1. Now, interest accrues, we pay $10,000 closing. Interest accrues, we pay $10,000 closing. Take first in dollar term. Dollar term 43,300. Interest accrued 5%. 43,300 into 5%, 2165. We paid 10,000. This is closing. Now see, I have written over here, keep interest column before payment. The opening, interest accrued, we paid, closing. Opening is at opening rate. Interest will be at average rate for the year. Payment done on last day. Wo last day's rate it will be there. So interest basically accounted based on average rate. Yeah, interest aaya average rate. Payment accounted at the rate on the date of payment, closing. Okay, so now INR wise opening was 29,44,400 plus interest accrued. Interest is 149,385 minus payment done 7 lakh. INR wise the balance is 2393. INR wise the balance is 2393,785. Now, what should be the lease liability? Closing for dollar term mein 35,465 into 70. Lease liability should be 2482. It is 23 something. Now you check out difference 88765, that will go as your exchange loss in P&L. Monetary item brought to closing rate. Okay, so day 1 starting में recorded rate on that day, interest is at average rate, payments done at the rate on the date of payment. Now closing, whatever comes, you have it in INR, but now bring it to the closing rate. So opening lease liability, this rate, this is this, and now in our book it is dollar terms this, rupee term this, but if I have to bring this to closing rate, difference is 88765. Remeasurement, I'm doing it after the break. Any doubts? Anybody till now? Remeasurement, I'm doing it after the break. Any doubts? Anybody? Okay, 15 minutes break. We are meeting back at 8:30. 15 minutes break. We are meeting back at 8:30. The class is till 11:30 today. The class will be till 11:30 today. Enjoy your break. Okay, hi, welcome back. We did IND AS 115, we started with IND AS 116. Let's finish IND AS 116 as well as your financial instrument, and then we'll take another break. Okay, so in this session we are finishing IND AS 116 and your financial instrument chapter. We'll take a break afterwards, and then IND AS 101 financial instrument, analysis of financial instrument, two things. Okay, coming to remeasurement point. Now, what do you mean by remeasurement? Under remeasurement, there is no change in contract. Contract is not being changed, but what is happening is our expectation. Earlier, we thought we'll not go for renewal. Now we think we'll go for renewal. Earlier, we thought we'll not go for termination. Now we think we'll go for termination. Earlier, we thought we are going to purchase. Now we think, no, we are not going to purchase. So that is basically coming under your remeasurement. Plus, in substance, fixed lease payment changes, or there's a change in rate or index. Remember, variable lease payment that depend on rate or index, they were included in your lease payment. But if rate or index has changed, what to do? So this comes over here. So there's a reassessment of lease term, or there is a reassessment of purchase option. In substance, fixed lease payment changed, or amount expected to be paid under residual guarantee program changed, or there's a change in rate or index for a variable lease payment. These are coming under remeasurement. Because of remeasurement, we'll remeasure the liability. Now, if it is due to point number A and B, if it is due to point number A and B is change in lease term, so renewal or termination, and second is basically purchase option. If it is due to this A and B, 2 points, then in that case, the new liability will be based on revised discount rate. The new liability will be based on which discount rate? The revised discount rate, if it is basically your A or B. But if it is due to CDE, the revised liability will be based on the original discount rate only. This you need to take care. And because the liability remeasured, opposite effect comes in ROU asset only. Upon remeasurement, the opposite effect comes in ROU asset. There's no gain loss coming. There's no gain loss coming. Remeasured it, the opposite effect goes in ROU asset. Fine. Now moving ahead, question number 38. Okay, question number 38. If we just check out over here, there's a lease which was taken on 1/1/2017. Lease term was 5 years, renewal 3 years further. Payment for initial period was 1 lakh, renewal period is 110. Initial period was 1 lakh, renewal period was 110. And the lease payment will increase based on CPI. Lease payment will increase based on CPI. The payment due on 1/1. I understand payments are at beginning of the year. Will be based on CPI available at 31st December 17. And they are telling over here the incremental borrowing rate 1/1/20 is 5%. Inception was 5%, 1/1/20 is 6%. CPI at commencement was 120, now CPI became 125. So when I say CPI changed, when CPI was 120, the amount payable was 1 lakh. 1 lakh normally, and renewal period was 110. And if you just check out, CPI falls under your category number D, not D, E. Yeah. Change in rate or index. ये E में आता है. There's one more question over here. Earlier we thought he will not go for renewal, but now in 2020 we feel he will go for renewal. Oh, the lease term is also changing. So there's a remeasurement due to point A as well as E. For point A, we need to measure it as per the, revised discount rate. For E point, it was original discount rate, but as it is A and E both, we'll measure it as per the revised discount rate. ठीक है. So over here, earlier the lease rentals were basically like this. Now beginning of 2020, it is getting changed. Now he will go for renewal. So original period में 2 years are pending, renewal 3 more. Original 2, renewal 3 more. Now it will not be 1 lakh. 1 lakh was when CPI was 120. CPI became 125. 100 say 125, so this is how many percentage? 4.16. They have taken a round of 4%. It's actually 4.16. They've taken a round of 4%. So 1 lakh की जगह ये 104 and 110 की जगह 110 plus 4%. It's coming as 114,400. These are the payments to be made in future, discounted as per the revised discount rate now, because remeasurement is as per point A also. So we get a new liability 490,589. This is the new liability. Now what is the liability in your books? What is the liability in your books? So day one you had calculated a liability 454. That was day one. Okay, interest accrued, you did not pay this year, closing. Beginning May, you paid something, then again interest accrued. So now at beginning it was coming 195,244. 195,244 is becoming 490. Because earlier renewal option was not taken, so based on that it was a lower liability. Now liability increasing, opposite effect goes in ROU asset. That's it. Okay, next one is lease modification. So lease remeasurement was, there's no change in contract, but expectations changed. But lease modification, there's a change in contract. There is a change in contract, that's a lease modification. Okay, now lease modification, how do I account? If there is an increase in scope by adding one or more ROU asset. If there's an increase in scope by adding one or more ROU asset, earlier it was 1000 square feet, I took 500 square feet extra. That's increase in scope by adding one or more ROU asset, and what they are charging is SSP accounted separately. So accounted like a new lease only, separate lease contract only. But if lease modification is not a separate lease contract, how do I account? If there's a increase in scope by adding one or more ROU asset, and what they are charging is SSP, is a separate lease contract. Now otherwise how do I account? How do I account? They're telling if there's a decrease in scope, area going down or lease term going down. If there's a decrease in term, area going down, imagine out of 1000 square feet, 500 given back. So half ROU asset remove, half lease liability remove. Half ROU asset remove, half lease liability remove, difference goes in P&L. If there's a decrease in scope, what do I do? Decrease the carrying amount of assets, similarly liability, difference goes in P&L. And for all other lease modification, which are not accounted separately and which are not decrease in scope, उसके अलावा कोई भी है, like anything else, like the rate changed up, down, वो lease rental वाला. In that case, what do you do is lease liability going up and down, opposite effect comes in ROU asset, there is no profit or loss. There's no profit or loss. Like in this question, after 7 years, what did they do? They extend the lease term by 4 years. Okay, now there's an increase in scope. Is it by adding one or more ROU asset? No. ROU asset is same. So it doesn't fall there. Is there a decrease? No. So it falls under other lease modification. You remeasure it, automatically difference goes in ROU asset. Next, if you just check question number 41, out of 5000 square feet, we are giving back 2500. Okay, so there's a decrease in scope. Half ROU asset goes away, half lease liability goes away, difference will go in your P&L. Next, 42nd. If you check out 42nd, the rentals are reduced from 1 lakh, the rental reduced to 95. Is there a decrease in scope? Scope reduced nahi hua hai. Area or term is not changed, just rates are changed. So what do? You remeasure it. Basically, over here the new lease liability will find out, opposite effect comes in ROU asset. Achha, one more thing, under lease modification, the revised lease liability is always as per the revised discount rate. Under lease liability, under modification, remeasurement may for A and B revised discount rate, for C, D original discount rate, but under modification always revised discount rate. Okay, check next question, 43rd one. Two things are there. One, there's a decrease in scope. How there's a decrease in scope? The term is reduced from 10 years to 8 years. And there's another lease modification also. We are taking some extra space. But for that the payment is not SSP. So it doesn't fall under separate accounting. It will come under other lease modification. Two things are there. Decrease in scope bhi hai, other lease modification bhi hai. Now for decrease in scope, what do I do? Decrease in scope is basically when? Kab ho raha hai ye? After how many years? Beginning of 6th year. Okay, the first of all, originally whatever you had to pay, you find out present value, that was your lease liability. So whenever this modification is there, first try to find out what is the lease liability, what is the ROU asset in your book today. Aaj kya hai? Start with first, what is lease liability on day 1? So lease liability on day 1. Initial calculation, it was 735,900 on day 1. ठीक है, now let's find lease liability today in your book. Okay, that was 735,900, interest accrued, we paid 1 lakh closing. That way in beginning of 6th year, lease liability 421. And ROU asset 735, depreciated over 5 years. Now beginning is this. So this is lease liability ROU asset today in your book. ये today है now. Now beginning of 6th year, the term is reduced to 8 years. So can I say this ROU asset for remaining 5 years था, 5 की जगह only 3 रहेगा. तो 2 years का ROU asset goes away. तो ROU asset 2/5 goes away. ROU asset 2/5 goes away. Lease liability you can't say 2/5 goes away. ROU asset 2/5 because ROU asset was coming annually equal only. वो 2/5 goes away. Lease liability you cannot say 2/5 goes away. Whatever was lease liability payable in 9th and 10th year. वो 9th and 10th year वाला जो lease liability था उसका present value वो that goes away. Now 9th and 10th year it will not come. So ROU asset that much goes away, lease liability accordingly you calculate it, and difference will go where? The difference will be going कहाँ पे? अच्छा, तो if I just check over here, ये original table से आपको पता चलेगा this two goes away. Now this two is not to be paid. Originally which was basically calculated 59,200, 55,500, but now actually ये pay नहीं करना है. But now we are not here. We are not at this stage. We are at this stage, beginning of 6th year. We are at beginning at 6th year. अच्छा, तो this was payable now after 1, 2, 3. अच्छा, तो what was payable? We are at beginning of 6th year, right? So what was payable at beginning of 4th year के 4th year end 1 lakh not payable now. 6 से 4 years is 9 year. And 5th year end 1 lakh not payable now. 4th year end 1 lakh not payable now. 5th year end 1 lakh not payable now. So that is how it is to be done. Or else I can understand now I have to pay 1 lakh next year, 1 lakh next year, 1 lakh next year. That's it. So what should be the liability? So what they have done is, if you just check out over here, this due to decrease in term, this much liability not to be paid. This is based on original discount rate. Now, the remaining liability, they measured it from 6% to 7%. So this is basically due to remeasurement of remaining liability from 6 to 7%. And then additional space ka we have to pay extra, that is added. So we started with 421. 2-year term gone. उसके लिए the lease liability goes away. 6 to 7% we are doing, उसमें lease liability is reducing, and additional space taken, उसके लिए we have to make payment, lease liability increasing. So this is now the revised lease liability. Revised lease liability 393,600. Revised lease liability is 393,600. Okay, तो पहले जो था ना ये वाला, उसमें ROU asset goes this much, this goes, difference goes in P&L. फिर 6 to 7% is just a remeasurement, वो जाएगा ROU asset में opposite effect. Additional space taken, it's a other modification that will be adjusted in ROU asset. This two will be same. But यहाँ पे 153, यहाँ पे 147, the difference has gone in P&L. Are you clear? Are you clear with this question? Important one. Okay, next, moving ahead, presentation. How does that appear in your balance sheet? ROU asset will appear in your balance sheet under your separate heading is there, ROU asset, separately from other assets. Lease liability also, there's a separate heading on the face of balance sheet itself. P&L mein, the depreciation on ROU asset will go. On your lease liability, there will be interest expense. Cash flow mein, whatever you're paying, the lease liability is treated as a loan. Whenever you pay that, usme interest portion, principal portion, they come under financing activity. The lease liability, when you pay, it's a financing activity. Achha, if it's a short-term lease or a lease of low-value item, and we did not account as per 116, so we account as and when rent is paid, then they will come under your operating activity. Achha, variable lease payment, which will not included, variable lease payment, which are not included as a part of lease payments. So that whenever I pay, they will be accounted as and when they are paid, they will go in your P&L, they as such come in your operating activity. This is in the books of Lessee. Are you clear till now? I want answers from everyone, please. Next, going to lesser accounting, books of lesser. Okay, in the books of lesser, first of all, the lease is to be classified as a finance lease or operating lease. Lessee की book में no classification, lesser's book it is finance lease or operating lease. Accounting will depend based on whether it's a finance lease or operating lease. Now, finance lease is a lease where substantially risk and reward relating to ownership is transferred. Operating lease is a lease where risk and reward relating to ownership is not transferred. Okay, if ownership goes at the end to lessee, it will be a finance lease. Lessee has a purchase option to buy at a lower rate, it will be a finance lease. Where lease term covers a major useful life, then it's a finance lease. Achha, present value of lease payment. Present value of lease payment substantially covers the fair value of asset. It's a finance lease. Asset is of specialized nature. Generally, it will be finance lease. If the lessee cancels the loss, what is happening? Lessee has to bear it. So then it's a finance lease. A lessee has an option to extend kind of for a very less than market rate. So it's a finance lease. These are some examples given where it will be a kind of finance lease. Okay, the first determine whether it's a finance lease or operating lease. Finance lease accounting will differ, operating lease accounting will differ. Now, there are key concepts. One they've written is gross investment in lease. Whatever lessor will be receiving, kya milega? The lease payments. What lease payment? Lease payment includes guaranteed residual value plus the UGRV. So, gross investment in lease. Iska present value is the net investment in lease. Iska present value will be the net investment in lease. Okay, fine. Now, how do I account for finance lease? How do I account for finance lease? Again, accounting is done started at commencement date. So, commencement date ko lessor will record a finance lease receivable. The lessor will record a finance lease receivable. Asset goes away from his book. Whenever you give on finance lease, asset goes away from your book. The finance lease receivable debit to asset. And so, finance lease receivable at what value? Net investment in lease. Simple words, whatever I had to receive including UGRV, uska present value. Uska present value. Achha sir, what about the initial direct cost? Initial direct cost you add it to the finance lease receivable. Initial direct cost ki entry, finance lease receivable to bank. The finance lease receivable will go up. Later what we are getting, it gets adjusted in IRR calculation. It gets adjusted in IRR calculation, automatically gets split. ठीक है. Subsequent measurement. So we have booked basically finance lease receivable at its present value, interest accrue, we receive something, closing. Interest accrue, we receive something and closing. Achha, any variable lease payment which were other than rate and index not included here, they will be going in your P&L as and when they get accrued. Fine. Moving ahead. Now, finance lease receivable which you have booked, it's nothing but your net investment in lease, that was your finance lease receivable. It's not remeasured. Usko remeasure nahi karte unless the lease is modified. Unless the lease is modified or lease term is changed. Unless the lease is modified or the lease term is changed. Now, there's a change in UGRV. I told you booked a finance lease receivable at whatever you had to receive. Lease payment included your GRV plus मैंने आपको बोला था UGRV, whatever I have to receive उसका present value was taken. So if there's a change in UGRV, how do we account? Pay attention to this question, good one. Pay attention to this question, good one. Annual lease rentals are 5,000, lease period is 5 years, guaranteed residual value nil and UGRV was 4,000. The present value of lease payment plus UGRV was 20,000 at beginning. Okay, the 20,000 tha, interest accrues, we receive 5,000 closing. That way it was there and last mein 4 bachega, which is UGRV. Now they say if UGRV is reduced to 3,000, when? Third year end. Third year end. I want to ensure third year end the UGRV is changing. Now at the end I don't want 4, I want 3,000. And we are standing here third year end. So can I say after 2 more years? After 2 years, I'll get 1,000 less. Oh, after 2 years, I'll get 1,000 less. 1,000 I'll get less after 2 years. Uska today's value. Uska today's value is coming 790. That's a loss to be booked now. That's a loss to be booked now. Do one thing. Adjust it in this interest income. Yahan pe adjust kar do. After 2 years, 1,000 I'll receive less. So today's value is 790. We are standing at the end of third year. So it will get adjusted over here, yahan pe, and then automatically effect will come up. Okay, the checkout theory. So you need to review the UGRV. If there's a reduction, the lessor shall revise the income allocation. The income allocation revise hoga and recognize immediately any reduction which is there. So 1000 ka reduction. Okay, after 2 years 1000. The today's value will be 790. Book that 790 extra automatically gets reduced over 2 years by way of income allocation may change. Fine. How do I account for operating lease? Okay, if at all lessor gives a asset on operating lease, asset remains in lessor's book. Finance lease mein asset was going out, here the asset will remain in your book. The lessor shall present the asset in their balance sheet. Asset remains in your book. Now sir, whatever income I'm getting, rentals I'm getting, rental you book it how? On SLM basis or other systematic basis. You record the lease rentals as income on SLM or other systematic basis over the lease term. And initial direct cost, you defer it over the lease term. Initial direct cost, you defer it over the lease term. Fine. So it's not basically like over here. If I see the rent is 5 lakh per annum and the lessor will charge escalation at 2%, general inflation 7 doesn't matter. So 5 lakh tha plus 2%, it gets 20%, sorry, 20% gets increased. So now total I'll be getting this 3720. And benefit का कोई pattern नहीं है, take it SLM. So this should be divided by 5 SLM. So I will be booking rental income 744 every year. But for the first year I received 5, remaining is deferred. Second year I booked 744, I received 6, remaining deferred. Third year 744, I booked 720, I received deferred. Automatically ये reverse हो जाएगा next years में. That is how you need to do it. Okay, moving ahead. Manufacturer or dealer lessor. Manufacturer or dealer lessor. Okay, if it's a finance lease, can I say asset goes out from your book? But yeah, you are a manufacturer. For you, car is not an asset, it was your inventory. Car is not an asset, it was your inventory. So you will record sales. Ab credit kya karoge? Sales. Ab credit kya karoge? Sales. Now sales should be recorded at what value? Normally, finance lease receivable is at what value? Whatever we have to receive, present value of lease payment plus the present value of UGRV. But sales mein UGRV can't be taken. So do one thing, present value, finance lease receivable will be, the finance lease receivable will be your present value of lease payment plus present value of UGRV, but sales may I cannot take UGRV. So present value of lease payments, that only I'll be taking, this I'll not be taking. So they've clearly given over here, you will book a revenue should be lower of the fair value or the present value of lease payment, UGRV cannot be taken. Okay, now UGRV have not taken. Now the thing is, inventory gets converted into COGS. आपका inventory चला गया, cost में आ जाएगा. तो cost of goods sold to inventory will be another entry. Cost of goods sold to inventory as such is cost. But do one thing, you're not basically booked a revenue for UGRV, remove that much from your COGS. So remove that much from your COGS. So ये actually this two entry match होना चाहिए, but UGRV was not taken. Now your inventory goes away, COGS comes in. Rather than having 1 lakh minus whatever was present value of UGRV not taken in revenue, deduct from cost. I hope this is clear. And now one more thing, for this manufacturer, dealer, whatever is initial direct cost, it goes in P&L, it's a selling expense. For manufacturer, dealer, initial direct cost is P&L as selling expense. Achha sir, what if it was an operating lease? If they gave it on operating lease, the asset remains in their book, but now don't show as inventory, convert into PP. The asset remains in their book, but it gets converted into PP, and now it's an operating lease. Whatever lease rentals I'm getting, that will be booked. That will be booked either on SLM basis or other systematic basis. Thank you. This question we did. Okay, question number 53. Question number 53 is similar to the earlier one. It's okay. See again, in lease receivable, present value of lease payment plus UGRV both, but in your revenue, I'll take only the lease payment. ठीक है. Initial direct cost should be taken to P&L. I can account it separately also. इसको अलग रख सकते हैं. Now your inventory goes away. 1 lakh. But in your COGS, I'll not take 1 lakh. 1 lakh minus the present value of UGRV. Plus initial direct cost, PNL to cash, they have included here. So CO cost of sales में ले लिया, ये PNL to cash. Okay, next one, lease modification, books of lessor. Lease modification, how do we account in the books of lessor? So if at all there is an increase in scope by adding one or more ROU asset, and what we are charging is SSP for it, it's accounted as a separate lease. It's accounted as a separate lease. But if it is not a separate lease, how do I account? If it's not a separate lease, how do I account? Now, if it would have been classified as operating, had this change happened on day one, okay, so currently it's a finance lease. If that change would have happened on day one, it would have been an operating lease. So operating lease hota, so we would have the asset only in our book. But currently we have a finance lease receivable. So convert that finance lease receivable into asset. That's it. The balance of finance lease receivable will get converted into PP. That's it. अच्छा, operating lease में modification. तो ये finance lease, but if that modification was there day one, it would have been operating lease. If day one only it would have been operating lease, we would not have booked a finance lease receivable, we would have continued with PP. So do one thing, now whatever is finance lease receivable, convert it into PP. And now onwards follow basically your accounting as per operating lease. Acha, operating lease modification. Operating lease modification में you should account it like a new lease. तो account operating lease में modification हो ना, whatever payments are to be done, account it like a new lease. अच्छा, जो previous deferred में something is pending, consider that into consideration while allocating how much revenue should be booked every year. तो now onwards I have to pay this. अच्छा, previous में deferred इतना पड़ा था, now you adjust it and then you find basically the revenue to be booked every year. Fine, moving ahead. Presentation. That is okay. Finance lease hoga, finance lease receivable will come under your financial asset. Operating lease, the asset comes under your book only. PP, so machine PP, land building comes under investment property. Sublease. A Limited has given on lease to B, B has given on lease to C. How do we account? Okay, A is a lessor. A has lease to B. A's ka accounting will depend whether it's a finance lease or operating lease. If it's a finance lease, you will book a finance lease receivable. If it's an operating lease, asset continues in A's book. So A mein, it's like a lessor. C is the ultimate lessee. So C Limited will account like a lessee, ROU asset to lease liability. Question comes of B. Question comes of B. B is a lessee as well as lessor. B is a lessee also and lessor also. Acha, the first as a lessee, B Limited will record ROU asset to lease liability. As a lessee, B will record ROU asset to lease liability, and then you're given on lease. If it's a finance lease, that ROU asset goes away, finance lease liability comes in. What goes away is your ROU asset. You give that on. If it's as a lessor, if it's a finance lease, ROU asset goes away, finance lease receivable comes in. If it's an operating lease, ROU asset remains in your book. Did you got it? The only difference comes in B's book. That's it. Baki A is just a lessor, C is just a lessee. B is a lessee as well as lessor. As a lessee, I'll pass the entry ROU asset to lease liability. Now I'm further giving it. So if it's a finance lease given, the ROU asset goes away. And finance lease receivable comes in. And if it is an operating lease, ROU asset will continue in my book, and operating lease ka jo income I'll get, either it's booked on SLM basis or other basically suitable basis. Fine, moving ahead. Sale and lease back transaction. Sale and lease back transaction. I'm selling an asset and taking it back on lease. Acha, मैंने बेचा and then again I take back on lease. That's called as a sale and lease back. I need to first of all see whether control is really transferred or not, because rent came back to me. So if basically control is not transferred, so I don't record a sale only. Gone, then came back. If control is not transferred only, don't record a sale only. But if control is transferred, I'll record a sale separately and then I took it on lease separately. If control is not transferred, don't record a sale. So, sir, what do? I got the money. What do? I got the money. You record it as a financing arrangement. You record it as a financing arrangement. If control is not transferred, you don't book a sale only. You got money, treat it as financing arrangement which you are repaying over a period. Achha, if control is transferred, you'll record a sale also, and then you'll book basically lease transaction separately. Fine. So if it is a sale, you derecognize the asset, asset goes away. You derecognize the asset, asset is going away. Fine. You got some money, bank debit, and now you're taking back on lease. If you're taking back on lease, to pay attention. Lease pe le rahe ho. If it's a finance lease, you record, finance lease, operating lease doesn't matter in lessee's book. You're taking on lease, you're a lessee, ROU asset debit to lease liability. Now, ROU asset should be based on previous carrying amount of the asset retained. Oh, ROU asset कैसा होना चाहिए? Previous carrying amount of the asset retained. ठीक है. And then the gain loss will be related to the portion which is actually transferred. Because when I sell it to you, I take it on finance lease, I book a ROU asset. Can I say part asset is coming back to me? So for the portion retained, ROU asset booked, previous carrying amount. And for the portion basically transferred, I'll have the profit loss coming. Okay. If it is not a sale record in you, I got money, it's a financing arrangement. That was fine. Acha, one more thing. Suppose sale and lease back, the transactions are not at market terms. Now, suppose I sold you at a lower rate. Now, why I'll sell you at a lower rate? It will get compensated by lower lease payment. I sold you at a lower rate, but then I'll pay lower lease rentals. So indirectly, if I'm selling you at a lower rate, later I have to pay lower lease rental. Later I'll be basically having a lower lease rental. So it is indirectly treated as lease rental paid in advance. It will get compensated by lower lease payment. It will be accounted as if it's a lease rental paid in advance. So sales you book not at 90, sales you book at 100 only. But bank is 90, extra 10 is a lease rental paid in advance. Okay, suppose I sold at 110, you paid me more, I have to pay more lease rental. I cannot record sales at 110. Sales will be recorded at 100 rupee only. So extra 10, I treat it as a loan coming from you. And that basically I'll pay by way of higher lease. तो उसके अंदर से in that lease payment something is towards the loan repayment. So above market terms are additional financing provided. Instead of 100, you paid me 110. Why you paid me 110? I'll pay more lease rental. So sale is 100 only. Extra 10 आपने loan दिया है. In that lease rental repayment, 10 वो loan का repayment is also happening. Fine. Check question number 60. If we check over here, entity sells a building to another entity for cash 30 lakhs. Okay, 30 lakhs. Fair value is 27. So can I say indirectly you are paying me 3 lakh more? It will get compensated by more lease payment. The extra 3 lakh will be treated as a financing arrangement. I took a loan from you. And whatever payments I'm making, उसमें से something is towards loan payment. Fine. Cost of building in your book is 15 lakh. And lease rental now will be 2 lakh every year for 20 years. If I find the present value, it's coming total 1494. But in reality, out of 1494, 3 lakh is towards loan. 3 lakh is towards present value of loan repayment, and remaining is present value of lease rental. So lease rental is 1194, 3 lakh present value is for the loan payment. Loan ka present value आज 3 lakh है ना? That's why. ठीक है. तो 3 lakh was the additional financing. Okay, so day 1, if I see the accounting, cash debit is 30. Okay, loan will be booked as 3 lakh. Lease liability 1194, which I have to pay for lease rental. So out of total 1494 which I have to pay, 3 lakh is for loan. Acha, building goes away from your book carrying amount. Now ROU asset will be debited. ROU asset will be debited. Acha, as such, ROU asset gets debited by 1194. So ROU asset to lease liability, as such it's 1194, but I have to record at previous carrying amount. Previous carrying amount पे record करना है. अच्छा, तो previous carrying amount I want. Fair value 27, cost was 15. So fair value 1194, cost is how much? Fair value 27, cost was 15. उसमें 1194 कितना? तो 66333 is the carrying amount retained. I'll record ROU asset at that value. And difference is gain. Gain will be basically for the portion transferred. जो transfer हुआ है उसके related का gain I am booking. Okay, let's pay attention. If full fair value was transferred, 27 lakh you transfer, gain would have been 12 lakh. Carrying amount 15, sold for 27. Extra 3 lakh was loan. So if full fair value transferred 27, gain is 12. But out of 27, can I say 1194 is coming back? So 1506 is transferred. So fair value 27 transferred, gain is 12. So 12 into 15.06 divided by 27. This is coming as 669333 to 669333. Clear? Only on the portion transferred the gain is recognized. For the portion retained, ROU asset not at fair value, ROU asset is at previous carrying amount. Okay, next last point of this chapter is transition. Whenever we are shifting from basically whenever we are shifting to IND AS 116. Now see, earlier we had basically under AS, it's AS 19. Under AS 19, treatment is different. Now you shift to IND AS 116. Under AS 19 for lessee also. AS 19 mein lessee also we need to have whether it's a finance lease, operating lease. If it's a finance lease, you book an asset in your book. If it's an operating lease, in lessee's book, there was no asset. AS 19, if it's a operating lease, no asset in lessee's book. But under IND AS 116, whether it's an operating lease, finance lease, we book a ROU asset. So whenever I'm shifting, what do I do? That's called as transition. They've already given. One is called as a full retrospective approach. Full retrospective approach means you apply IND AS 116 from very beginning, as if IND AS 116 was applied from very beginning. If from day one only IND AS 116 was applied, what would be the liability on the date of transition? Transition is previous year beginning. ठीक है, so on the date of transition, what would be the liability? With that you start recording. And what would be the ROU asset on the date of transition? Difference goes in retained earnings. अच्छा, तो you apply 116 as if you were following 116 from very beginning. The day when asset taken on lease, from that day only you had followed 116. That is called full retrospective approach. But how entries कैसे होगी? Entries will be done previous year beginning, transition date पे. तो if IND AS 116 was followed from very beginning, lease liability day one, फिर you do interest accrued, payment done, what would have been previous year beginning? You record that. Same way ROU asset on day one, then depreciated, what would be previous year beginning? You record that. Difference goes in retained earnings. Achha, second is a modified retrospective approach. Under modified retrospective approach, I'm not telling you to go that much back. अब एक वो difficult होगा. तो I'm telling you one thing. Now, whatever you have to pay, अब जो आपको pay करना है, how to find lease liability, whatever you have to pay, now onwards, from the date of transition, whatever you have to pay, उसका present value. Whatever you have to pay, उसका present value is the lease liability. Okay, so over here, under modified retrospective, a lease liability is present value of remaining payment to be done and discounted using today's discount rate. If I was applying from full retrospective, I would have discounted by the discount rate going on at the time of inception of contract. But यहाँ पे whatever is remaining lease payment to be done, उसका present value based on today's rate. Okay, ROU asset. How do I find ROU asset? ये lease liability मिला. ROU asset, two option. One. If 116 was followed from very beginning, what would have been the ROU asset today, but based on today's discount rate? Okay, if 116 was followed from very beginning, what would have been the ROU asset today? But the thing is, only thing is you take the discount rate based on today's discount rate. Or this is one option. Or second option is you take ROU asset equal to lease liability. The majority people went for this modified retrospective. उसमें भी ये second वाला. So lease liability is whatever I have to pay now, uska present value. Whatever I have to pay now, uska present value at today's discount rate. And whatever is lease liability, same amount, ROU asset. Achha, if I go for this thing, there's no difference coming. But if I go for this thing, ROU asset में, यहाँ पे ये alternative one ले रहा हूँ. ROU asset is, if from very beginning IND AS 116 was applied, considering today's discount rate, so what would be the ROU asset? If I take that, the difference will go in retained earnings. Okay, check question 61. It's okay, not important. You can do on your own. That's it. This is your chapter of IND AS 116 leases. Moving on to financial instruments. We'll finish financial instruments, then break, and then the remaining two topics. We'll finish financial instruments, then we'll take a break, and then the remaining two topics. Any doubts? Anybody till now? Keep replying, keep on having water, pay attention. Thank you. Chalo, let's move ahead. Chapter number 11 is financial instrument. There are so many units over here. Okay, first of all, we have unit number 1 and 3 together. We are doing unit number 1 and 3. Unit 1 is scope and definition. Unit 3 is equity and financial liabilities. First of all, what do you mean by the word financial instrument? It's a contract. Financial instrument is a contract which gives rise to a financial asset to one party and financial liability or equity to another party. So it's a contract, one party के लिए financial asset, another party it's a financial liability or equity. Okay, so only if something is contractual it falls over here, something which is not contractual doesn't fall over here. Financial instrument can be primary instruments, receivable, payable, equity shares, etc. It can be derivative also. Futures, forward, options, swap, both it can be there. Now, what do you mean by the word financial asset? We saw the definition of word financial instrument. Now, financial asset is any asset. Financial asset is any asset that is cash, any currency, bank balance is also fine. Bank balance is also fine. Or equity instrument of another entity. You have an investment in equity. Or a contractual right to receive cash or financial asset from another entity. Or a contractual right to exchange financial assets and financial liability with another entity under the terms which are favorable. Okay, I have a contractual right to exchange financial assets, financial liability. Okay, I am going to give you cash. You will be giving me shares of Reliance. Cash is also financial asset. Shares of Reliance is also financial asset. So contract, basically it's what? It's a contractual right to exchange financial assets, financial liability under the terms which is favorable. If that terms are favorable to me, then that contract is a financial asset to me. So I have to give you 100 rupee cash, you will give me one share of Reliance. Reliance ka share currently suppose is 120. So मुझे 100 ही देना है, but I'll get a share of Reliance worth 120. It's favorable to me. So then that contract, even though it's not yet over, it will be a financial asset to you. D point doesn't come, it's basically not applicable in India. Okay, so your debtors, they are financial asset, then your loan which you have given, investment in equity, investment in debt, they all will be coming under financial asset. Have a contractual right to receive cash and cash equivalent. Achha, if there's a contract to exchange financial asset or liability and it's a favorable to me, then that is also a basically financial asset. Okay. Now prepaid expenses, it's not financial asset because whenever I prepay the expense, I don't have a contractual right to receive cash. I have a contractual right to receive goods or services. So inventory, PPE, ROU asset, intangible, prepaid expense, they are not financial asset. Inventory, till it is sold, I don't have a contractual right to receive cash. Once sold, debtor may have a contractual right to receive cash. Now, what's a financial liability? It's a contractual obligation. It's a contractual obligation to deliver cash or other financial asset to another entity. It's a contractual obligation. Same way. Or a obligation to exchange. If I have a contractual obligation to exchange financial asset or financial liability under the terms which are unfavorable to me. I told you earlier example, 100 rupee cash to be given, 1 share of Reliance is going to come. If 100 rupee cash to be given, Reliance ka share price is 120, so it's favorable to me. But 100 rupee cash to be given, Reliance share is worth only 80 only, that's unfavorable to me. Then that contract will be financial liability as of now. Contractual obligation to exchange financial asset or liability with another entity under conditions that are potentially unfavorable. Acha, third, a contract that will or may be settled in own equity shares. Okay, if at all you are settling in own equity shares, we have a fixed for fixed test. We have a fixed for fixed test, fixed amount to be received and fixed number of shares to be given, our own. Fixed amount to be received, fixed number of shares to be given, then it's equity. But if fixed for fixed test not satisfied, amount I'm getting fixed but number of shares to be given is variable, it will be classified as financial liability. Okay, the non-derivative, for which entity is or may be obliged to deliver variable number of equity share, or a derivative which may be settled other than by fixed amount of cash and fixed shares. The one which will be settled in fixed amount of cash, fixed shares, that's equity. Other than by fixed amount of shares and fixed cash, that will come here. Means if either amount to be received or number of shares to be given, anything is not fixed, it's a liability. Both are fixed, then only it's a equity. Fine, then what's the equity instrument? Under equity instrument, there's no contractual obligation to deliver cash or other financial asset. And there's no contractual obligation to exchange financial assets or liability under conditions which are unfavorable. And third, a contract which will or may be settled in own equity instrument. Acha, fixed for fixed status satisfied here. So no obligation to give variable share, means we have to give fixed share. Or a derivative which will be settled, fixed amount of cash and fixed share, which will be settled only by fixed cash, fixed shares, it comes here. Other than by fixed shares and fixed cash, that goes there. Fine. Now, there are a few exceptions to the word equity. Normally, puttable financial instrument, which you can put it back to issuer has to give back money. If issuer has to give back money, it's actually not equity, it's a liability. But certain puttable financial instruments, subject to exception, subject to condition, are covered under equity, like for mutual fund, open-ended mutual fund scheme, units of mutual fund, even though mutual fund people have a liability to give it back, so it's not treated as liability, still it's coming under your capital only. That's okay. Flowchart is fine. Preferences. How to classify the preferences? You need to see the rights attached to the shares. Okay, if it's a redeemable one, it's a liability, classified as financial liability. Okay, redemption at the option of holder, kabhi bhi wo karwa sakta hai, liability. Redemption at the option of issuer, whenever I want to redeem. So it will be classified as equity till that time you decide to redeem. Achha, non-redeemable one, it will be classified as equity. Achha, uska interest or dividend. If dividend is mandatory, that much portion will be liability. If dividend is also at discretion, then entirely it will be equity. Fine. Classification not affected by history of making dividends or intention. We need to see terms and condition. History kya thi, intention kya hai, that's not important. And most important under this unit number 1 and 3 is this compound financial instrument. Compound financial instrument have a feature of both financial liability and equity. They are compound, convertible debentures. Okay, so there's an option given. If they want shares, they can take shares. If they want cash, they can take cash. So that's compound financial instrument. They may go for cash, they may go for shares, I don't know. That's compound financial instrument. Fine. Okay, question number 3. Optionally convertible debenture. Option is given to holder. Holder may go for shares, holder may go for cash, I don't know. I'll account like a compound financial instrument. But option is with issuer. issuer, I will decide what I want to give. So see, you account, you know what you want to do. Other holder, what he will do, I don't know, but I want to do what I know. If I'm planning to give shares only, I'll treat it as equity only. But if I know my cash pada hai mere paas and I know I'll be giving cash, then you treat it as liability fully. So classify entirely as equity or liability depending on what you want to do. If option is with issuer. This question, issuer has an option. Issuer has an option, so you need to classify either entirely as a equity or entirely as liability depending on what you want to do. Fine. Okay, question number 7. Question number 7. Entity B writes an option contract for sale of shares of Target Limited for a price of 100. Acha, I'll get 100 rupees. I'll give one share of Target Limited. Okay, I have to give equity shares of other company. Khud ke nahi. So it's fine. It's a financial asset. Equity shares of some other company is a financial asset. Cash is also financial asset. It's a contract to exchange financial asset. It's a contract basically to exchange financial asset. Did you understood? Fine. And it's a contractual obligation to exchange financial asset. We will get cash. We'll give the shares of Target Limited under the conditions which is potentially unfavorable. This contract is exercisable anytime within 90 days. So if market price 120 hai, if market price 120, I'll get 100, I'll have to give the share of Target. Market price 120 hai, but I have to give it 100. So it's unfavorable, it will be a financial liability. It's a contractual obligation if karke likha, if market price is already 120. The terms unfavorable to me, 120 wala share, I have to give it 100. It's a contractual obligation to exchange financial assets under the terms which are unfavorable. It's a financial liability for you. Now, convertible preference shares are there. If they convert in this year, for every one share, if they convert, this time it's 1.5 to 1, this time it's 2 to 1. Okay, different conversion rate at different period of time. Different conversion rate at different period of time. This is fixed for fixed test satisfied because time is certain to elapse. So ये fixed for fixed test is satisfied. It will be equity. Okay, next. Question 13. Acha, conversion 1.1 if a strategic investor invests within 1 year. Conversion 1.5 is to 1 if IPO comes up within 2 years. Conversion 2 is to 1 if binding agreement is basically happening. So here the conversion ratio is different for different independent situation. If conversion ratio different only for time basis, वो fixed for fixed satisfied. If conversion ratio is different for different independent situation or condition, then fixed for fixed test is not satisfied. Just a minute. Yeah, fixed for if conversion ratio is different for different independent situation or condition, तो fixed for fixed satisfied. Achha, different independent condition. But if you check over here, either this can happen or this can happen or this. If this doesn't happen in 1 year, ye chala gaya. Then IPO wala. So these are independent thing, independent situation, independent option, fixed for fixed satisfied. But if one happens, other cannot happen, then in that case, fixed for fixed not satisfied. Check question 14. Check question number 14. If strategic investor invested USD 100 million, यहाँ पे USD 150 million, ये 200. Now you see someone invest here, so can I say this cannot happen only? So here it's not independent, it's interdependent. Here it's not independent, it's interdependent. So this will be classified as a liability. So independent, different situation, different conversion ratio chalega. Independent, different situation, different conversion ratio. But here it's not independent. If this valuation at 100 million someone invested, this and this is not possible only. Okay. Now, point, this is important. Imagine, suppose we entered into a contract after 1 year. I will be getting $100. I have to give 5 shares of mine. Acha, so I have to issue my own shares. but amount to be received $100. This fixed for fixed test satisfied. $100 I'll be giving 5 shares. Okay. The number of shares to be given fixed. Amount to be received fixed but in dollar terms. So is fixed for fixed test satisfied? So India may yes. IND AS may they say yes. So they classify it as equity. But under IFRS they say no, they classify it as liability, telling ये dollar में है. In basically local currency term, it's not fixed. So we take it as fixed for fixed test satisfied. They are taking it no. So check out. Equity conversion option in a mandatorily foreign currency convertible bond to acquire a fixed number of shares is classified as derivative financial liability if the exercise price is fixed in foreign currency. This is as per IFRS. यहाँ पे चलेगा, India में it is fine. So if it is fixed in any currency में amount $100, number of shares 5, so can I say fixed for fixed is satisfied? India में yes, it will be a equity. Under IFRS it will be a liability. Okay, question on this is fine. Okay, how do I account for a compound financial instrument? Compound financial instrument are two things, liability component, equity component. Now how do I find the liability component? Whatever we have to pay. Generally when it's a convertible debentures, the rate of interest will be a bit lower than the market because I give you a conversion option. So whatever we have to pay discounted by the normal market rate, that's a liability component. Remaining is equity component. So find out the liability component. Remaining is equity. Liability is nothing but whatever we have to pay discounted by a normal market rate which does not have a conversion option. So without having conversion option वाले का rate कितना है? That will be generally higher. We are paying 6%, without conversion option at 8% interest. So whatever we are paying discounted by that 8%, whatever present value comes, that's liability. Difference is your equity component. Fine. And no gain loss comes on initial recognition on day 1. Deferred tax is okay. Or 18th is fine. 19th important. On 1st April 1, 8% convertible loan 6 lakh rupees is given, redeemable after how many years? 4 years. April 1, March 5. Alternatively, it can be converted into equity shares, optionally convertible hai. Without conversion wala rate will be 10%. See, ours is 8. So whatever we have to pay, 8% के हिसाब से 6 lakh into 8%. So we have to pay 48 and again 4th year में 6 lakh. So 48 and 648 discounted by 10%. The present value is the liability component. Remaining is equity component. Now day 1 bank debit, you got 6 lakh. Liability is 560, equity is 39,777. Equity will remain same. Liability में every year interest accrues. We pay 48. Interest will accrue based on 10%. So 560, 022, interest accrued 10%, we paid 48 closing. Again interest accrued 10%, we paid 48 closing. Again interest accrued 10%, we paid 48 closing. That way it will work. And suppose last May if they go for cash, so liability is paid off, equity not required, transfer it to retained earnings. If they go for cash, liability will be paid, equity not required, transfer to retained earnings. Achha, if they go for shares, liability component, equity component, both gets converted into equity share capital or securities premium. ठीक है. Now question number 20, word optionally is not written. And they clearly said they are redemption at 10% premium to the extent of 50%. The 50% have to pay in cash, 50% will be shares. I have to pay interest and 50% only have to pay in cash principal with 10% premium. So check out liability component में principal 50% to be paid at 10% premium. And interest, so we get liability component 2821 and total we got 50, so equity is 2179. That was the only difference here. Now conversion, I told you if at all they go for cash, liability paid, equity component gets transferred to retained earnings. If they go for conversion, both the liability, equity, both gets converted into securities premium, equity share capital. Did you understand? यहाँ पे if you just go down directly last में whatever is liability, whatever is equity gets converted into equity share capital, securities premium. Okay, early settlement of compound financial instrument. Good. Early settlement of a compound financial instrument. If I settle compound financial instrument early. Okay, so day one when I received money, part was for liability component, part was for equity component. Now when I'm settling, when I'm paying, can I say part is for liability component, part is for equity component? So at the time when we received, amount received was bifurcated into liability component, equity component. Same way, when I settle, when I pay them early, you need to bifurcate how much towards liability, how much towards equity. Reason, I paid something for liability, something for equity. Now difference, what was the liability component and how much I paid, difference goes in P&L. And for equity, what was the equity component, how much did I pay, the difference goes in equity wahan pe. Now how to find out how much I paid for liability? How to find out how much I paid for liability? Liability के लिए कितना पे किया? Liability पे कितना पे किया? तो very simple. Whatever I had to pay in future. See, if I'm not settling today, can I say I have to pay in future? Whatever I pay in future, उसका present value at today's discount rate. If I'm not settling today, I have to pay in future. Whatever I have to pay in future, उसका present value at today's discount rate, that is amount paid for liability. Balancing is amount paid for equity. ठीक है. तो check question number 22. Optionally convert. Day one I bifurcated. Out of this, equity is 149. 1650 888 was the basically your liability component. Okay, journal entry is not there. Fine. Now later on what had happened, there's an early redemption taking place 20 lakh on 30th September 2020. Normally it was 21. 17 से 4 years is 21. एक साल जल्दी पे कर रहा हूँ. अच्छा, if I had not paid now, I have to pay next year what? अगर मैंने अभी पे नहीं किया होता तो what would have been the amount to be paid in future? The amount which I have to pay would be 10 lakh plus 60,000, 1060. If I'm not settling today, I have to pay next year my interest and principal. बस 1 year only left. उसका present value is 10,09,523. So this much is towards your liability component. Balance is towards equity component. The towards liability component is that I paid total now how much? Remaining will be for equity component. That way you need to do it. Achha, actually this is for the next question. For this one, here. Fine. Amount, just ignore it because this is not for this question. This was for some other question. But you understood whatever I have to pay, uska present value. If I just try to see what I had to pay. Option, they are convertible at 4 years. 18 lakh, uska 5.5%. I had to pay 99,000 plus 18 lakh. 99 plus 18 lakh, that would be payable in future. Uska present value will be the liability remaining. 1899 to be paid. 1899. So next year 1899, uska present value, whatever is coming today, that much is the liability, remaining is for equity. Okay, question number 23, good one. Okay, question 23, good one. They already given the amortization schedule. Day one, this was liability equity. Day one, this was liability equity. Equity remains same. Equity remains same. On liability, interest accrues, we pay something, closing, interest accrues, we pay something, closing. So यहाँ पे now liability is 972. Now liability 972, and there's some prepayment happening. When I'm prepaying June 30th 23 यहाँ पे. So now only 1 year left. Now 1060 to be paid. 1060. What is towards liability? If I had not paid today, I had to pay 1060 after 1 year. उसका present value. Okay, so 10,09,523 is for liability out of 11. Out of 11, that is for liability, remaining is for equity. So check, out of 11, 1009, 523 is for liability, remaining is for equity. Now what do you paid for liability? 1009, liability in books is 972, extra paid debit P&L. So liability mein what it was, what you are paying, difference goes to P&L. For equity component, what it was, what you are paying, difference goes in equity. That's the only thing. Next, moving ahead. Amendments to the terms of convertible instrument. If the terms of convertible instruments are amended to induce early conversion, we may do a change in terms that goes to P&L. We may do a change in terms that goes to P&L. Question is fine. Now, interest, dividend, losses and gains. See, if it's a financial liability, interest paid, dividend paid, any loss gain coming, all goes in P&L. If it's equity, uska dividend paid will come under kahan pe? Equity mein, retained earnings mein directly, other equity. तो उसका interest paid, dividend paid और उसका gain loss goes directly in equity. अच्छा, transaction cost. For equity, the transaction cost is deducted from equity. अच्छा, if it's a compound financial instrument, the transaction cost is to be allocated between the equity and the liability on the proportion. Whatever, first of all, we found the proportion. In that proportion, you allocate the transaction cost. And once the transaction cost get allocated, equity wala gets deducted from equity, liability gets deducted from liability, automatically effective interest rate will change. Effective interest rate will increase a bit. Okay, check this question, 26, 2 times asked, important. There's a compulsorily cumulative convertible preference share. So can I say principal portion is equity? Compulsorily convertible. Only the dividends which you have to pay mandatorily, they are your liability. Okay, so when we found out the liability component, only dividend portion was taken. So liability is 502, total we got 15 lakh, equity becomes 997. Okay, so can I say this is 502, this is 997. Now there's a transaction cost 30,000, allocate in this ratio. The allocation of transaction cost in this ratio, the allocation came this. Okay, related to equity, deduct from equity, related to liability, deduct from liability. So liability instead of 502, transaction cost got deducted, 492 it became. And now because it became 492, now effective interest rate changes. Effective interest rate will change. The effective interest rate, now it's not 15, it's 15.86. 15.86. Did you understood? That's the only difference. Other all things fine, same over here, no change at all. Scope, what is not covered under 109? Okay, what is not covered under 109? Contract to buy or sell non-financial item. Sorry, contract to buy or sell non-financial item which can be settled in net. जो net में settle होने वाले हैं. Contract to buy or sell non-financial item which will be settled in net. जो net में settle होंगे, that's covered under 109, but which will not be settled in net. Delivery होगी, that's out of the scope here. So check out contract to buy or sell non-financial item which cannot be settled in net, they are out of scope. Yes, is out of scope, they are not covered here. One which will be settled in net, that only comes under 109. Okay, check this question. I have this contract one, can it be settled in net? Can it be settled in? Yeah, but I need to check wo real mein settle hoga ki nahi. It can be. It can be. But if you see over here, there are 30% chances we take delivery. We take delivery, then it is out of scope, not covered under 109. अच्छा, यहाँ पे only 1% chance we take it, then this is covered under 109. Third में, they are mandatorily to be settled in net. They are mandatorily to be settled in net. They are 109. The first one, they can be settled in net. Instances of net settlement constitutes only 30%. What they've given? 30% time we do a net settlement, it's covered. Okay, यहाँ पे only 1% time net settlement happened. Every time it's delivery. Every time it's delivery, it's out of the scope. Third में पक्का net only, it is within the scope. Third में पक्का net only, it's within the scope. Offsetting a financial asset, financial liability, you should offset only when you have a legally enforceable right to set off, and you either intend to set it on net basis or basically realize assets, settle the liability simultaneously. The legal enforceable right required, and you intend to settle on net basis. This is unit number 1 and 3. Moving ahead, unit number 2. This is unit number 1 and 3. Moving ahead, unit number 2. Okay, coming to unit number 2, which is classification, measurement of financial asset, financial liability. Okay, so first of all, for financial asset ka classification, there are basically 3 things. Financial asset carried at amortized cost, financial asset measured at FVT OCI, financial asset measured at FVT PNL. So whether it's amortized cost, FVT OCI, FVT PNL depends on 2 things. 2 things. One, what is your business model? What is your business model for managing the financial asset? And the contractual cash flow, whatever are coming, assets will give you cash flow. The contractual cash flow ka characteristic. The business model, if the business model is to hold till maturity, if business model is to hold till maturity and the contractual cash flow which are coming, uska characteristic is such that they are solely for payment of principal and interest. So we want to hold till maturity, the cash flows comings are solely for payment of principal and interest, then it's measured at amortized cost. Acha, our business model is basically to collect the contractual cash flow and sell in between. Our business model is to collect contractual cash flow, sell in between, and SPPI test fulfilled, then it's FVT OCI. And one which doesn't fall above will go in FVT PNL. One which doesn't fall above will go in FVT PNL. Check out business model can be to hold till maturity or sell in between or just for the purpose of trading kind of it, that. Okay, iske questions are not relevant for exam purpose. Cash flow characteristic mein I need to check whether the amounts which I am getting are solely the payment for principal and interest. In a basic lending arrangement, you have time value of money, your credit associated with principal. तो वो सारी चीजें. This question is not relevant. Now, when do I classify it as amortized cost? Business model is to hold till maturity and the contractual term gives rise to basically the cash flows that are solely for payment of principal and interest. ठीक है, तो you want to hold till maturity, SPPI test fulfilled, both condition. Okay, when do I measure FVT OCI? The purpose is to collect contractual cash flow, sell off in between, and SPPI test fulfilled. And one which doesn't fulfill above, that will come under FVT PNL. Now, investment in equity. Investment in equity, SPPI test is not fulfilled. So normally investment in equity is FVT PNL, but we have an irrevocable option. Normally investment in equity is FVT PNL, but I have an irrevocable option to designate it as FVT OCI. Fine, moving ahead. Question number 12. Come to question number 12. I have an investment in subsidiary, investment in associate. So can I say investment in equity? Okay, can I have investment in subsidiary at FVT PNL and investment in associates at FVT OCI? So investment in PNL, usme I don't want irrevocable option, usme FVT PNL. But investment in associate, I want to go for irrevocable option, FVT OCI. Can I do that? Answer is yes. If you go for investment in subsidiary, FVT PNL, all subsidiary that way. If you go investment in associate, FVT OCI, all associate that way. So can you do that? Answer is yes. Okay, initial measurement. How do I measure the financial asset? So we understood classification. Now measurement. The financial assets are measured at fair value except the trade receivable. Trade receivables are at transaction price. So they are measured at fair value. Fair value. We already understood definition of word fair value under IND AS 113. ठीक है. Now, normally fair value will be the transaction price only. But if at all I have a transaction with a related party, वहाँ पे the transaction price may not be the fair value. So if transaction price and fair value are different, if transaction price, fair value are different, I'll record asset at fair value. I'll record the asset at which value? Fair value. What should I do with the difference? Imagine transaction price, fair value is different. Asset is at fair value. What do? Two bank is different figure. The difference, what do I do? If it's based on level 1 input or observable data is level 2, if it's level 1 or level 2 input, take it to P&L immediately. But if it is level 3 wala inputs used, unobservable data more, then recognize as an asset if it qualifies or amortize to P&L. If level 1 level 2 valuation tha, तो it goes directly to P&L. Level 3 है, it is basically amortized to P&L. ठीक है. Now check question number 13. You give a deposit, I'll get back the money, but it's interest free. Now normally rate going on is 7%. I give 1 lakh, I'll get back after 3 years. I give 10,000, I'll get back after 3 years 10,000 only. So uska fair value is the present value. The fair value is 8163. So fair value is 8163. The deposit given, it's a loan given to someone else. Don't take it 10,000. No. The deposit is 8163, but we paid 10,000. Difference, what do I do? The deposit was given for what purpose? They have given us some containers which are returnable. I'm using that container. It's treated as prepaid lease rental. It's prepaid lease rental which will be amortized over the period. यहाँ पे level 3 है, prepaid lease rental. अच्छा, second question. We granted a loan to someone at 10%, then incremental borrowing rate of old is basically 12, but I gave it 10, which is a treasury yield. Treasury yield is basically observable data available to everyone. So loan debit, so whatever we are going to get, discount it. Whatever we are going to get, discount it at 12%, normal market rate. So this is 111.28. So loan given will be debited 111.28, but I gave actually 120. So 2 bank is 120. Difference, it's a observable data, immediately goes to P&L. Achha, transaction cost are incremental costs which are directly attributable to acquisition or issue of financial asset or liability, uske related directly. What do I do with the transaction cost? Pay attention. What do I do with the transaction cost related to it? So if the financial asset or financial liability is designated as FVT P&L, so if it is carried at FVT P&L, transaction cost goes in P&L. If financial asset, financial liability is FVT P&L, it goes to P&L. If they are at amortized cost or FVT OCI, then in that case, what do I do? Then for transaction cost on financial asset, add it to asset. Transaction cost on financial liability, deduct from liability. So add it to asset, deduct it from liability. Okay, check this question. A Limited invested in equity shares of C. You invested in equity shares of C, 10,000 rupee. Transaction cost 500. ठीक है. On the 31st March, the fair value is 11,200. You're required to give journal entry. Now, if it is carried at FVT P&L, transaction cost goes in P&L. The record asset at 10,000. I'll record asset at 10,000. 500 goes in P&L. If it is FVT P&L, transaction cost goes in P&L. And now 10,000 becoming 11,200. 1,200 will be gain in P&L later. So 10,000 asset debit, transaction cost goes in P&L. ये P&L में गया. 2 bank was 10,500. And then 10,000 becomes 11,200 this way. If it is FVT OCI, transaction cost added to asset, the asset becomes 10,500. The investment debit 10,500 to bank. And now year end pay it became 11,200. Fair valuation पे 700 gain goes in OCI. Clear? Okay, subsequent measurement of financial asset, financial liability. How do I measure them subsequently? Subsequent measurement, financial asset, financial liability. If it's an amortized cost, we booked the asset, interest accrues, we receive something, closing, interest accrues, we receive something, closing. That's amortized cost. Okay, if it's fair value through OCI, under a fair value through OCI also interest accrued, received in closing, and then closing fair valued. Then closing fair value, difference goes in P&L. Interest doesn't go in P&L. Interest doesn't go. Interest accrued, we received something, closing. Interest goes in P&L. Interest goes in P&L. Interest doesn't go in OCI. Now closing is fair valued, which will go in OCI. Okay, now this is the table for it. It's fine. Check question number 16. Check question number 16. A Limited made interest-free security deposit. You're given an interest-free security deposit. 5 years pay, normal market rate is 12%. So you'll be recording deposit at its present value. And इसका purpose क्या था? I don't know. The purpose is not given. We assume it's basically for container. The prepaid expense remaining will be there, which will be amortized to P&L over the life. Okay. You took deposit at present value. Now on deposit, interest accrues. The first year interest accrues, second, third, fourth, fifth, and now it became 10 lakh. We received 10 lakh. And this prepaid may say it goes to expense. Okay, next question. We gave to employee loan at 5%. We gave to employee loan at 5%. Market rate is how many percentage? 10. Market rate is how many percentage? 10. Again, now how is going to repay? How is going to repay? He is going to repay equal 5 installment for principal. Acha, 16 lakh loan given divided by 5. So he pays every year 320 plus interest. He pays every year 320 plus interest. So I'll be getting 320 plus interest. First year mein full on 16 lakh. Next year it will be on 12.8 lakh, 9.6 lakh. So this is my basically cash flow coming. This is my cash flow coming. What I will be getting discounted at a normal market rate. What I will be getting discounted at a normal market rate, 10%. This is your asset. Remaining will be a prepaid salary. This is the asset. Loan remaining becomes a prepaid salary. Only thing is how you're going to get principal 320 plus interest you are getting like this. This is your inflow. What you are getting discount at 10%. Next one, basically over here we have a redeemable preference shares. They've issued a redeemable preference shares to holding company, and if you see interest kuch hai nahi. So parent has invested in redeemable preference shares. Parent has invested in redeemable preference shares of subsidiary. So can I say parent is going to get back? Parent is going to get back 1 crore after 5 years. I've invested 1 crore. I'll get back 1 crore after 5 years. I'll be recording investment at its present value. Present value is coming 56 lakhs. Present value is coming 56 lakh, but I paid total 1 crore difference. Difference yahan pe. Parent investing in subsidiary, treat it as investment in subsidiary. Treat it as investment in subsidiary. That's it. So check out first entry. First entry, loan debit 56 lakh. To bank 1 crore. Difference is investment in subsidiary. Okay, question number 19. Question number 19. Wheel Company Limited is providing subsidized loan to its employee. And this is basically, this is similar basically to the last one. Only difference over here is prepays 2 lakh. Okay, now whenever he prepays, see day one, whenever I gave loan to him, I bifurcated as towards loan towards prepaid salary. So whenever he prepays also, I need to bifurcate how much he has prepaid for loan and how much prepaid salary he has given back. So day one, when I gave to him, I bifurcated. So when I get back 2 lakh, I also have to bifurcate how much is towards the loan and how much is towards the prepaid salary. Now how do I identify how much is towards loan, how much is towards prepaid salary? Okay, so after this 2 lakh, is prepaying yahan pe. Can I say I have to receive this much money? Here 216 and 208. I have to receive 216 and 208. Find the present value of this. So loan this much should remain. Okay. So after he has given a prepayment, now I have to receive 216 and 208. Iska present value find karo. What I have to receive right future mein uska present value. This much should be the loan remaining. What is the loan in your book? This much should be loan remaining. Remaining he has paid for loan. Did you understood? What I have to receive in future, uska present value. This much should be the loan remaining in books. This is what he will pay in future now after prepayment of 2 lakh. So that much loan should remain. Now see, what is the loan in your book? This much loan should remain. The difference is the loan amount what he has paid for loan. Okay, the out of total payment, this is for loan. Balance is for the prepaid salary. And now that prepaid salary you have to write off in the remaining 2 years only, not 3 years. Clear? Good question. We have 2 similar questions over here. Okay. This was financial asset going to financial liability. Now, financial liability is also measured on day 1 at fair value. How do we measure it? Fair value. Subsequently, either it's amortized cost or FVT P&L. Under liability, there is no FVT OCI. I repeat, under liability, there is no FVT OCI. But now there's one thing. There's one thing. If there's a fair value change, if it's a liability classified as FVT P&L, and the fair value change is due to own credit risk, then it comes in FVT OCI. Yaad aaya? Under schedule 3 we had done. ठीक है. Now check this question. Important over here is how is the repayment happening? Question 24 asked in May 22 exam. There's 20,000 rupee borrowing which you have taken. Loan processing fee 1,000. Loan processing fee 1,000 we deduct from the liability. The liability net 19. Liability 19. And the loan is repayable for half yearly installment 5,000 each. अच्छा, you show loan in your book 19, but repayment कैसे होगा? 5 half yearly installment of 5,000 each. Half yearly. And interest, if you see, interest is to be paid quarterly. Okay, the first day 1 loan was as such 20 था, उस पे first quarter का interest 12% divided by 4. तो first quarter 600 interest. Second quarter 600 interest plus I'll repay 5,000. So check out first quarter 600 interest, second quarter 600 interest, 5,000 principal repaid. Now loan becomes 15. So now interest 450 paid. Now 450 5,000 paid. Now 10,000 loan becomes 300 interest 300, 5,000 principal. This is how the payment is happening. These are your cash flows. These are your cash flows. These are your cash flow, what you are paying. ठीक है? Now what is happening is you have in your book loan not 20, you will start with 19. Interest accrues based on effective interest rate. So interest accrues 16.60%. You paid some 600 rupee closing. Then again interest accrues, you paid 5600 closing. These are your payments, and this is how interest accrues on effective interest rate. So interest is quarterly. Principal repayment is half yearly. Please take care. Okay, next is accounting for financial guarantee contract. Whenever I give a financial guarantee for someone, I should not give it for free. I should charge. The entry should be bank debit to financial guarantee, and that financial guarantee is an income amortized over the period of guarantee. So bank to financial guarantee, which should be treated as a deferred income. ठीक है? So it's kind of a deferred income. Till the time it goes in income, it's a liability. This is on day 1. Subsequently, how do I measure? If this is measured at FVT P&L, difference will go in P&L. If it's a designated FVT P&L, difference goes in P&L. If it is not designated FVT P&L, then this liability you should show at higher off. See, amount day 1 you recorded, then out of that something you took to P&L, balance remains. That balance or the loss which is going to come, whichever is higher. The amount initially recognized less whatever is income taken, that balance remaining or the loss expected, whichever is higher, that much I will show financial guarantee. The financial guarantee in books is this. I shall have to show it this. Difference goes in P&L. ठीक है. So day 1 financial guarantee is this. Later on, what will be the value of financial guarantee? Out of that, something goes to P&L, whatever remains, wo value. Or the loss, what can come, whichever is higher. ठीक है. Check this question over here. The parent gave a guarantee on behalf of subsidiary. A loan is taken by subsidiary from bank. Subsidiary took a loan from bank, I gave a guarantee, they got a loan at 8%. If that guarantee was not given, it will be 11%. So because of guarantee, can I say there's a benefit of 3%? Every year interest of 30 saved. So uska present value, so what is the value of the guarantee? What is the value of the guarantee? 73320. So I should have charged. I should not give for free. I should have charged. The entry should be bank to financial guarantee, but we did not charge. It's a subsidiary. The investment in subsidiary to finance guarantee. And now this finance guarantee will go to P&L over 3 years. Don't take SLM. They're not taking SLM. How they are doing? Interest accrues for 30 and closing. So they're doing like this. 7.3 effective interest accrues, 30 closing. Interest accrues, 30 closing. So now balance should be 51385. Okay, we started with 73320. Now balance should be 51385 or the loss expected, whichever is higher. First year we are expecting a loss. Kitna loss expect kar rahe hain at the end of first year? Check. Only 1% probability of default, 10,000. So should I show at 513,385 or 10,000? 51385. Okay, the 73 becoming 51385, difference goes in P&L. Acha, now the liability is 51385. Now we will show 27037 or loss expected 30 hai. Loss expected 30, so I have to show at 30. So 51385 becomes 30, difference goes in P&L. This is your financial guarantee. Fine. 26th is okay, nothing different. 27th is also fine. Okay, 28th already covered under your IND AS 21. We have done it. Now, group company wala loan. Group company loan. Okay. Now, if there's a loan given between the group company, parent gave to subsidiary or subsidiary gave to parent, kind of that. If it's repayable on demand, if the loans are repayable on demand, the fair value of loan is at least equal to the nominal amount. The fair value is not less than the face value. So then in that case, I gave a loan repayable on demand. Whenever I demand, I'll get back. So now in that case, the fair value of the loan is not less than face value. The loan of 10 lakh, recorded 10 lakh. Acha, this is there. Second, if it's a fixed maturity, they're going to pay after 3 years. If they're going to pay after 3 years, it's an interest free. If it's interest free, the loan will be the present value of it. Or present value. Acha, no fixed maturity. If there's no fixed maturity, so see, if it's repayable on demand, parent can ask whenever they want. No fixed maturity means subsidiary can pay whenever they want. If subsidiary can pay whenever they want, then I'll estimate when they will pay. Repayable on demand, so I'll record fair value is not less than the face value. I'll record at 10 lakh only. But no fixed maturity, subsidiary can pay whenever they want. So in that case, I'll be recording what value pay. What I expect. If I expect they'll pay after 5 years, the present value based on that 5 years. That way I'll be recording. Question number 29 is important. 10 lakh rupee interest free loan given, repayable on demand, I'll record 10 lakh only. Second case mein repayable after 3 years, present value of 10 lakh. Yeah. Repayable whenever they want, I'll try to assume if I feel they will pay after 5 years, the present value based on 5 years. So whenever they can repay whenever they want, you need to presume when they'll pay. Repayable on demand, full 10 lakh you can record. Fine, this is done. Next, reclassification of financial asset, financial liability from basically amortized cost to FVTOC or FVTOCI to FVTPNL, something reclassification. All reclassifications are done at today's fair value. Aaj ke fair value pe reclassification will be done. Otherwise, this topic is not much important. So reclassify only if there's a change in business model and it's prospectively done and always measured at fair value on reclassification. Always measured at fair value on reclassification. Okay, next point is impairment of financial asset. Okay, financial asset ka impairment. Okay, so whenever I have a financial asset, if it is carried at FVT PNL, no problem. Because if it's carried at FVT PNL, it's already at fair value, difference has already gone in PNL. So no impairment testing for financial asset designated as FVT PNL. But if it is amortized cost, FVTOCI, then it will be required. Okay. Now, credit loss is nothing but the present value of difference between what amount are due and what I expect to receive. The actually due is this, but I expect to receive is this. Uska difference and uska present value is basically the loss. Now how to take this loss? So they are telling if it's a trade receivable, lease receivable or contract asset, yeah, the contract asset IND AS 115, then the provision which you need to do is based on lifetime expected loss allowance. Okay, the trade receivable, lease receivable, contract asset, lifetime credit loss, lifetime expected credit loss that you take. Acha, if there's a significant increase in credit risk, when do I say there's a significant increase in credit risk? When it's overdue for more than 30 days. If there's a significant increase in credit risk also, then also you measure based on lifetime expected credit loss. Otherwise, you measure based on 12-month expected credit loss, ECL we call it, 12-month ECL. Okay, so if it's a trade receivable, lease receivable, contract asset, or there's a significant increase in credit risk, measure lifetime ECL. What can the loss come throughout the life? Acha, if answer is not in में से नहीं आ रहा, then it's a 12-month ECL, chances of default in next 12 months, and if that happens, what loss will come? Acha, chances of default after 12 months are not considered when you're doing 12-month ECL. Acha, now for determining whether it's significant increase in credit risk is there or not, we try to basically consider the information which is available without undue cost or efforts. Acha, one more thing. Suppose sir, basically there is a significant increase in credit risk. Now we have done some provision. The income which we record, should it be on gross value or net value? Income, provision kar diya, to asset was this, provision is this, now net. So income should be on net value or gross value. So they are telling if there is no significant increase in credit risk, income is on gross value. If there is a significant increase in credit risk, still it's on gross value. But if it's credit impaired, there's an objective evidence of impairment, then it's calculated on net basis. So significant increase in credit risk hai, to bhi chalega, you can do it on gross. Credit impaired, then it's on net basis. Okay, check question number 41. Check question number 41. 1st April 17, you lent 2 crore to a supplier and the arrangement of the loan cost 10 lakh. Achha, loan ka arrangement cost was 10 lakh. You add it to asset. So in your book, asset is 2.1. And he's going to pay 2.4 after 2 years. He's going to pay 2.4 after how many years? 2 years. So effective rate is 6.9%. The 2.1 plus 6.9%. After 1 year, the loan is 2.2244. After 1 year, the loan is 2.244. Okay, but now what happened is you got the information, he's in trouble. And now you feel in 19 he will not pay 2.4, he will pay only 2.2. Now in your book, after 1 year, in your book in March 18 in your book, the loan is this. But now I know after 1 year is not going to pay 240, he is going to pay 2.2 only. That too after 1 year. So after 1 year, 2.2, uska present value is coming 205. So in my book, the loan is 224. I'll be getting only 205. Difference is impairment, which goes in P&L. Any doubts? Anybody with unit number 2? Any doubts? Anybody with unit number 2? Okay, let me just finish one more unit, then take a break. Let me just finish unit number 4, then we take a break. 15 minutes, 10 to 15 minutes. Let me finish unit number 4, then we are taking break. Pay attention. Okay, derivative and embedded derivative. First of all, what is a derivative? Derivative is a financial instrument that meets all the following criteria. 1, uska value changes with the change in specific variable. Okay, so gold futures, the value depends on gold ka rate. Second, it requires no or little initial investment. And third, it will be settled at a future date. It requires no or little initial investment and it will be settled when future date pay. And your derivative includes your options, your forward, your futures, your swap. They all are covered in derivative. The value changes in response to specific variable, requires no or little initial investment and settled at a future date. And if I have a contractual right to exchange financial assets or I have a contractual obligation to basically exchange financial asset, financial liability under the terms which are favorable, unfavorable, then that becomes basically a derivative. So contractual right to exchange financial asset liability under the terms potentially favorable, or contractual obligation to exchange financial assets liability under terms which are unfavorable, they are all your derivative. So it's a derivative financial asset or a derivative financial liability. ठीक है. So derivative will be a financial asset when it's a favorable contract. Derivative is a financial liability when it's unfavorable contract. And derivative can be equity also. Derivative can be equity also when fixed number of own shares are to be issued for fixed amount of cash. Are to be issued. Fine. This all questions whether it's a derivative or not is fine. Not relevant at all. Next is embedded derivative. Now what is an embedded derivative? This is nothing but there is a non-derivative host contract. There is a non-derivative. If I buy a debenture, I'll pay full money right now. So it's not, it requires a little or no initial investment. I'm paying full money. But it's a convertible debenture. The value of it will also depend on the value of shares. Actually, the host element, host is a non-derivative. But uske andar there is some derivative component added. The component of a hybrid contract, it's a component of a hybrid contract that includes a non-derivative host with some of the cash flow varying in a way similar to standalone derivative. Some of the cash flow varying in a way as a standalone derivative. For example, I'm issuing convertible debenture. Issuing, not buying, I'm issuing a convertible debenture. Okay, so whenever you issue a convertible debenture, you're getting full money right now. So it's not coming under basically the definition of derivative, because derivative requires little or no initial investment. So you get full money right now, but now the value of the debenture will depend not only based on that interest rate, but also on share ka value. So this is embedded derivative. Okay. Now, in certain circumstances, the embedded derivative are to be separated from the host contract, accounted separately. I need to separate it. When I have to separate the embedded derivative from host contract? One, when economic characteristic and risk of the embedded derivative contract, I need to check whether they are closely related to host contract. If economic characteristic and risk are closely related to host contract, no need to segregate. Not closely related, segregate. Second, whether such a derivative can be there independently. क्या ऐसा कोई independently derivative possible है? Right to buy shares at a fixed rate. Yeah. So if such an independent derivative possible, then segregate. If such an independent derivative not possible, don't segregate. And third, overall how it is measured. If the overall contract is measured at FBT PNL, then don't segregate. Reason, even after segregating, I have to measure derivative at FBT PNL only. If overall is already measured at FBT PNL, no need to segregate the embedded derivative. Clear? Okay. Acha, plus one more thing. Embedded derivative, if it is included in financial liability, embedded derivative, it's included in financial liability or equity or compound financial instrument, then only it's segregated. Embedded derivative included in financial asset, no need to segregate. The embedded derivative which is included, which contains a host which is a liability, equity or compound, that needs a segregation. Which is financial asset, they are not to be segregated. उसमें अलग करना ही नहीं है. If I have an investment in convertible debenture, don't segregate. But if I have issued convertible debenture, we have to segregate. Now sir, how to segregate? So we find out liability component, equity component. We already did earlier. Compound financial instrument. Indirectly we did it. Acha, if there's a prepayment option in your debt instrument, in your loan taken, there's a prepayment option. So whether that prepayment option is an embedded derivative, so they're telling the prepayment option, whether it's an embedded derivative or not, I need to understand whether it's closely related to host contract. If it's closely related to host contract, economic characteristic, etc., then it's not to be segregated. So when do I say it's closely related? The prepayment option is considered closely related to host contract if the price which we have to pay prepayment के time approximately equal लिखा है, तो I assume 98% to the amortized cost of host contract. Means if normally loan, if I don't prepay, what's the liability in my books every year? Loan liability in my books every year. And if I go for prepayment, what I have to pay right now? The difference between both should not be more than 2%. If difference is more than 2%, then I say they are not approximately equal. So then they are not closely related, then they are to be segregated. If carrying amount of liability in books and amount to be paid under prepayment option are approximately equal, plus minus 2%, then basically it is closely related, no need to segregate. Check this question over here. This is basically the liability in your book. This is the liability in your book at each point of time, and if you go for prepayment, this is what you have to pay. The difference, here the difference is exceeding 2%. So can I say it's not basically approximately equal? So here you need to segregate and account it separately, the derivative element. And derivative element which you are segregating, it will be then measured at FVT PNL. Okay, just going down, I'll come back to this point. Where embedded derivative are required to be segregated, you measure the derivative at fair value on day one and subsequently at FVT PNL. So from the hybrid, remove embedded derivative, balance is host. Balance is host. Okay. Now, I'm taking question 15 first, then I go to the other questions. I'm taking question 15 first. Okay. Embedded derivative are always FVT PNL, right? Okay. So 1st January 1, we entered into a contract to purchase this many USD. So there's a forward contract to buy 2000 USD at 68. There's a forward contract to buy 2000 USD at 68. Okay. Day 1, I don't have to pay anything. Mark to market, I need to pay or receive. Okay. Mark to market. Okay, mark to market, if it becomes negative, it becomes a financial liability for me. Mark to market becomes positive, it's a financial asset for me. Remember derivative, the contract mark to market negative, contract unfavorable. Mark to market positive, contract favorable. So that time contract unfavorable, it's a derivative financial liability. Contract favorable, it's a derivative financial asset. Now quarter wise it is to be done. Okay, quarter 1 mark to market is negative 25. So PNL debit to derivative financial liability. Okay, now 15 negative. Oh, 25 became 15 negative, means there's a 10 profit. The derivative financial liability debit to PNL. So check first entry. PNL to liability 25. 25 now becoming 15. Liability reducing. So liability to PNL 10. Okay. Then it becomes favorable 12. Oh, we have a liability 15. Liability 15 becoming 12 asset. So 15 liability going, 12 asset coming, total profit is 27. 15 liability going, 12 asset coming, total profit is 27. Okay. Total profit is 27. And last May, 66 rupees is there. Last May 60. Now see, you had entered into a contract to buy $20,000 at 68. So can I say I have to pay 1360? Okay, the 1360 you are paying and you are getting $20,000. When you are getting $20,000, that you record at spot rate. So you will be recording $20,000 at 66. $20,000 at 66. So you are recording asset at cash 66. $20,000 come in. $20,000 come in, spot rate pay recorded. I paid to cash $20,000 into 68. This INR paid. So this comes, and you have a derivative financial asset 12,000. That asset goes away. Difference is PNL. Difference PNL. Or I can understand in a very simple way. Today as per 66. 1320. But I am paying 1360. So can I say net I have a 40,000 loss? So $20,000 is worth today on settlement date 1320. I have to pay 1360. Net 40 loss. You had a 12 asset goes away. Net 40 loss चाहिए. तो 52 loss now. 12 asset था वो भी गया and 40 का loss. So 52 loss will come up now. And see here really $20,000 comes. This is paid. Your asset चला गया. 52 loss in this quarter. Did you understood? This is really a contract to buy or sell that thing. This is really a contract entered to purchase dollar to dollar I. This is cash given. till now we had mark to market, उसमें asset था वो गया, and difference, this is the P&L this quarter. Okay, did you understood? Now there is another concept. If you just come back, here page number is 10. Page number 10. It's contract to buy or sell non-financial item in foreign currency at future date. There's a contract to buy or sell non-financial item, PPE, basically inventory, in future, and that too in foreign currency. Okay, if you are buying, selling non-financial item today, if I'm buying, selling non-financial, imagine PPE purchased in foreign currency today, so PPE debit to creditors or to bank हो जाएगा, PPE credit debit to creditor or bank based on today's rate. But this is not today, this is basically at future date, अलग चीज है ये. तो contract to buy or sell non-financial item today is accounted as per IND AS 21. But this is contract to buy or sell non-financial item at what rate? Future date. So here accounting, how it is to be done. Assume there are two contracts. One, suppose you are buying. So there's a contract to buy a PPE in INR, ऐसा मानो. There's a contract to buy PPE in INR, but sir, I have to pay in dollar. आपको dollar pay करना है ना. तो assume there's another contract where you sold dollar, means I have to pay dollar. So contract to buy or sell non-financial item in future. Which will be settled by delivery, is out of scope of 109. If it is to be settled by delivery, it's out of scope. But when the payment is made in foreign currency, its value fluctuates based on exchange rate. So there's a derivative element. Actually, there's a non-derivative host. It's contract to buy PP. But उसके अंदर एक derivative element is added because उसका value gets changed based on exchange rate. And they are not closely related. It has to be segregated. तो accounting कैसे करेंगे? If you have a contract to buy, so assume there's a contract to buy a non-financial item in INR, but I'll be giving dollar. You'll be giving dollar. Assume you have entered into a contract to sell dollar. ये assumption ऐसा है. So contract to buy, there's a contract to buy non-financial item in INR, and there's a contract where you sold dollar, where you will be giving dollar. Acha, if you are selling a PPE, or selling an inventory, so there's a contract to sell non-financial item in INR, but you will be getting dollars. You're selling PP, you'll be getting dollar ना. तो assume there's a contract to buy USD. Don't think from hedging angle. ये hedging angle से नहीं देखना है. I'd explain you in class many times this thing very clearly. ठीक है. Now contract to buy this non-financial item in INR, this will be based on the क्या बोलते हैं? Forward rate to maturity available on day one. And ये जो contract है ना, you assume you've done it today. Maturity वाला, it will be mark to market. This will be mark to market every time. बीच में year end mark to market, settlement पे mark to market kind of. Contract to buy or sell USD with forward contract to buy or sell, this will be mark to market at the end of each reporting period. Upon maturity, what will happen? Upon maturity, derivative financial asset or derivative financial liability, whichever is there, you transfer it to debtor creditor, and then debtor creditor are paid based on spot rate. Things will get settled. Let's check question, more clear हो जाओगे. Let's check question, it will be more clear. Okay, check over here. 1st January, ABG Private Limited enters into a contract to buy solar panel. कब? 1st January entered on 30th June. So can I say this is a contract to buy PPE in future? Assume there are two contracts. One, contract to buy PPE in INR. And another contract is where you sold dollars. ठीक है, तो two such contract are there. तो contract to buy PPE in INR में कौन सा रेट लेंगे? 50 million. And what is the forward rate of maturity today? तो 6 months forward today is 65. So 50 into 65. So assume there's a contract done to buy PP in INR only, and INR कितना rupees होगा? This into this, 3250. 3250. The host contract, solar panel, denominated in INR 3250. Okay, then you have entered into a forward contract to sell dollar. So you have sold $65 forward wale. Now this has to be marked to market. This has to be marked to market. ये 65 में आपने बेचा, you sold dollar at 65. Now rate became 66. 31st March is not there in between. You sold at 65, rate became 66. आपको loss हो गया, 1 rupee का loss. तो P&L debit to derivative financial liability 1 rupee. P&L debit to derivative financial liability 1 rupee on that 50 million. 50 million के ऊपर 1 rupee, 50 rupee हो जाएगा. ये million, this is crores, that's why it became 5. That's why it is 5. अच्छा, day 1 forward contract neither favorable nor unfavorable. I entered into forward contract at 6, उसका rate 65 और 65 चल रहा है. Now year end or settlement time I need to check. So now it became, I sold at 65, rate has become 66, loss for me. I sold at 65, rate became 66, loss I booked. ठीक है. Now this derivative financial liability transfer to debtors creditors, वो बाद में, उसके पहले I'll record that PP purchase. अच्छा, तो day 1 there is no entry. Day 1 there is no entry. Then that contract mark to market की entry. Now on 30th June, solar panel debit to trade payables. And I told you the rate कौन सा लेना है. ठीक है. Now this liability transferred to trade payable. The trade payable is 325 plus this liability goes, trade payable will become 330. Today 66 rate, you pay 330, खत्म. Trade payables to bank 330 हो गया. तो trade payables get away. So indirectly solar panel recorded at 325, loss of 5 rupee recorded, and total we paid is 330. Okay, check next question. Check next question. We enter into a sale contract in January to sell a equipment in June. So can I say we have to sell equipment in June? June में equipment देना है. अच्छा, तो now assume there's a contract to sell equipment in INR. So 10 lakh into what is 6 months forward on day 1, 55. So 10 lakh into 55 you sold, you will be recording at 550 lakhs. You'll be recording at 550 lakhs that way. And you entered into a forward contract to buy dollar. आप ऐसे मानो you entered into contract to buy dollar. You'll be getting dollar, तो आपको dollar मिलेंगे, buy dollar. You buy dollar at 55. You buy dollar at 55. This is basically 6 months forward today. This is basically June May 1 which will be maturing. Okay, now March came. अच्छा, March में 3 month forward. Can I say June expiry? I bought at 55, it became 45. I bought at 55, it became 45. 10 rupee loss. So I book a 10 rupee loss, P&L to liability. अच्छा, on maturity 45 नहीं, अब ये 60 हो गया. On maturity 60 हो गया, तो now there is a profit of 15 coming. तो पहले loss था. Now there is actually a profit of 15 coming. There's actually a profit of 15 coming. So liability goes away, asset 10 comes in, and there's a 15 ka profit. So पहले 10 loss booked, now 15 profit booked. Okay, now you book trade receivable to sales at 55, day 1 forward maturity wala thing. Now your asset, liability is already gone. This asset 5 you remove it. Asset 5 transfer it to debtors creditors जो भी है. The asset is transferred to debtor. The debtor was 55 plus becoming 5, it becomes 60, and spot rate के हिसाब से you get money, it will be 60. Spot rate के हिसाब से you get money, it will be 60. So assume there are 2 separate contract. If you are going for a buy, PPE to be bought, assume there is a contract to buy PPE in INR, वो forward maturity का rate on day 1, and as you're buying you have to pay dollar. So assume there is a contract to sell dollars. And same opposite in sell side. This is basically your unit. I think there's one more question to be done. Yeah. No, that's it. Fine. So this is your unit number 4. Unit number 5 I'll do after the break. Okay, we are left with 3 things. Unit number 5 left, and we are left with IND AS 101, analysis of financial statement. 3 things are left, approximately 1 hour 15 minutes or 1 hour 30 minutes till it will take. So we'll take lecture till 11:45, whatever it takes. So we'll finish off today only. 11:45 the lecture will be there. Now I'm taking 15 minutes break. And I'm recommending you, please make sure you are attending everything. Don't skip. ठीक है, तो I write down over here break 15 minutes and back at 10:45. We'll be back at 10:45 p.m. Enjoy your break. Okay, hi, welcome back. The final part. Yes, last 1 hour of your revision is pending. Approximately 26 to 27 hours of revision. A thorough, in-depth revision is done by us. Let's move ahead. Try to finish it early. Actually, late hi ho raha hai, but still, whatever early possible. We are left with unit number 5 of your financial instrument. Recognition, derecognition of financial instrument. Recognition, derecognition of financial instruments. Someone asked me, sir, unit number 6 and 7 are there. 6 is related to hedge instruments, 7 is related to a disclosure. They're just theories. They're just theory. ICI has not given a single question. That's why that 6 and 7 is not relevant for examination purpose. Now, recognition, derecognition of financial instruments. Let's start with this. Now, when do I recognize a financial asset or a financial liability? You should recognize a financial asset, financial liability when and only when you become a party to the contractual provisions. When you become what? A party to contractual provisions. Okay? Now, under your forward contract, the day when you enter into a forward contract, the terms basically you enter into forward contract, the day one, it is neither favorable nor unfavorable, so uska value will be 0. So you don't have to account anything on day one like we saw in the last unit. But when you enter into option, day one you might be paying some premium, you need to record it on day one only. Fine. Now there's a concept called regular way purchase or sale of financial asset. What is a regular way purchase sale? Okay, regular way purchase sale is a purchase sale of financial asset under contract under which the terms require a delivery of asset within a time frame. Remember the stocks T+2 and generally established by the regulations. So how do I account for that? T+2. If I buy a stock today, they come in my demat account after 2 days. So there are two options. One is called trade date accounting, other is called as settlement date accounting. You can follow any of them, either a trade date accounting or a settlement date accounting. If you follow trade date accounting, financial asset debit to bank, or basically you're not paying to bank today, the financial asset to creditors or to financial liability will be at the rate prevalent on the date of trade. As a settlement ke time you're basically paying that money and you need to fair value it. If it's FBT PNL, FBT OCI, that way you need to fair value it. If it is basically amortized cost, it will not be fair valued. 10 lakh trade date accounting, settlement date accounting, I don't take fair value of settlement date. Settlement date accounting, I don't take fair value of settlement date. I take the fair value of trade date only if it is amortized cost. So check out, when trade date accounting is applied, the buyer of financial asset records an asset and liability to pay on trade date itself. When settlement date accounting is adopted, the buyer of financial asset accounts for any change in the fair value of asset to be received during that period in the same way as it accounts the asset acquired. Now let's see question, it will become more clear. Like check. 1st January you entered into a contract to purchase financial asset for 10 lakh. Okay? If it's a trade date accounting, I'll record on 1st January only, the 1st January financial asset debit, and I have to pay within 2 days. To financial liabilities 10 lakh. Okay. Now 4th January we are settling it. Fair value became 1050. 4th January is settling it. Say whenever you settle, it's liability to bank. This is basically settlement pay. If it is FPT, PNL, FPT, OCI, I'll fair value it. So book mein jo asset 10 lakh tha, I'll bring it to 1050. Here also 10 lakh, I bring it to 1050. Here it goes in PNL, here it goes in OCI. So trade date pay, record on trade day. Settlement date, you pay the money, and also try to fair value it, bring it to today's value. Achha, if it's a settlement date accounting, no entry on 1st January, directly entry is on 4th January. Achha, 4th January ko entry, we are paying 10 lakh. Amortized cost, record 10 lakh only. Amortized cost per 10 lakh. But if it's FBT, PNL, FBT, OCI, directly record 1050. Pehle yahan pe we recorded 10, then we remeasured it. Here directly recorded 1050 asset, but we are paying 10. Difference goes in PNL and OCI. But over here for amortized cost, you need to take the fair value not of settlement date, the fair value of trade date only to be taken. The change in fair value between trade date settlement not recognized under amortized cost. Now, when do I derecognize a financial asset? When should I derecognize a financial asset? When contractual right to the cash flow is over, or you transferred the financial asset. Contractual right is over, or you transferred the financial asset. That time basically you remove it. Simple example, you sold it off. Acha, that is transferred. A sale of financial asset together with the option to repurchase at its fair value at the time of repurchase. I can repurchase, but at its fair value. So then today it's gone. So this is basically given. And when I say I have not transferred, see, the thing is, if you transferred risk and reward, you record, you remove the asset. But if you retain the risk and reward, you retain the risk and reward, then you keep it. Sale ke saath repurchase transaction is there. Sale ke saath a repurchase. A sale with a deep in the money put option or call option means the thing is I'm selling it, but I know it is going to come back to me. Then in that case, you're not derecognizing a financial asset in your books. Okay, this is okay, not relevant. Now check over here. Has the right to cash flow expired to derecognize? Achha, right to cash flow is not derecognized. Right to cash flow is not derecognized, but has the entity transferred substantially all risk and reward? If I have transferred risk and reward relating to ownership, derecognize. Achha, you have retained. You have retained risk and reward. So then I need to check whether I have the control. If I have the control, I'll continue. If I don't have the control, I'll derecognize. Okay. Let me go to important questions. Okay, nothing. Now, accounting treatment for transfer. Whenever you are transferring your asset goes away. You receive some money. Difference is profit or loss, which basically is there. So difference is profit or loss. The difference between carrying amount and consideration received is recognized in P&L. Okay, whether it was FBT OCI or whether it was FBT P&L doesn't matter. Now, upon sale, profit loss goes in P&L. Achha, if that asset is sold off, the previously accumulated balance in FBT OCI, previously accumulated balance in OCI, now the asset is disposed of, it will be reclassified to P&L or not reclassified to P&L, will go to directly retain earning depending on what it is. So previously recorded in equity is recycled to P&L. If it is equity instrument through OCI, that will go directly to retained earnings. Okay, question number 6. A debt instrument purchased for 1000. We have a fair value through OCI. ठीक है. 31st March, the fair value has became 950 and 12-month ECL was 30 rupees. Now see, first do impairment testing, then do fair valuation. So 1000 में से 30 impairment loss gone. 970 becoming 950. 970 becoming 950. Okay, the first of all, I bought financial asset to bank. Okay, then there is impairment loss 30. OCI में fair value through OCI में 20 loss and 50 rupee goes away. So can I say now the asset became 950? 1st April you sell it for 950. 1st April you sold for 950, cash to asset. Acha, asset sold, the balance lying in OCI, accumulated in other equity. Now asset is not there. Asset is not there, and what was the name of the asset? This was debt instrument. Debt instrument through OCI is item reclassified to P&L. It will go in P&L. It's recycled to P&L. It's item reclassified to P&L. Okay, transfers that do not qualify for disqualification. If it does not qualify for disqualification, you continue to recognize the transferred asset. You continue to record the transferred asset. Acha, sir, money received, what do I do? Money received, you treat it as a loan. So recognize a financial liability for the consideration received. So it's treated as kind of borrowing. If it does not qualify for disqualification, asset remains. But sir, I got money. You got money, treat it as borrowing. Achha, next concept is continuing involvement. I have a continuing involvement in the asset. As such, I sold off my debtor. But if that guy is not able to collect, I'll have to bear certain amount. That's called continuing involvement. Okay, so can I say it's kind of guarantee given? I sold off my debtor, but if that guy is not able to collect, I'll bear some amount. I've given a guarantee for a certain amount, kind of that way. So you need to basically record. If you give a guarantee to someone, can I say I should book a guarantee commission income, which is over the period? The same over here. If entity retains control of assets transferred, you continue to recognize the transferred asset to the extent of continuing involvement. to the extent of continue. What is your continuing involvement? The amount of asset or the guarantee which you have given? My continuing involvement is what? The amount of asset or the guarantee amount. Acha, plus I should book a associated liability. Associated liability is nothing but that deferred income related to that financial guarantee. So that I need to recognize. Associate liability is initially measured at, acha, associate, see, you have continued to recognize basically that asset. The associated liability is the guarantee amount plus the fair value of guarantee, that is guarantee commission that should have been charged. That should have been charged. I have a, see, the thing is, for the per amount of guarantee given, that much asset I retain, 5 rupee, to opposite side 5 liability also. Plus, for that guarantee given, I should have charged commission. So that guarantee commission income is again a liability, deferred income, hai na? So that 0.5, that will also be coming. Okay, and the difference goes in P&L. Check out this. Check out this question. We entered into a factoring arrangement and we sold at 90. We sold at 90. Book value is what? 95. So asset 95 goes away. You sold at 90. Cash debit 90. Asset 95 went away. Asset 95 went away. Difference 5 goes in P&L. But there's a continuing involvement. There's a continuing involvement. I have to bear a loss up to 5. So I'll book a continuing involvement asset, opposite liability. I'll book a continuing involvement asset 5 rupee, opposite there's a liability 5 rupee. And for that guarantee given, I should have charged a guarantee commission, but I gave it for free. So P&L debit to financial guarantee 0.5. P&L debit to financial guarantee is 0.5. This is derecognition of financial asset. Moving on to financial liability. Okay, so financial liability we should remove kab, when and only when it is extinguished. So financial liability extinguish hogi, then you should remove it. How? What is the accounting treatment? So I paid it off. So amount paid, carrying amount of liability, difference goes in P&L. The difference goes in P&L. Now this point very important. Pay attention. Exchange between an existing borrower lender of a debt instrument with substantially different terms. Okay, so exchange between existing borrower lender of a debt instrument with a substantially different terms. How do I account? Either it's accounted as substantially different term likha hai na. Substantially different term means old liability goes away, new liability comes in. Extinguishment of old, recognition of new. If terms are changed and there's a substantial, the old liability goes, assume new liability came in. Acha, now how do I decide whether it's a substantial change or not? The terms are changed substantially or not. How do I decide? There's a 10% test. There's a 10% test. So you need to compare. You need to compare what is the carrying amount of liability in your books today. What is the carrying amount of liability in your books today? And as per the new terms, what I have to pay? As per the new terms, whatever I have to pay, including fees for modification, etc. That fees, etc. Whatever is there, that also you take it using original discount rate. So find the present value of amount to be paid under new terms. Present value of amount to be paid under new terms, net of any fees paid or received using original discount rate. Acha. The terms may change. Liability in books is 100. Acha, as per revised terms with the fees to be paid or received using original discount rate, the present value of what I have to pay is now 112. So earlier 100 tha, now it became 112. It will be called as substantial change. If it is 10% or more, it is substantial. If it is less than 10%, not substantial. Acha, if it is substantial change, it's treated as extinguishment accounting. Old liability goes, new liability comes. If it is less than 10%, it's a modification accounting. ठीक है. The extinguishment में वो 10% test में 10% or more is met. Acha, the old liability goes away, new liability comes in. New liability will be at today's fair value. Acha, while doing 10% test, I considered whatever I have to pay fees के साथ using original discount rate. But that is while doing 10% test. But while recording a new liability, I have to just see whatever I have to pay, leave fees, and whatever I have to pay using newer discount rate, today's discount rate I need to check using today's discount rate. ठीक है. The old liability goes, new liability comes, difference comes in P&L. Fees B is what you have paid, that also goes in P&L, and new EIR will be calculated. new EIR will be calculated. So for doing 10% test, we use the original rate, but while recording a new liability, we use today's discount rate. While doing 10% test, that fees B's was considered, but over here, fees is not considered in new liability. Fees paid goes in P&L. Okay. This is basically for extinguishment accounting. Okay, check this question over here. On 1st January, XYZ issued some bonds of rupees 10 lakh, and this is there. Now, when is the modification done? No cost, no fees on day 1 on 1st January 5, that is after 5 years. Now there's a modification done. After 5 years, there is a modification done. First, try to find out the liability in your books today. Okay, so first of all, we need to find the liability in our books today. The original liability, what is the liability in books? Okay, so on 1st 5, the present value of remaining, this is the liability in your books, 10 lakhs. Okay, so it was basically 10 lakh, interest accrued 1 lakh, we paid interest, so liability remains same, 10 lakh. Now, revised term may I have to pay 15 lakh when? I have to pay 15 lakh after 7 years from now. This is done on 1st January 05. So 5, 6, 7, 8, 9, 10, 11. 11 end. So 7 years from now I have to pay this. Fees B's is 1 lakh rupees incurred. So check out with this using original discount rate. Using original discount rate, it is coming as 11, 13, 158. Okay, this is 10 lakh, this is 11, 13, more than 10%. More than 10%, extinguishment accounting will apply. The old liability goes away, 10 lakh, new liability comes. Now, new liability comes. Now, here, fees B's is not to be considered and it will be based on the new discount rate. What is the new discount rate going on? 11%. So, now discounting will be 11%. So based on new discount rate, fees B is not to be considered. Fees will go directly in your P&L. There's a new liability, difference goes in P&L. This was extinguishment accounting. We have a similar question. Okay, moving ahead. Acha. In this question, Wheel and Company wala, December 21 exam. 22 May, we had some liquidity issues and we negotiated. 22 May, we had some liquidity issues and we had negotiated the things. Acha, if it is liquidity issue, means we are not able to pay the amount that time. We are not able to pay the amount that time, but the written payment of interest is on annual basis. So I assume that interest has been paid. The principal was not paid. A principal, what I was paying on part, the principal was not paid at December 02. Interest was being paid. Okay, so this is only thing, otherwise you are able to do it similar as extinguishment accounting. Okay, next one is modification accounting. If 10% test is not passed, if 10% test not passed, the change in terms we account it as what? Modification accounting. 10% test not passed, we'll account it as which way? Modification accounting. How do I do under modification accounting? Simple. Simple. Leave fees. Find out what is the liability in books. Okay. Now find out what will be the liability as per new terms using original discount rate. Yahan pe discount rate is using original only. So using original discount rate, what should be the liability? What is the liability? So don't remove old liability, don't create new liability, just see the difference. What difference leke aao, and what difference directly take it in P&L. Means liability is 100, you have to make it 105. Less than 10% and difference. Liability was 100, you have to make 105. So simple P&L debit to liability 5 rupee. And fees, B's, etc. will go in your P&L. Fees, etc. will go in your P&L. This one option. Second option is the fees is adjusted against the liability. Fees paid, whatever you paid fees, liability to bank and new EIR to be calculated. Done. The first option may, what is the liability? What should be the liability? Liability is 100, it should be 105. So simple entry P&L to liability 5 rupee and fees charge goes in P&L. Second option, what should be liability? What is liability? Leave all that. Just whatever fees you paid, entry liability to bank. Fees you paid, liability to bank, EIR you calculate and done. This is basically your modification accounting. ठीक है. Next is debt for equity swap. Many time instead of debt I'm giving them equity. So over here debtor and creditor my negotiated term by giving them what? The equity instruments. How do I account? The equity instrument issued are recognized at the fair value of equity instrument issued. अच्छा, तो liability goes away. Equity shares at the fair value of equity share. Difference goes in P&L. Difference goes in P&L. Now in this question, you have a liability 90. Okay, owing to financial difficulty, you approach bank for settlement. 2/3 is unsustainable, that gets converted into equity, and equity ka fair value is 56. So liability 60 goes away. Liability 60 goes away, and you are basically 2/3. Liability 60 goes away. You give equity shares 56, and remaining 4 goes in P&L. Acha, so this is for 2/3. 1/3 debt sustainable है, 1/3 debt basically is sustainable, you are continuing, but उसमें थोड़ा change हो रहा है terms. The present value of cash flow as per revised term using original EIR is 25. अच्छा, 30 की जगह 25, 10% test passed. Okay, 1/3 is 30, but as per new terms using original EIR is 25, तो 10% test is passed, तो now extinguishment accounting. Old 30 goes away. New one coming at 28, fair value उसका 28 है using current discount rate, and 2 rupee will go in P&L. Old 30 goes away, new one 28, 2 goes in P&L. Then this is basically your chapter of financial instrument, and now there is now there is next topic, which is IND AS 101. And after that, analysis of financial statement. Oh, done with financial instruments. Chalo, going to chapter number 14, which is IND AS 101. Give me a high five. Get yourself fresh. Boo. Okay, going to IND AS 101, which is first time adoption. Now see, whenever you are applying IND AS, the IND AS are to be applied retrospectively. Achha, first time when you're starting with IND AS, the IND AS 101 is given certain exceptions and exemption. Exceptions are mandatory, exemptions are kind of voluntary. ठीक है, but this is applicable only when you're applying IND AS for the first time. तो तभी applicable है. What is first time IND AS financial statement? That all is fine. Now, previous gap ka meaning, what you were using for your statutory reporting purpose in India. What you were using for your statutory reporting purpose in India. That's called previous gap. Check over here, question number 2. Company B is a foreign subsidiary of a company A. Acha, company B is a foreign subsidiary of company A. So company B is abroad, company A is in India. They had adopted IFRS for their local purpose. Local purpose. Acha, but they also prepared as per AS for the purpose of consolidation with A. So we have a foreign subsidiary. So for their country's law, they followed local gap. But for the purpose of consolidation, they were giving us figure based on AS. Acha, now IND AS comes. So can I say now I want their figures as per IND AS? Now previous gap is what they were following for statutory purpose in India. What they were following was accounting standards. The answer is accounting standards is a previous gap. That was the question. Now this point, entity shall prepare and present an opening balance sheet beginning of previous year at the date of transition. Usko bolte opening balance sheet. So whenever this IND AS is coming, new policies are coming, you're required to give 3 balance sheets: current year end, previous year beginning. 3 balance sheet needs to be given. Now general principle of IND AS 101. What is the general principle in IND AS 101? So they are telling you need to apply IND AS retrospectively. So in simple words, assets liability at the date of transition, previous year beginning, what value? As if IND AS were applied from very beginning. Not IND AS were applied from previous year beginning. IND AS were applied from very beginning. पहले से IND AS थे, तो what would have been the value of assets and liability at previous year beginning? If they were applied from very beginning, what would have been the value of assets liability at previous year beginning? That way you need to do it. So, but there are certain exemptions, certain exceptions. Exemptions are voluntary, exceptions are mandatory. Okay, general principle, this question was asked earlier also once, pay attention. Entity shall recognize in its opening IND AS balance sheet. What you need to recognize? You need to recognize all assets, liabilities whose recognition is required by IND AS. Acha, like ROU asset, it was not there under AS, but IND AS is there. So you need to recognize what is required by IND AS. Acha, don't recognize assets liability if IND AS doesn't permit. Okay. Reclassify the item, like preference share capital was part of capital, now it will be part of liability. And you need to measure all assets and liability as per the IND AS. To recognize all assets and liability required by IND AS, don't recognize any item which IND AS don't permit. Then reclassify the items as required, and fourth, they are telling measure everything as per IND AS. Fine. This question they are telling there was a government grant received as per AS12, they're taken in capital reserve. Now they switched over to IND AS. Chalega? No, IND AS doesn't allow anything in capital reserve. It should go in P&L. It should go in P&L. So to the extent it should have already gone in P&L. We treat it as deferred income, so then it goes to P&L. To the extent it should have already gone to P&L, take it directly in retained earning. Remaining amount, take it as deferred income. So to the extent it should have already gone in P&L, transfer to retained earning. Balance amount, keep it in deferred earning, transfer to deferred income from capital reserve. Okay, next question number 4. Question number 4 is fine, chalo. Now, going to the mandatory exceptions and voluntary exemption. First of all, coming to mandatory, five exceptions are given. Number 1, estimate. See, whenever you are transiting from AS to IND AS, okay, many places estimates are required. Now, point is, under AS also the estimates were made. So, can I use the estimates which were done under AS? Question is, can I use the estimates made under AS? Answer is yes. In simple words, estimate made under AS can be used for IND AS at the time of transition. So whether estimates were required by previous gap, nahi tha, to we need to do it right now. If it was already there, is there evidence of error? If there is evidence of error, then do it again. But if there was no evidence of error, then you can basically continue with the previous estimates. Usme koi thoda bahut change karna hai, you can do that, that's fine. Okay, the estimates, whatever were there earlier, can continue. Second, NCI. We know under IND AS, NCI can be negative, but under AS, NCI was not allowed to be negative. Okay. So imagine NCI was coming negative, but as per AS, it was not shown negative. If I would have applied IND AS from very beginning, NCI would have came negative, but that all you don't need to do it. You can apply prospectively. So, pehle AS tha, as such NCI was coming negative, but we are showing nil. If IND AS is applied from very beginning, NCI would be negative and all that, but you apply the following requirement prospectively from date of transition. NCI having debit balance, and same way, change in parent ownership. 80 में से 10 sold. So imagine 5 years back, 80 में से 10% sold. Under IND AS, goodwill is not affected, but AS में goodwill was affected. So 5 years back, 80 में से 10% sold, that much goodwill was removed as per AS. IND AS में it's just a change in NCI proportion. Goodwill is not affected. If I apply IND AS from very beginning, that goodwill, वहाँ पे जो change किया था, it has to be reversed, all that, but leave it, that is to be applied prospectively. Okay, so these two things you apply prospectively. However, there is one point to restate the previous business combination. अगर आपने past में business combination किया है, to restate previous business combination or not, it's optional, up to you. If you decide to restate previous business combination, then this cannot be applied prospectively. If previous business combination are restated retrospectively, then this basically cannot be prospectively, then this changes, you need to do it. Third one, classification, measurement of financial asset, financial liability. Acha, financial liability, amortized cost or FPTPN or FPTOCI, we had to do that basically business model test, contractual cash flow characteristic test. That was generally done at the inception of contract. जब वो contract होता था तब. But now no need to go back to that thing. You just try to do it at the date of inception. So actually it was to be decided at the time of when that contract happened, but now they're telling you decide at the time of seeing the circumstances at the time of transition. Plus, You remember basically now whenever we are transiting, you can start a financial asset, financial liability. We know financial asset, financial liability are measured at fair value. The fair value on the date when contract was entered. Rather than that, you can directly take the fair value at the date of transition. So fair value at the date of transition shall be the new carrying amount that you can take it. Okay, next one, government loans. You know, government loans at lower market rate. If government has given you a loan at a lesser market rate of interest, what difference is a government grant? Acha, this is basically now. Earlier nahi tha. So earlier I got some government grant. And it was not bifurcated. Earlier I got a government loan, not grant. I got a government loan at below market rate. Earlier it was not treated as government grant. If I apply IND AS 20 retrospectively, it will be there, but they're telling no need to apply, you can apply it prospectively. So 2, 3, 5 years back, I got some government grant, which was basically lower rate wala. That time it was not classified as government grant because AS meet was not required. If you apply IND AS retrospectively, it will be required, but they're telling for that you apply prospectively, and the previous gap carrying amount of loan will be the carrying amount of loan on transition date. EIR has to be calculated. Next one, impairment of financial asset. Acha, impairment of financial asset. Remember, if there's a significant increase in credit risk, we have to do lifetime ECL. Otherwise, we do 12-month ECL. Now, whether significant increase in credit risk is there or not, I told you, uske liye significant cost and effort should not be there. So do one thing. If you're not able to decide, do lifetime ECL for everything. So if at all it would require a significant cost or effort to understand significant increase in credit risk is there or not, do one thing, do lifetime ECL for everything. These are 5 mandatory exceptions. Now optional exemption. I told you one business combination. Whether to restate previous business combination or not, वो आपके लिए optional है. Whether to restate previous business combination or not, that's optional for you. Acha, now suppose previous gap में asset or liability was not recognized, but as per IND AS it's required. Previous gap asset or liability was not recognized, but IND AS requires it, so you need to record. ये no था, यहाँ पे required है. ठीक है. If that asset or previous gap में it was not required, now required. If it is intangible, opposite effect you give it in goodwill. If it is not intangible, the opposite effect you give it in retained earnings. So now you are recording. Is it a intangible? No, to retain earning. Is it intangible? Yes, to goodwill. अच्छा, तो I just have to see पहले asset था, now नहीं है, या पहले नहीं था, अब है. So in that case, if it is related to intangible, opposite effect comes in goodwill. Not related to intangible, opposite effect will come in retained earnings. अच्छा, share-based payment. You know, in AS was allowing basically your earlier में you were taking either the intrinsic value of option or fair value of option. But now they allow only the fair value of an option. So earlier, if you've taken an intrinsic value of an option, if you now apply fair value of option from very beginning, figures will change. Acha, if options are already wasted, तो चलेगा, छोड़ दो. For options already wasted, it's okay. For unwasted option, if you had booked intrinsic, make it as per fair value. So already wasted में no need to do it, चलेगा. Okay. Check question number, no, it's not important. Moving ahead. Okay, deemed cost for PP intangible ROU asset. Okay, I have a PP intangibles ROU asset, uska deemed cost. They've given 4 options. 1, you apply IND AS 16 or 38 or 116 retrospectively. That way you do it. Second, you can do one thing. What is the fair value today on the date of transition? Take that. Third, if previous gap में revaluation was done, that figure subject to some adjustment you can take it, or the previous gap carrying amount. Acha, if you are taking a previous gap carrying amount, it has to be for all PPs together. I cannot have machine के लिए previous gap carrying amount, land के लिए fair value, नहीं. If previous gap carrying amount is taken, all PPs के लिए same. PPs as per previous gap carrying amount, intangible based on fair value on date of transition. PP based on previous GAAP carrying amount, and intangible based on fair value on date of transition. Is that allowed? Answer is yes, that will be allowed. That is not a problem. The 4 options are given to you. ठीक है. Okay. Investment properties are as required as per cost model. तो उसमें this fair value वाला option is not available. उसमें एक fair value treating as deemed cost, that's not available. Fine. Next. Cumulative translation difference, FCTR balance. What is FCTR balance as per old? You can reset it to 0. You can reset it to 0. The cumulative translation difference set to 0 is allowed. Opposite effect will come in retained earnings. Okay, next. Long-term foreign currency monetary item. Acha, now see, if there is a long-term foreign currency monetary item, like a loan taken, long-term foreign currency monetary item. So there was a long-term loan taken in foreign currency. If in AS, if that loan was for purchase of PP, uska exchange gain loss we can add or deduct in PP, or else we are able to put it in foreign currency monetary item translation difference account, and it was spread over the period of loan. That was allowed under AS 11. AS 11. Here everything should go in P&L. Now they are telling for that long-term foreign currency monetary item, you are allowed to continue the policy which you are having. So your policy could have been either in P&L, or if it was related to PP, you could have added or deducted from PP, or you could have put in foreign currency monetary item translation difference account, amortized. What you are following, you are allowed to do for that new loan taken. No. For that loan, you are allowed to do whatever you were doing it. You may continue the accounting policy. Okay. Investment in subsidiary associate JV. Investment in subsidiary associate JV, you know, in SFS they are carried either at cost or as per IND AS 109. Now IND AS 101 allows you, IND AS 101 allows deemed cost. Which is the deemed cost? Either the fair value on the date of transition. You can start with the fair value on the date of transition, or previous GAAP carrying amount. Or the previous GAAP carrying amount. Acha, compound financial instrument are to be split into liability component, equity component. Acha. If I apply IND AS 109 from very beginning, I might be required to split, but for those compound financial instrument where liability component is over, for those compound financial instrument where liability component already khatam ho gaya hai, no need to apply IND AS 109 retrospectively. If liability component is not outstanding, then no need to split. Clear? Okay, in 14th question, the liability component is not over, splitting is required. In your book, the asset was, basically this liability was, we had 30,000 convertible debenture, 100 each at par. They are redeemable at 10% premium. They are redeemable at 10% premium. ठीक है. तो total premium, this is 4 years. 4 में से how many years are already over? 2 years are already over. 4 में से 2 years are already over. So half of the premium you would have booked as an expense. The premium also is booked over a period under AS. So in our books, the liability is 30 plus 150. In our books, the liability is 3150. In our books, the liability is 3150. Remove that. ये निकाल दो. ये निकाल दो. And you need to identify liability component, equity component. First of all, if day 1 pay, then what will be the liability component today? Okay, so you need to identify, this is on day 1, liability component, equity component. Then liability component mein interest accrued, we paid this is, so today the liability is 3027. So bring 3077 liability, bring 185 equity, remove old one, difference goes in retained earning. ये old liability 3150 goes away, new liability comes, equity component comes, difference goes in retained earnings. Next, non-current asset held for sale and discontinuing operation. Non-current asset held for sale, discontinued operation, we measure them at fair value less cost to sell. You can directly take the fair value less cost to sell, not the day when they are classified like that. Transition date se le lo. Transition date se le lo, difference goes directly in retained earnings. Next one, joint arrangement, in that only JV. Acha, under your AS, the joint ventures were accounted, CFS, the joint ventures were accounted by proportionate consolidation method. So their share, our share, proportionate, our share of assets, our share of liability, they were included. But under IND AS, we follow equity method for JV. To do one thing, our share of assets we had included, remove it. Our share of liability we had included, remove it. Our share of goodwill was there, remove it. NCI to hoga hi nahi because we booked only our share. That all you remove. Same value investment in JV comes in. So to measure the initial investment at transition date, so whatever we had recorded related to JV in CFS, our share of asset, our share of liability, our share of goodwill capital, so remove it. Same value investment in associate will, in your investment in JV will come in. Fine, this is done. Next. Okay. Question number 16. Question number 16. We are basically required to prepare a balance sheet. I'll take the points. They've already given some balance sheet. Okay. In relation to PP, the following adjustments were identified. A PP comprising land held for capital appreciation, investment property, costing 450 and was classified as investment property. So earlier it was part of PP, now remove it and make it as investment property. So from PP 450 goes away, investment property 450 comes in. Acha, exchange difference of 1 lakh were capitalized. Acha, so we might have some loan taken related to assets. We might have certain loan taken related to assets in foreign currency. Loan was brought to closing rate and that exchange difference was added or deducted in asset. वो past में किया था, it's fine. Fine. And you may still continue your policy for that loan. तो इसमें कोई adjustment नहीं है, no adjustment to be done. ठीक है. There are no asset retirement obligation, means there is no provision for dismantling. Achha, management intends to adopt a deemed cost exemption for using previous gap carrying amount. Achha, for PPE, I want to use previous gap carrying amount, no adjustment. They are same value, I want to continue. Okay, they have some investment in subsidiary, 48 lakh, fair value 68 lakh on transition date, and you want to record it at fair value. Karo. So you have investment at 48, I want to have it at fair value on transition date 68, 20 lakh will go in retained earnings. Okay, next, VAT deferral loan. VAT deferral loan, kya hai? For setting up something in backward area, we are given a loan. It does not carry any interest. It does not carry any interest and I have to pay after how many years? 5 years. Okay, fair value of loan on 31st March 1 is 3725. Entity choose to exercise the option and apply retrospectively. Yeah. They are telling clearly entity wants to account IND AS 20 retrospectively. If it was accounted retrospectively, the loan in the books would have been 3725. Remaining is deferred government grant. So very simple, that VAT deferral loan goes away. VAT deferral loan goes away. Uske jagah loan will be 3725. Balance will be deferred government grant. Balance will be deferred government grant. Question says they want to apply retrospectively. That's why. Otherwise, for that deferred government grant, they had said you can directly take, for that government grant, they told that you can directly take the previous gap carrying amount only. Okay, there's an ESOP reserve 20,000. Okay, total 1,000 options, out of which 800 have already wasted. For already wasted, no need to change anything. Achha, they had followed intrinsic value method, recognized 12,000 towards wasted, leave it. 8,000 for unwasted, this I need to bring based on fair value. Achha, so 12 would have been 15, leave it. 8 would have been 9. This I need to do. So ESOP reserve, SBPR I have to increase by 1,000. PNL debit ho jayega. Retain earning will be debited. Retain earning debit to SBPR. So upon basically transition, the changes go in basically retain earning. Okay, foreign cumulative translation difference, we want to avail, we want to make it 0. So I have a cumulative translation difference 1 lakh. So 1 lakh reserve is lying, remove it. So reserve debit to retain earning. So reserve mein se nikal denge, retain earning mein it will get added. Then the opening balance sheet needs to be prepared. It's a simple. Next is question number 17, Sawyer Limited. Next, question number 17, Sawyer Limited. Okay. 60% of Shaurya Limited shares are held by Government of India. तो कहने से Shaurya Limited is a government company. ठीक है. It's applying IND AS for the first time. 1920. Date of transition previous year beginning 1/4/18. Balance sheet given. I'll directly go to things. Okay. Other current liability include 390 to be paid in cash. Achha, if it is to be paid in cash, I have a contractual obligation to pay cash. It should not come under other current liability. It should come under financial liability. So make it other financial liability में ले जाओ. अच्छा, remaining 60,000 are statutory dues. Statutory dues are not contractual. They're statutory. So they continue under other current liability. They will continue under other current liability. Okay. Long-term loans and advances include, your long-term loans and advances include 40,000 loan. Achha, see, there's no concept of loans and advances under IND AS. So 40,000 loan is financial asset. Achha, remaining staff advance will come under your other non-current or other current asset. Okay, other non-current asset include 2 lakh capital advance for supplier. I've given capital advance to supplier. I'll be getting machine. Achha, I'll be getting machine. So I don't have a contractual right to receive cash. It will continue under other non-current asset. ठीक है. Other current asset include 350 receivable in cash. Receivable in cash will come under financial asset. And prepaid expense, I'll be getting goods or service that continues under other current asset. Short-term provision include dividend payable 2 lakh. Board meeting was subject to approval. Shareholder approval pending. No. It cannot be there. Unless it's approved by shareholder, I can't record it. So remove this liability and add in retained earnings. ठीक है. Next, property, plant, equipment carrying amount is 10 lakh. Fair value is 15 lakh. Company wants to follow revaluation model. Yeah, to make it 15 lakh. So 5 lakh PP goes up, add it in retained earnings opposite side. Intangibles, they are reluctant to incorporate fair value. Can they continue with book value for intangible? Yeah, PP they want fair value. Intangible they want to continue previous gap, allowed. No adjustment. Okay, they acquired 80% shares in the company. They recognize goodwill as per the earlier standard. Fair value exercise is not done. Fine. You may not restate the past business combination. Trade receivable is 20,000. Provision for doubtful debt, previous gap is this. Now as per latest estimate, in provision needs 25. Now CC, pay attention. The thing is, okay, we are transiting. We can use earlier estimate. If new situation came up now and estimate is changing, that is not as per IND AS. That is basically, that is not on switching to IND AS. तो वो अलग है. तो that will be accounted separately. So because of change in circumstances or info, now basically the provisions are required to be changed. That will be as per IND AS 37, not as per 101. So after shifting later होगा ये. ठीक है. Company has given a loan for a 10 years. 6 years ago, principal amount to be repaid this way. Okay, the fair value of loan on transition is 50, carrying amount 40. Okay, so remember financial asset, financial liability, you can take the fair value on the date of transition directly. So you take directly 40 becoming 50, 10,000 loan given, asset increasing, opposite retained earnings mad. Okay, next. In long-term borrowing, 450 is basically state government. It's a 4% loan, present market rate 8%, the fair value of loan is 420. Fair value of loan is 420. Now, say mandatory exemption is there. Below market rate government loans are there. Continue at the previous carrying amount. No change. Achha, previous gap, mutual funds are at cost or market value. IND AS they will be at FET PNL. Okay, I want to bring it to its fair value. Previous gap 2 lakh are included. Current value is 230. Now they will be taken at today's fair value 230. 30 is added in retained earnings. Achha, and all this change happened. Don't take DTA, DTL impact separately. They have given the 50,000 is deferred tax impact of all of this, and we have to create a DTA. DTA you are creating DTA debit to retained earnings. I hope this is clear. Okay, carve in, carve out between your IFRS 1, IND AS 101. The definition of word previous gap, we have the word reporting requirement in India. That word they don't have, definitely. Acha, PPE में we are allowed to have a previous gap carrying amount, they don't have. Acha, foreign currency monetary item में जो policy था, we are allowed to continue, they don't have. So these are the differences. Acha, this 18th question, good one. 18th question, good one. The financial statement under IND AS, the transition date is 1st April. Following adjustment done, we opted for fair valuation of land and 4.5 becoming 10, 5.5 land may added, opposite retained earnings. Okay, the proposed dividend is there, they've already accounted, it's not yet approved by shareholder, remove from liability, add it in retained earnings. They want to fair value the investment, there's an increase 75 lakh, investment goes up, add it in retained earnings. Preference shares are redeemable, it will be removed from capital, coming under your liability. Reserve surplus before transition, 40 crore general reserve, 5 crore capital reserve, 95 total, so 50 crore was retained earnings. What is the balance of total equity? What is the balance of total equity? Okay, so equity share capital, preference removed. General reserve and this is same. Retained earning was 50, these are all changes happening, this is coming 182. Now show the reconciliation. As per old it was 200. As per old it was 200. Now 1. Your preference shares iske andar se nikal gaye, they are reclassified. The effect of reclassification, we remove preference share. Okay. Then derecognition, that proposed dividend we removed, uske karan profits, retained earnings are going up. And then there was remeasurement, uski impacts are considered. So this is your reconciliation. Then this is your chapter of IND AS 101. Now going to the last chapter of the day, analysis of financial statement. Now going to last chapter of the day, analysis of financial statement. Very simple. It's all based on IND AS and Schedule 3. The analysis of financial statement, nothing new. IND AS mein what we did, Schedule 3 mein what we did, uske related the question will be there. Okay, what are the characteristics of a good financial statement? It should show a true and fair view. It should show all the relevant information. Things should be understandable. Consistency should be there. Compliance, it should comply with laws and regulation. And last one, comparable. Universality is comparability. Best practices is fine. It's not mandatory. Best practices to be followed. This is not mandatory. Practice it. If you follow, it's good. So one, you need to ensure you are complying with all accounting standards, regulation in a manner what is given. Second, information given is complete. Data given is in simple and proper way, specific way. Note should not be ambiguous. It should be simple. Transparency, everything, all disclosure should be fine. What to disclose, what not to disclose, materiality basically will help you out in that. Integration of notes should be done in a proper way. You disclose all your significant accounting policies properly. Whatever estimate judgment you have made, uske related also you give the disclosure and have an integrated reporting approach. Integrated reporting is not just finance side, qualitative, quantitative, everything. Where you are, where you want to reach, how you're going to reach there, the entire story of the company you give. Okay, this is fine. Come to the questions which are there, important ones. Where is important question? Question number 5 tak to nahi hai, 6, yeah. Come to question number 6. Five, 10 more minutes, that's it. Okay. Now, Soft Bharti Private Limited with Iktara. Soft Bharti Private Limited, wherein investment 55% is done by Iktara, rest by Deepak. So Iktara holds 55, Deepak holds 45 in Soft Bharti, actually in Soft Bharti. Ulta hona chahiye, it should be here, this way. Fine. So this is the thing. Now Iktara ke financials are as per IND AS. Iktara ke financials are as per IND AS. So Soft Bharti is a subsidiary. Their financials should also be as per IND AS. They've given financials, but things will be wrong. Like see, balance sheet, they've started with liability side. So we have to rectify and prepare it new. We have to prepare a new one. Okay, deferred tax liability 6,000 was created due to timing difference in depreciation. So they already given your asset as per book 1, this is 80. So can I say 20,000 is difference? So asset as per income tax is less. So can I say more depreciation under income tax? 20,000 uska 30%. You get 6,000. The extra 20,000 depreciation in IT. You got more depreciation in IT. So today you are paying less tax. Future I have to pay more tax, DTL to be created. So this is this. Okay, pre-incorporation expenses are deductible on SLM basis over 5 years under income tax. Okay, the books mein pre-incorporation expense went to P&L directly. Tax mein they are over a period of how many years? 5 years. Okay, 30,000 tha, usme 1/5, 6,000 allowed this year. 24 they will allow in future. 24 they will allow in future. Future mein allowed hoga. So I'll have to pay less tax in future. DTA to be created. Okay, current tax is 30% of PBT. Now they took 30% of PBT given. ये जो PBT है इसका था नहीं ये इसका नहीं लेना है. PBT as per income tax. I have to take 30% of PBT as per income tax. So it should be correct income tax comes to 125,700. I have to take 125,700. Okay, then there was some dividend. It's not yet approved. Remove it from liability, add it to retained earnings. So removed from liability, add it to retained earning. Okay, some statutory government dues amounting to 15,000 which are grouped under other current liability. Okay, government dues continue under other current liability. Correct. So correctly shown. Okay, capital advances are grouped under other non-current asset. Capital advances, I don't have a contractual right to receive cash. It continues under other non-current asset. Correctly shown. Ye bhi correctly shown. Okay, other current asset 51,000 interest receivable. Interest receivable is contractual right to receive cash. It will come under other financial asset. Okay, next. Current investments are 30,000. They are now to be carried at FVT. P&L fair value is 50. So investments add opposite 20,000 add in retained earnings. Sorry, not retained earning, other income. This is not transition. This is not transition. So they forgot to do a fair value through P&L. Acha. Now, if investment goes up, asset goes up in books, DTL required. 26,000 DTL will be required. Acha. So now just try to understand. 6,000 DTL. Again 6,000 DTL, 12 and minus 7,200 was DTA. 7,200 was DTA. Acha, there's actuarial gain on employee measurement benefit. This goes in OCI. So OCI may 1,000 rupee income to be taken and liability goes down. So liability goes down, OCI may income to be taken. You take income in OCI, uska related deferred tax will also come in OCI. You have to pay tax later. So DTL 300 rupee will come. So now if you see 6,000 DTL plus 6,000 DTL plus 300 DTL minus 4,800, 7,500. 7,500 DTL and balance sheet में already कितना था 6. 7,500 DTL and plus balance sheet. Acha, they have written only 6. Now 7,500 is your DTL. Let's just check the balance sheet. Kitna DTL they have given. 6,000 plus 6,000 minus 4,800 plus 300. 7,500. क्या हुआ? Let me just check it. DTL. Is there any other? 6,648. Yes, 6 DTL. Fine. ये DT अच्छा 7,200. Okay. 6,000 plus 6,000 minus 7,200 and plus 300. It's 5,100 DTL in your balance sheet. 5,100 DTL in your balance sheet. Yes, tally it. Out of 5,100, 300 ka effect comes in OCI. 4,800 effect will come in P&L. So check. In your balance P&L में ये 300 यहाँ पे आया and here it will be 4,800. 300 and 4,800. Correct. Okay, all points are done. Remaining all is fine. You can just go through the solution. We discussed each and every point. Okay, question number 7. Master Creators Private Limited. Again, a draft balance sheet is given. They would be requiring a rectified balance sheet. Now, there's a compound financial instrument. There's a compound financial instrument. Can I say it should have been split between a liability component, equity component? It was not done. So, split it. Split it. First April 1 hai, and this is balance sheet of which date? March 2. So split, find out on day 1 what should be the liability, what should be the equity. Then on liability, interest accrues, you get a closing liability. Interest accrues, you get a closing liability. Now put that figure in your balance sheet. Put that figure, liability component, equity component, and current whatever is included, that you remove it. Fine. Next point is dividend. We already did it in last two questions, so that is okay. Third, other current liability include, okay, wages payable, contractual obligation to pay cash, financial liability. Salary is also financial liability. TDS is a statutory due, remains here. Interest accrued is again other financial liability. Out of 4, only 1 will remain here, remaining will go to other financial liability. Okay, building continues under PP. Land held for capital appreciation goes to investment property. Vehicle remains under PP. Factory premises still it will take 2 years to complete, keep it under CWIP. Okay. Other current financial asset, prepaid expense will be other current asset. Interest accrued, royalty receivable, it's contractual right to receive cash, they will come under other financial asset. Okay, current investments, we are bringing it to fair value, so investment goes up, opposite is retained earnings. Entity has an intention to set off deferred tax asset, deferred tax liability, so the net, what is there in balance sheet, usme net dikha do. And the opening balance of retained earning is given to us. Prepare the correct balance sheet. Fine, I think we discussed all the points, so there won't be any problem to you. Yeah. This is basically you bifurcated equity component, liability component. This was on day 1. Then interest accrued, closing is this. Interest accrued, then closing is this. So that much liability will come in your balance sheet. This much equity component will come in your balance sheet. Okay, question number 8. Question number 8 and 9, last 2 questions. Okay, Mumbai Challengers, a listed entity, is a sports organization. They need a new stadium. They started constructing stadium. Okay? They started constructing stadium. Cost 140 crore in December. December they spent 140 crore. 350 crore per month till the end of the year. Year ends in March. So December they spent 140. January, February, March, each of the month 350, 350, 350. No specific borrowing. Okay, only general borrowing, rate is 15%. Very simple. As in when you use that way, capitalization happens. So 140 crore, 15% for 4 months. 350 crore, 15%, 3 months. Again 350 crore, 15%, 2 months. And last 350 crore, 15%, 1 month. So this is your answer. Check out. Yeah, simple. 140 crore I used for 4 months. 350 I used in January, this for 3 months. Again 350 I used in February for 2 months, and again 350 I used in March for 1 month. Assume that beginning of the month they are spent. Okay, next. Mumbai Challengers acquire and sell player registration, player ke rights. Okay, so if I acquire player ke rights, it will be my intangible asset. Right. Virat Kohli for 5 years, wo aapke paas right hai, so that's intangible. The cost of acquiring the player registration, uske liye what you are paying money, and reporting year end, you review the contract with players and you decide which player you want to retain, which player you want to sell it off. And if you have a player, the player cannot play for basically other clubs because of you. If you have it, the player registration ke liye you paid total 175 crores. Player registration were sold. Achha, player registration was sold. I sold an intangible asset at 175. Carrying amount is 49. Difference goes in P&L. Fine. Mumbai Challengers measures its stadium in accordance with revaluation model. Stadium is measured in accordance with revaluation model. Airline company has approached the director offering 700 for property naming right of all stadium. Property naming right of all stadium. Achha, naming right of all stadium for how many years? 5 years. ठीक है. Naming right, I am just selling that naming right for how many years? 5 years. The directors, 3 directors are on management board of Mumbai and airline. Achha, both the companies have directors in common. Both the places KMP common, they are not related. Both the places KMP common, they are not related. So how to account of the naming right in valuation of stadium and potential implication. This, let us just check it. First and second were fine. Third one. Property naming right, if you want to sell that. So as per IND AS 113, fair value is fine. It has nothing to do with property, but it can be of significant worth. So you should include property naming right in the valuation of stadium and write it off over a period of stadium. The property naming right is identifiable, intangible, you can record it. Achha, related party, both the places just a key managerial person, they are not related party. And it's not valuation of stadium we are talking about the valuation of stadium ka naming right that Mumbai Challengers have and can sell it off. Okay. Next one, question number 9, Nishchal. Okay, not Nishchal, it's Nilanchal. Nilanchal Gas Refinery. They jointly own an underground storage facility with another entity, Simanchal. They own 60% of underground facility, Simanchal ka 40%, but every decision require unanimous. So even though you hold 60, you don't have a control. It's a joint control. Okay, the underground facility is pressurized so that the gas is pushed out when extracted. And when the gas pressure is reduced to certain level, some gas is irrecoverable, wo rahega jab tak you don't decommission it. Some gas will remain, it will come out only when you decommission it. Okay, so what is the agreement? It is basically a joint arrangement, separate entity not created, it's a JO. Separate entity not created, JO. I'll record my share of assets, my share of liability, my share of income, my share of expense. So based on this, no separate vehicle formed, it will be regarded as your JO. It's a joint operation. You record your share of PPE, your share of other expenses, incomes, everything. Fine. Next, Nilanchal has entered into a 10-year contract with Uttaranchal for purchase of gas. They have paid some advance based on forecasted price. The advance carries an interest 12.5%. The contract requires fixed quantity of gas to be supplied every month. There's a price mechanism. Is settled on quarterly basis. If they don't deliver the gas, Nilanchal has a right to claim compensation. They want to know whether it is accounted as per IND AS 109. Now tell me, I entered into contract to buy gas and it will be settled upon delivery. If it is settled upon delivery, would it be accounted as per 109? Answer is no, it's outside the scope of 109. It's outside the scope of 109. Check out. The contract will result in physical delivery of gas outside the scope of 109. It is not covered under 109. That's it. We are done with our revision. There are 3 small topics which are there, which you have to do on your own. One is a conceptual framework. Second, we have basically accounting and basically the professional duty of accountant and basically accounting and technology. So these are just 3 theory topics. Other than that, all IND AS. All IND AS I have covered, not even one IND AS skipped, and it has been done in great detail. And I tell you, approximately it took 27 to 28 hours for revision. I thought of 4 days, but instead of 4 days, we had to extend for 5 days. I thought of basically 5 hours a day, but instead of 5 hours a day, every day I've taken 5.5 to 6 hours a day. So for 5 days, 5.5, 6 hours a day, 27 hours we have taken. In-depth revision is done. Please make sure you get benefit of this and also you share about it to all your friends. Just one thing for you, your exams are very, very, very nearer. Only one thing, never ever quit in between. I repeat, never ever quit in between. It may happen one of your paper doesn't go up to your expectation, it's fine. Gone is gone, you cannot change it. Focus on the papers in remaining. Wo gaya, you can't change it. Just make sure that whatever you lost in that paper, try to recover from the remaining paper. But if one paper goes bad and because of that you're upset and you quit the examination, rest assured you're 100% fail. If you skip your exams, you're 100% fail. If you're writing, there's still 1, 2, 5, 10, 15, 20% probability you may pass out. So never ever skip your examination. Just make sure you keep on putting your efforts and you enjoy basically writing your examination. So make yourself such strong that you won't have any problem in the paper coming up. Someone asked me, sir, should I start with MCQ? Should I start with the big questions? It's up to you. I generally prefer starting with short questions. Rather than doing a very big question, I'll prefer doing a small question so that I'm feeling a bit confident. I generally will start with MCQs. It becomes more easier for me. So all the best to all of you. Rock the examinations and definitely we'll meet after the examinations. See you all later. We'll do audit ka marathon during that holidays. Audit mein you're having actually 3 days holiday and 4th day is examination. So we'll be taking up audit marathon during that examination days. All the best to all of you. Bye-bye, tata and take care. Okay, Jacob has a question, sir. Will these videos be kept after the exam? Answer is yes. This all videos will be available on YouTube only afterwards as well. Thank you, Aradhya. Thank you, Jacob. Thank you, Abhijit, Harshit. It's important to dream and to chase your dream. Be sincere and honest, dreams do come true. Your dream is about to come true. Just continue your efforts, be sincere and honest. Chalo, bye-bye everyone.